A Random Walk Down Wall Street by Burton Malkiel. Malkiel, a Princeton economist, argues that asset prices exhibit signs of a random walk, which later popularized the random walk hypothesis. He believes that an investor cannot consistently outperform market averages. Although I must say I raised an eyebrow when I read this statement, nonetheless I offer an impartial review of the book for those looking to learn from some of the key topics presented. I hope you enjoy, and as always, please hit the like button and subscribe to our growing library. It really does help the channel. The random walk theory discussed by Malkiel is similar to the efficient market theory. Both suggest that the price reflects all known information about an asset, and both advocate that the only consistent approach to investing is a strategy of buy and hold. In fact, Malkiel went on to say, a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. Conversely, on the opposing camp, we have the approach of technical and fundamental analysis, each looking for opportunities conflicting with the concept of random and efficient theories. But which is right? Or can they all be right? Malkiel does, however, align all theories and strategies to a common purpose, that is, improving upon a return better than inflation. He said, "It is clear that if we are to cope with even a mild inflation, we must undertake investment strategies that maintain our real purchasing power. Otherwise, we are doomed to an ever-decreasing standard of living." An example of how inflation can slowly erode purchasing power is provided with a McDonald's double burger. In 1962, the burger would have cost 28 cents, and in 2018 the same burger cost almost $5, an increase of 1,610%. Malkiel segregates investing theories into two buckets, the firm foundation theory and the castle in the sky theory. The firm foundation theory argues that stocks or even a piece of real estate have a firm anchor of value, also known as an intrinsic value. For example, fundamental analysts fall into this bucket. They might look for current and future earnings or dividend yields and then work backwards to determine the intrinsic value of a stock. Benjamin Graham and Warren Buffett typically follow this firm foundation approach. Next, the castles in the sky theory looks at what Malkiel calls psychic values. He alluded that investors were more inclined at analyzing crowd behavior, known by technical analysts and traders as trend following, often without any consideration of the stock's value. Malkiel said, "In this kind of world, a sucker is born every minute, and he exists to buy your investments at a higher price than you paid for them. Any price will do, as long as others may be willing to pay more." In theory, the investor looks to buy high but sell higher, the opposite of the firm foundation investors looking to buy low and sell high. Growth and momentum stocks are the likely selections in this bucket. In my opinion, however, you do not need to choose between either. My strategy is a combination of both, which I call the hybrid theory. Malkiel expands upon his castles in the sky theory by discussing the madness of crowds. He notes the irrational exuberance of crowds which have been the cause of many financial bubbles over the years, including the Dutch tulip craze of the 1600s, the stock market bubble of 1929, the biotech craze in the 80s, and more recently the dot-com bubble and 2008 real estate bubble. The bubbles eventually burst, money dropping in price by between 50 and 90%. Using the previous theory, the sucker who bought hoping to sell at a higher price would have been left with a huge loss. Malkiel gives reasons for such irrational exuberance through his lessons of behavioral finance. He said, "In investing, we are often our own worst enemy. As Pogo put it, we have met the enemy and it is us. An understanding of how vulnerable we are to our own psychology can help us avoid the stupid investor delusions that can screw up our financial security." Behavioral finance questions the idea of the rational investor, highlighting that there are at least 4 factors causing irrational investor behavior: overconfidence, biased judgments, herd mentality, and loss aversion. The herd mentality in particular is often the reason for asset bubbles like these, The lure of getting rich quick and getting swept up into speculative investment decisions usually leaves you trampled by the herd. Malkiel suggests that to make the transition from an irrational to rational investor, we must avoid the herd mentality, overtrading, IPOs, hot tips, and sell losers, not winners. According to the random walk theory, despite becoming a rational investor, we are still unlikely to beat the market, although we are more likely to beat inflation and less likely to suffer huge financial losses. So how does Malkiel suggest we invest? He says, the core of every portfolio should consist of low-cost, tax-efficient, broad-based index funds. We previously provided some detailed analysis of such advice in our review of the book Common Sense Investing, of which author John Bogle provided clear evidence supporting Malkiel's view. Without repeating information previously covered, we add to the advice. In particular, Malkiel provided some allocation principles. He provided a table which shows a history of performance and a clear correlation between the risk and return relationship for a given asset. Here we can see the distribution of returns covering the period between 1926 and 2018. In terms of distribution and return, we can see a positive bias amongst all the assets. The point Malkiel makes here is that despite not being able to predict short-term asset prices, which is the foundation of his random walk theory, he does acknowledge that over the long term there is some predictability in terms of achieving higher returns from bearing higher risk. We can see here that US Treasury bills resulted in minimal risk and minimal return when adjusted for inflation. In contrast, we can see small cap stocks have seen considerable risk, but they have been compensated by higher returns. When building your own investment portfolio, it would be wise to consider your equity allocation against these metrics. Having established a relationship between risk and reward, Malkiel provides advice on reducing risk, specifically the modern portfolio theory. The key concept is diversification, and the theory was developed by Harry Markowitz in 1950, backed by thorough mathematical justification. He suggests that risky, volatile stocks become less risky when combined as a whole. To simplify the concept, we provide an island which occupies only two businesses, a resort owner and an umbrella manufacturer. We establish a 6-month rainy season and a 6-month sunny season, and each business had the following returns in each season. We can see both businesses had the same return when looking at the full 12-month period, but individually they had very different results depending on the environment they were in. A portfolio weighted with too many stocks that react in the same way to certain economic situations or cyclical environments can lead to larger drawdowns and erratic performance. The message, therefore, is not simply diversification over different assets, but diversification over assets which have a negative covariance. Too often we hear investors say they have a diversified portfolio, but this often only relates to the number of stocks being held. True diversification is holding a portfolio of uncorrelated stocks, which can reduce risk and volatility when constructed correctly. Whilst on the subject of risk, diversification and portfolio size, Malkiel provides further analysis relating to the number of stocks in a portfolio and the associated risk. Here we can see the number of stocks and here the assumed risk. Looking at a typical well-diversified US stock portfolio first, we can see that holding one stock assumes 100% risk. Holding 5 stocks reduces risk by approximately 15%, and holding 20 stocks reduces risk by almost 50%. The optimum portfolio size, according to the study, suggested a portfolio of at least 50 stocks, which provides a risk reduction of 60%. Additional stocks thereafter provide minor risk reduction benefits. The study also gave a comparison using a portfolio of international stocks, and we can see a 50-stock portfolio of diversified stocks across the globe reduces risk by up to 70%. Unsurprisingly, the more stocks you add to a portfolio, the more your results will resemble the returns of the market, and the less random the walk becomes. Equally, the longer you hold such a portfolio, the less random the returns become. We can see in this chart the returns of the S&P 500 index for the period between 1950 to 2017. Notice how a holding period of just 1 year can see a range of between a negative 37% return to a positive 52.6% return. And in almost a linear fashion, through to a holding period of 25 years, we can see the range is between a 5.9% and 17.5% return. Again, adding weight to Malkiel's view that results are random in the short term and less so in the long term. The final chart offered from our review compounds Malkiel's overall opinion: invest in a fully diversified portfolio or index, make periodic investments benefiting from dollar cost averaging, and take advantage of the immense power of compounding. Incredibly, a $1 saving in the year 1800 would have compounded to over 27 million by 2021. No wonder Albert Einstein called compounding the greatest mathematical discovery of all time. In summary, Burton Malkiel believes an investor would be better off buying and holding an index, whilst benefiting from diversification and eliminating the destructive psychological traits that often succumb an investor trying to beat the market. The book offers excellent, in-depth knowledge about investing, and with over 400 pages, it's possibly the broadest of its kind. Too much to cover in this short review, and a highly recommended purchase. Thanks for listening, and again, please hit the like button, subscribe, and join our community below.
Thanks everybody for coming to part of the series on being fiscally fit. We're deeply honored and appreciative today to have Dr. Burton Malkiel join us from Princeton. Dr. Malkiel is a seminal figure in finance and economics, and particularly in personal finance. Dr. Malkiel not only has a distinguished career, which I'll tell you briefly about, but in many ways was the first person to have the insight about what is the optimal investment strategy, and one that's actually been proven over time to be effective. And while there's a lot of debate about it, it is one where if you examine the data, you'll find it actually works over just about any measurement period, over any economic period in the United States, which is a remarkable achievement. He received his bachelor's degree and his MBA from Harvard University, and originally went into the business world, but always had an interest in academic economics, and eventually earned a doctorate from Princeton University. He's the Chemical Bank Chairman's Professor of Economics at Princeton, and is a two-time chairman of the economics department there. He served as a member of the Council of Economic Advisors from 1975 to 1977, president of the American Finance Association, and dean of the Yale School of Management. He also spent 28 years as the director of the Vanguard Group, and is still very actively involved and a member, I believe, of the board of their international operations. One of the things I think you'll learn is that people vary wildly in their ability to assess risk, particularly when it comes to their personal finances. And Dr. Malkiel will give you a tremendous amount of insight into what works and what doesn't. Beyond that, the advice I think he'll share today with you actually is proven to be true and actually works, which is a useful thing when it comes to advice. Many of you found a copy of his Elements of Investing, which is his latest book, a follow-up to his decades-old bestseller, A Random Walk Down Wall Street. I think you'll enjoy his talk a great deal, and I welcome Dr. Malkiel to Google.
Thanks very much for your kind introduction, and thank you all for coming. I'm just delighted to see all of you guys as far as the eye can see. What I'm going to do is talk to you today. I call this talk Timeless Lessons for Investors, because I want to talk about what I think are the timeless lessons, and some of them which are, in fact, in question right now. So let me begin by talking about some things that people now say we have presumably learned given the past financial crisis. One of the things that they presumably have learned is that now you have to time the market. After all, we realize that we've just been through a period where the market tanked, went down almost 50%. And this shows you that buy and hold is dead, that's the wrong thing to do. And basically, I don't think that that's correct. I still believe in buy and hold for the following reason. Obviously, if we knew that 2007 was the top of the market, if we knew that, yes, we should have sold then and then bought back in March of 2009, which turned out to be the bottom of the market. But nobody can do that. You know, I've been in the investment business for a long number of years. I have never known anyone who could consistently time the market, individual or professional, and I've never known anyone who knows anybody who could consistently time the market. And the problem is, if you try to do it, you are much more likely to be wrong than to be right. Now, this gives you an example of what people actually do. And what we've superimposed here is the solid line shows you the performance of the world stock markets, and the bar graph shows the flow of funds into equity mutual funds superimposed on how the market is doing. And what you notice is that when the market is high, that's when people put their money into the market, and when the market is low, that's where people take their money out. More money went into the market during the internet boom in late 1999 and early 2000 than ever before. And then in October of 2002, which was the bottom of the market, more money went out than ever before. Similarly, in the late first decade of the 2000s, when the market was high, the money poured in. And when did the money come out? The money came out in late 2008 and early 2009 that turned out to be the bottom of the market. So what happens when you try to do that and you let your emotions tell you, because after all, what's happening is, at the top of the market, all the stories are it's optimistic, everything's going to be perfect. At the bottom of the market, the sky is falling, the world's going to end. That's when people take their money out. And so I'd much rather be a buy and hold investor, and just because I know I can't do it. And I don't think anybody can do it. And the fact is, remember, when you try to time the market, you've got to be right not once but twice. You've got to be right when you get out. You've got to be right when you get back in. And because when there are reversals in the market, they happen so quickly. If you take a period, and this was done from 94 to 2008, where the buy and hold investor had something, and this was not a great time to be in the market, had a 7% return. If you had, in fact, just missed the best 10 days, your return got down to practically nothing. And if you had missed the best 30 days, and remember, those best days typically were the leaps up right at the bottom of the market when everyone is pessimistic. You missed those days and you actually had a negative return. So I say, don't try to time the market. You can't do it. It's very dangerous. Now, not only do people make mistakes when they try to time the market because they get in at the top and out at the bottom, but they buy the wrong kinds of funds. Remember, I told you more money went into the stock market in late 1999 and early 2000 than ever before. Well, what did it go into? It went into high-tech funds. It didn't go into the value funds, which were actually very cheap then, and value stocks actually did well at the beginning of the 2000s, but it went into all of the internet stocks. You know, I remember so vividly as a director of the Vanguard Group, our flagship, Vanguard has generally had a lot of value funds. Our flagship value funds were losing assets, and all the assets were being taken out. And, you know, you sort of wonder where they were going. Because when you're in a mutual fund complex and there's a redemption of a fund, it goes into the money fund. So you have to look at where the checks were written from the money fund. They were all written to this company in Denver called Janus, and they went to something called the Janus 20 Fund, which was 20 of their best stocks. They were all internet stocks. So there's also this selection penalty that money went into internet stocks and out of value stocks at the top. And again, you know, without going through all of the bars and things in there, there's also a selection penalty. There's a study that was done by a company called Dalbar. And what it did was it tried to compare the returns that are published by the mutual funds, or when you say the stock market did a certain rate of return, from how individuals fared. In other words, if let's say there's a period, and this is a period from 1988 that this was the Dalbar study to 2007, so it did go to the top of the market. It's not, this is not indicative of what the stock market is going to do in every period. You had an 11.6% rate of return. But if you look at how the average investor did, realizing that the average investor wasn't necessarily in the market at that time, that the average investor didn't buy and hold, wasn't buying at the beginning and holding all the way through, the average investor got only 4.5%. And again, that's the danger of trying to do the timing. You can't do it. It's very dangerous. Obviously, with perfect hindsight, yes, you should have timed the market. You can't do it. Don't do it. You're more likely to do it wrong than right. And incidentally, this is true not only of individuals, but for institutional investors. I have looked at the cash positions of active managers, whether they're pension funds or mutual funds. Institutional investors have more cash at the bottom and the least amount of cash at the top. Nobody can do it, neither amateur nor professional. The second timeless lesson is what I will call the dollar cost averaging lesson. Again, the argument is, and most of you who are accumulating, who are saving over time, are taking advantage of this, there is an advantage for putting money into the market regularly over time. So what this shows you is that even though the market was rising in what's to the right of the screen, you actually made more money in this volatile flat market than you did in the rising market. Now, it's not always true. The dollar, obviously, if the market is continuously rising, you want to put all your money in at the beginning. But if, in fact, we're in a situation of pretty volatile times, you're more likely to be on the left-hand side of the screen, and at the very least, you're going to reduce your risk this way. And the regret that comes if you happen to put all your money in at a market top. I'm very fond of the advice of Warren Buffett, who likes to give this quiz. So you plan to eat hamburgers all of your life. What would you prefer? Do you want lower prices of hamburgers in the future or higher prices? And you know, obviously, if you're going to buy hamburgers, you'd like lower prices in the future. Or you want to buy automobiles throughout your life, and you're not an automobile manufacturer. You'd prefer the automobiles to be lower in the future. And now for the final exam, Warren Buffett says that most people get wrong. So you're going to be an investor all of your life. Do you want higher prices or lower prices? And the answer is no, you actually would want lower prices. It's as if you're buying cheaper hamburgers or cheaper automobiles. It's only when you're close to retirement that you want to get into the safer stuff where you take things out. And incidentally, what you have actually as part of your options, for those of you who are getting closer to retirement, that's why you have target maturity funds, that in fact make sure that you're not at a time at the end where everything's in the stock market when the stock market might be low, and the target funds do exactly that for you. Now, the other thing that is, I think, a timeless lesson is to rebalance, and I say yearly. My own work suggests that one ought to rebalance yearly, and this gives you an example from January 1996 through December of last year. That the bottom row says if you were not rebalanced, you simply start off with a balanced portfolio of 60% stocks, and we'll say you're in an index fund, what is called generally a total stock market index fund, which in the Vanguard case is with the Russell 3000, and 40% the broad bond market index, which this says the Lehman. Unfortunately, it's now called the Barclays Global Index. I don't know, something must have happened to Lehman along the way. I'm not sure what it was. So if you were not rebalanced, you had an 8.75% return. And then if you just simply said, I want to be 60-40, and I'm going to rebalance every year, that's what the top row suggests. So every year, you look at the portfolio. If you're away from 60-40, you go back to 60-40. And you have a rate of return that's well over 1 percentage point higher. So why does it work? Well, it works for the following reason. Just think. You can't time the market, but let's say we're going to rebalance in January of every year. So you started off 60-40. We're now in, January of 2000. You don't know it's the top of the market. Nobody knows it's the top of the market. But what you do know is that your stocks are sky high, and the Federal Reserve was increasing interest rates, which means bond prices fell, and your bonds were low, so you might have had 75% in stocks and 25% in bonds. And so you say you take some money off the table, you take it from the stocks and put it into the bonds. You're then January of 2003. You don't know you're just after the low of the market, but what you found was the Federal Reserve had lowered interest rates, so bond prices were up. So your bonds might have been 50-55%. Stocks were in the tank. So stocks were well below your target. And so you then sold some bonds and bought some stocks. That's why this works. And rebalancing, again, if the stock market does nothing but go straight up, even then, it'll work in that it gives you much less volatility, but you won't quite get the extra return. But again, if we're going to be in volatile markets, rebalancing is going to not only reduce your volatility, but it's going to increase your rate of return. Now, the other timeless lesson that I hear all the time saying, boy, diversification doesn't work anymore. We learned that in 2008 and early 2009, there were few places to hide. Everything went down together. Emerging markets went down. The U.S. market went down. Diversification doesn't work anymore. That's I can't tell you how often I read that. Well, first of all, if you were in bonds, if you had some bonds in your portfolio, diversification did work. What we know about diversification, you get the most benefit when you buy an asset class that tends to be uncorrelated or very lowly correlated with, say your main asset is U.S. stocks. Bonds actually have become a better diversifier over time in that the correlations have actually fallen. So there were places to hide. In fact, what happened with bonds was the Federal Reserve was reducing interest rates to essentially zero, And bond prices were going up, so bonds were a place to hide. Now, it's true that all world stock markets became very highly correlated. And globalization has tended to increase the correlations among markets, but even though the correlations have gone up, it's still paid to be diversified internationally, because here you have a graph of the emerging markets in the decade from 2000 to 2010. And, you know, it's something that people often call the lost decade because it was not a good time. These are worldwide stocks. It was not a good time to be in the stock market. You ended up about the same place that you began, but emerging markets gave you a 10% annual rate of return. So even though the ups and downs are the same, you know, it's the fact that, you know, they look like they're very highly correlated, and they are highly correlated. That still didn't mean that you didn't want to be diversified, because you did much better if you were diversified and had some of the emerging markets. And again, let's sort of put these things together. The advantages of diversification, rebalancing, and dollar cost averaging. You have at the bottom of the slide the lost decade. You were in the S&P 500. You didn't make a penny. You, in fact, lost some money. And in the top part of the graph, it says you're diversified. You have bonds. You have some international stocks, including emerging market stocks. And you do a little bit of dollar cost averaging. And in the first case, your $100,000 declines to $80,000. And in the second case, your $100,000 goes up to $250,000. So it basically just gives you some numbers to go away with what I've called the timeless lessons, that by diversifying, dollar cost averaging, and rebalancing, you get a much better investment performance. The next slide, and I'll try to tell you, those of you who don't see the slides, what this shows you, is that costs matter. You know, I think all of us need to be very modest about what we know about financial markets and what we don't know. But I will tell you the one thing that I am absolutely certain of. And the one thing I'm absolutely certain of is the lower the costs charged by the purveyor of the investment service, the more there will be for you. You know, it sounds so obvious, but it is just absolutely the case. As the founder of the Vanguard Group, Jack Bogle, likes to say, in the investment business, you get what you don't pay for. And what this does is it breaks down all mutual funds. And these are not just, these are actively managed funds. This is every mutual fund there is in the United States. And it divides them into quartiles. The low-cost quartile has lowest turnover and the lowest explicit expense ratio. The high-cost quartile has the highest costs and the highest portfolio turnover. And the low-cost quartile gives you an 8.66% rate of return. The high-cost quartile gave you a 6.66%. And this is the period 1994 through the end of last year, the end of 09. So you got 2 percentage points more a year. And, you know, I've done all kinds of studies for how do you pick the mutual funds that do best. The only thing that is reliably related to how mutual funds do is the cost they charge. And so the one thing you can control are the costs you pay. You want to have funds that charge the lowest in expenses. And that brings me to one of my favorite subjects, is that you ought to also use, at least to some extent, index funds, because the quintessential low-cost funds are index funds that simply buy and hold a broad portfolio and charge minimal, I mean, they're very close to zero expense ratios. Now, I've always argued that index funds make sense, first of all, because markets are reasonably efficient. You know, there are a lot of very smart people out there looking for every opportunity to buy cheap stocks, and they therefore give you a tableau of market prices that makes it very difficult to find really cheap stuff. You know, the way we academics like to tell this is the sort of story about the efficient market professor who's walking along with a couple of graduate students, and the graduate students see a $100 bill on the ground, and one of the graduate students stoops to pick it up, and the professor says, don't bother to pick it up. If it were really a $100 bill, it wouldn't be there. You know, I'm not quite that extreme. I tell the graduate student, pick it up right away, because it isn't going to be there for long. I mean, we just don't leave $100 bills on the ground very long. So that's one reason why you ought to be in index funds. But even if you don't agree with me that markets are pretty efficient, indexing still has to be an optimal strategy, because when you think about it, investing has to be a zero-sum game. That is to say, we're all different investors. We buy different stocks. Since all the stocks have to be held by somebody, it must be that if I just buy the stocks that go up the most, somebody else has had to have the stocks that didn't go up. This is just, we don't live in Lake Woebegone. We cannot all be above, we can't all be above average. So if you think of it then, that if half the people are better than the market, half of them have to be below the market, you realize it's a zero-sum game. But in the presence of costs, if you now say that on average, and this is true, that on average, purveyors of investment products charge 1 percentage point in costs, that means that if the market does 8%, you've shifted the whole distribution over, in that everybody's going to get whatever they got from their portfolio minus the 1% of cost. It then must be that most people will underperform the market if you could buy an index fund that has the whole market at essentially zero cost. And that's really it's a matter of arithmetic that since index funds are available at, something like right around 0.1%, essentially zero cost, it has to be that as a matter of logic, they're going to outperform most other managers. And, I look at this stuff, I said you ought to be in index funds before index funds even existed. I'm actually working on the 10th edition of my book, A Random Walk Down Wall Street. And every time I do it, and these are data that I'll put in the new edition, every time I look at it, look at the last year, look at the last 20 years, you see generally 2/3 of investors of funds are beaten by an index fund. And it doesn't matter whether it's all funds, all large cap funds, all mid cap funds, all small cap funds, multi-cap funds, global, international, even in emerging markets. 90% of active managers are beaten. And the reason that more are beaten in emerging markets, which are probably less efficient, is that the expenses of dealing with emerging markets and the problems of trying to do a lot of turnover and trading, because there are stamp taxes, there are a lot of taxes in emerging markets, even there indexing works even better. When you look at a very long period, and I will just tell the people who can't see the charts, what I've done here is taken a look at every mutual fund that existed in 1970. And in 1970, there were 358 mutual funds. That's every mutual fund that existed. And then I look at how they did up through 2009. And the first thing that people will notice who can see the chart is there were only 119 that are still around from the 358 that started. And all I can do is plot how the 119 did. So these data have what we call survivorship bias in them, because the 239 that didn't survive, I can assure you, had much worse records, because there's kind of a nasty secret in the mutual fund business. And that is the mutual funds are normally in big complexes, you know, the Fidelity Group, the American Funds Group. If you have in your complex a fund that hasn't done well, you normally kill the fund by merging it into a fund that had a better record. So that's why there's a lot of survivorship bias in this, but even with the survivorship, what it shows you is the distribution looks like the theoretical distribution, that most of it's on the negative side, and in fact you can count on the fingers of one hand the number of funds that started in 1970 that had beaten the market by 2 percentage points or more. It's not that it's not that there are no examples. You know, I sometimes say, you know, if I'd known Warren Buffett, it would have been Warren Buffett. I might have said in my book that was first published in 1973, buy Berkshire Hathaway, forget about index funds. And you know what? There will be some Warren Buffetts in the future. There may be several of them. But the problem is, I don't know who they are, and I'll bet you don't know who they are. And when you try to find them, you're much more likely to be on the negative side of the distribution. It's like looking for a needle in the haystack, and I guess what I'm saying is buy the low-cost haystack instead. Now, you always will see examples of, and the financial press loves to do that. These funds beat the index 10 times in a row. You see this all the time. So this, I didn't even do this chart. I picked it up from the Wall Street Journal a year ago. And it said there were 14 funds that had beaten the index for 9 consecutive years. And then how many actually beat the index the next year? And out of the 14, there was only 1 that beat the index. 13 of the 14 did worse than the index. What it shows you is you can't pick a fund by simply saying, this manager beat the index for a certain number of years. It doesn't work that way. The only thing, and I've done statistical work on this for years, the only thing that's reliably related to fund returns is the costs that they charge. In the bond market area, it's exactly the same thing. Bonds are very close to commodity products, and again, 2/3 or more of bond managers are beaten by bond index funds. Now, I don't say, and I don't even myself, simply have every bit of my money in index funds. But what I do suggest one does is what professional investors do more and more, and that is at least the core of one's portfolio. There's enough evidence that indexing works that at least the core of your portfolio ought to be in low-cost index funds. And then if you want to, buy an individual stock or take a flyer on buying a Cambodian stock, fine, you can do it with much less risk if the core of your portfolio is indexed. And this is what professional investors increasingly do. Pension funds, and even universities that do a lot of private investing, to the extent that they hold public stock, they will index the public part of it and then do the private stuff as active. So let me go back to diversification again. And this will be the last point that I will make, because I do want to leave some time for questions. I have suggested to you that what you want to do is to be broadly indexed. You don't want just one stock. And incidentally, even though you guys will all have positions in a great stock, Google, you don't want all of your money in Google, because bad things sometimes even happen to good companies. It's not, and your human capital is tied up in Google. And, remember what happened to the people who worked for Enron. Not that Google is anything like Enron, but, you can lose your, the company goes under, and you lose your livelihood, and you lose your 401k, or what happened to the people at General Motors. So, look, Google's a fine stock. I'm not saying you shouldn't own Google, but you don't want everything in Google, and you don't want everything in the United States. What we know about investing is that people have a home country bias. They have much too much of their money in their home country. For example, in France, France is 3% of the world's GDP. Institutional investors in France have 97% of their holdings in French securities. That's what we call the home country bias. The U.S. is only 40% of the world economy. The emerging markets are growing much faster than the developed markets. I know that the word China is a dirty word around here, but the growth of China has been absolutely unprecedented. China has grown after inflation over the last 20 years at growth rates between 9 and 10%. China has surpassed Japan this year as the world's second largest economy, and the Chinese yuan, or RMB, is a severely undervalued currency. So I want to argue for much more diversification. China is a very interesting story. China in the early 1800s had about a third of the world's GDP, and then all hell broke loose. They were beaten in 2 opium wars by the British. They were invaded by Japan in the 1900s. Japan wasn't thrown out till 1945. There was a damaging civil war. Then Mao came in, and the end of the Mao years was a so-called cultural revolution, where the universities were closed. Anybody with any knowledge was sent out to the countryside to be re-educated. And you ended up in 1980 with China maybe between 3 and 4% of the world's GDP. And then this remarkable man, Deng Xiaoping, came in, who was everything that Mao wasn't. Mao was an ideologue. Deng Xiaoping was an intensely practical person. He would say, I don't care if the cat is black or white, just as long as it catches mice. To be rich is glorious. I don't know whether stock markets are good or bad, but let's try them. And you ushered in this remarkable era of 30 years of unprecedented growth. China's never grown. No country in history has grown as fast as China. China is probably 12% of the world's GDP now, and according to IMF estimates, will be between 15 and 20% of the world's GDP by 2014. Now, one of the things that the reason I think China will grow is all the growth thus far has been in the eastern part of the country. The center and west are still dirt poor, and people are restless there. There's a lot of unrest in this area. The government wants to stay in power, And so government policy is we've got to keep this growth machine going. And China had a fiscal
Because what we
stimulus
saw
program.
in
They were the
the
first to get out of the worldwide recession. They had a fiscal stimulus that was much bigger than ours relative to GDP. And they've got the wherewithal to do it. We now have a debt to GDP ratio in the United States that's getting close to 100%. Europe's is close to 100%. We know what's happening in Greece right now because people are worried about buying Greek debt. Japan's is over 200% of the world's GDP. Debt to GDP is over 200%. China's is 20%. So they've got a very strong fiscal balance and tremendous human capital. The Chinese have revered education since the time of Confucius. They're hardworking, they're entrepreneurial, they have a gambling spirit, which is, I think, anybody who's going to be an entrepreneur has to be a bit of a gambler. It is a growth story that I am sure will continue. How would you access China? Well, the same kind of story that I have suggested before for U.S. Why not do it through index funds? Relatively low, they're not as low cost as U.S. index funds because it's more expensive to invest abroad. But there are exchange-traded funds. The most popular one is called FXI. It trades on the New York Stock Exchange. It's the FTSE Xinhua 25 Stock Index. It's like the Dow of Chinese stocks available in the international market. I think it's much too narrow. It's 50% financial. It's about 80% financial and oil and energy. Essentially no consumer, almost no technology. And so the newest ETF trades under the ticker symbol YAO, and I've been associated with this through a little company called Alpha Shares that I work with out here. YAO has 150 companies. It's much more diversified. It has some consumer stocks in it. The largest packaged noodle manufacturer, sneaker manufacturer. You know, we've got consumer stocks, we've got technology stocks. Baidu, for example, isn't in FXI and is in Yao. And Baidu has certainly been you talk about things with having correlations that are too high. Baidu certainly has had a good negative correlation with a stock that's in, I'm sure, all of your portfolios. We also have a small cap ETF. It's an index fund, but of smaller capitalization stocks, trades on the New York Stock Exchange under the ticker symbol HAO, low cost, relatively low cost. And the nice thing about the small cap is many of the larger cap companies in China are half owned by the government. So, you know, when the government owns half of your stock, you don't know that they're necessarily going to do something that's in the interest of the stockholders. How the small cap ETF has much more in terms of the more entrepreneurial and privately owned companies where the government doesn't own a share. And we would say that both of those are great. We've also got a technology ETF, and I would say for those of you who were wealthy enough to have a large amount of money that they want to diversify into China, we have even lower cost separately managed accounts with about a third of the expense ratio of the ETFs, which are also pretty low expense. So those were my prepared remarks. I think we have 15 or 20, by my watch, we have at least 15 minutes for questions, and I would be delighted to try to respond to questions. Oh, and if you would, in asking a question, if you could move to the microphone, then I won't have to repeat the question.
Hi.
Hi.
You talked about dollar cost averaging.
Yes.
In the context of like your regular savings. But in Random Walk, you were a little ambiguous about when you have a big chunk of money to invest, put it all in at once or spread it out to get dollar cost averaging. Is there a conclusion on that, or is it just, we don't know?
Well, the problem is that if you looked over history, the reason for the ambiguity is that when there is a long-term uptrend to the stock market, you can lose out by not putting your money in earlier rather than later. And that was the reason for the ambiguity. Frankly, I'm less ambiguous now because of some of the lessons that we learned from behavioral finance, and one of the lessons is this lesson of regret. The problem with putting it in, particularly as markets have become more volatile, which they have, when you put it in all at once, there is a chance that you're going to put it in at a period like January or even worse, March of 2000, and you have a terrible decade, terrible performance, and that regret can actually make some people say, my God, I don't want to be in the stock market at all. And I guess I'm less ambiguous now is it might not always be optimal in that I'm still, I'm still not, I didn't mean to suggest I was, negative about the United States. We've still got the most flexible economy in the world. We are still the people who basically invent Googles and invent iPads and iPhones and so forth. This is still a great, wonderful country and is going to be. But because the danger of the risk and the potential regret, if you do happen to get in at the high, and I've told you nobody knows when that is, and the reduction in volatility that you get, and the feeling that I and certainly some other people have is that we probably have a good bit more instability in our markets and volatility today than we probably thought. We probably should have realized that we had more volatility than we did, but we got fooled because things seemed so stable in the 80s and 90s. I think because of that, even though I understand it might not always be optimal, at least some of it I think ought to be dollar cost averaged, and I wouldn't put it all in at once.
Is there any guideline about how long to spread it out? Like 6 months or like 10 years, or depends on the amount of money? I would say right now, I probably wouldn't spread it out too long because it also depends upon what the alternative is. If you were in a period where short-term interest rates were 10%, I'd spread it out over a longer period because your alternative might have been to put it into a short-term instrument that paid 10%. The problem today is that the alternative is making zero. And so I can't tell you exactly what it would be, but I think I'd spread it out less now than I would if the alternatives were better. Thank you very much.
You bet.
I think I read your Random Walk book about 15 years ago, and I'm very happy that I did that because I've been sort of a buy and hold investor, all along. So that's a great thing. With respect to your presentation, I think while I completely, as I said, agree with the thrust of the presentation, there are a couple of I would say statistical numbers that presented I sort of disagree with. For example, this is an often repeated thing that if you miss the best 10 days of the past decade, then your return goes way down. The people who present that particular factoid never talks about what will happen if you could miss the 10 worst days of the past decade. Statistically, both are about the same. Another example is you presented a portfolio, how it would have grown over the last decade if your dollar cost averaged and bought and held, but it sort of masks the fact that you had $1,000 going in every month, which adds up to 120,000. So I think I see some biases in the presentation, is what I'm trying to say.
You are certainly correct that it is right that while you would have killed your return if you had missed the 10 best days, it's also true that your return wouldn't have been nearly as bad if you had missed the 10 worst days. But there, I think I come back to say you probably can't do either, and would go back to the graph showing that when you try to do it, you're more likely to be incorrect than correct. You're also right, and as a matter of fact, I'm going to redo the graph that I showed you. There's a bit of bias in the graph, which those of you in the other room didn't see, that shows, gee, you would have lost money but gone up from 100,000 to 250,000 by doing a little dollar cost averaging. You did put a bit more money in. You put $12,000 a year more into it. I'm going to redo that so you put exactly the same amount in, and it would reduce it a little bit, but the point is still right that you would have done a good deal more. But you're very perceptive. There was a small bias in it, but not a huge one.
So I have something of an abstract question here. In the ideal world where a majority or a plurality of individual investors follow your advice and hold most of their money in index funds, what are the consequences for corporate governance when you have a large class of investors holding on to voting stock, essentially just to get their share of the potential uplift instead of to be part of holding on a part of the company?
When you began that question, I thought you were going to say, what if everybody indexes? Would it then make indexing a non-optimal strategy? And, I often answer that when 90% of people index, I'm going to start to be worried about that. Mm-hmm. But in terms of the governance question, I think, it might even improve corporate governance for the following reason. Think of, say, Vanguard has active and passively managed funds. But when you think of a passively managed fund, it's often said that when an active manager doesn't like what corporate management is doing, they just sell the stock. The index fund can't do that. And I would think that it would make passive managers even better, more interested in corporate governance, more interested in voting their shares, more interested in writing letters to management, to look very carefully about things they're doing that the manager doesn't like, because the manager can't sell the stock. So my sense is that I think it might actually make things even better, because the active manager will say, listen, I'm not going to bother with that. I'm just going to sell the stock. The passive manager can't, and so the passive manager has to take the action. And my own experience as a board member in Vanguard is, over time, we spent more and more time worrying about proxy issues and actually taking a stand. So I think it's potentially an advantage of passive management, not a disadvantage.
Thank you.
Professor, I have two investment strategies I'd love to get your take on. The first one, if you look at Warren Buffett's top 10, stock holdings, a lot of them are dividend-based. In other words, he'll hold stocks and that pay out dividends regularly. And the second question was, I wonder what your thoughts were on the Vanguard REIT index fund for the States.
Okay, let me do the second question first. The Vanguard REIT, Real Estate Investment Trust. Real estate is, I think, potentially a very good asset class that isn't perfectly correlated with the others. Real estate has been a terrible place to be. Commercial real estate has been a terrible place to be. I think real estate, who knows if it's the bottom or not, but I think it's a very good diversifier. It's something I own in my own portfolio, and I definitely like. On Warren Buffett, I think one thing you must understand is that because of his size now, Warren Buffett can do things that really other people can't do. I mean, for example, when he put his money into Goldman Sachs, getting a 10% coupon on a preferred stock and scads of equity is something that wasn't available to other people. In fact, I wish the government, in its, quote, bailout of the financial institutions, could have used Warren Buffett's template to make a better deal with the institutions that the government put money into. But Warren Buffett has very often taken such large positions, and this gets back to the governance issue, that he can actually help in improving the management. In fact, one of the earliest wonderful investments he made was a failing company, the Washington Post, and Catherine Graham, when she heard that Buffett had bought 10%, said, oh my God, he's trying to take over the company and throw me out. He said, no, I did it as an investment. She then said to him, we're in real trouble, please help me. And Buffett went on the board, helped her get she was an editorial person, helped her get a good management in. So Buffett is almost closer to being a private equity person. And look, there's no question about it. Buffett's one of the smartest investment people there is. And, we know that now, and there will be other Buffetts. And as one of the satellite portfolios, if you think you've got another Buffett, I see no reason for doing it, but I wouldn't put everything in that because he is really a needle in the haystack. It's much easier to find the people who went downhill than to find the Warren Buffetts.
Yeah, thank you.
Hi, I have a question from the San Bruno office. Do you recommend that your 401k portfolio reflects the same investments as your other general portfolio? My financial advisor recommended that I do the exact same breakdown in both 401k and brokerage accounts.
Well, I think it really depends. And I think I would say the answer is no. And I'll tell you why. Because I just did have a chance to look at the options in the Google 401k. And for example, I have suggested to you that I think everybody ought to have some investments directly in China. And I'd probably make the same case for India, probably make the same case for Brazil. So to the extent that that is not directly in your 401k, I think you get nicely diversified with a lot of index funds in your 401k. And then I think for your individual investments, you might very well stray from that and use them as the kind of satellite portfolios where you do things like take a big or at least a significant position in a place like China, which tends to be underrepresented in general international index funds. And I might just tell you why. Index funds, international index funds, are so-called float adjusted. That is to say, the weight of the country depends upon the value of the floated shares. Now, what do I mean by floated shares? What I mean is that when the government owns half of a company, what the index fund uses as a weight is only the part that trades freely, not the part that's owned by the government. Another thing about China that's so peculiar, China has currency controls. And a lot of the Chinese equities are traded in local markets in Shanghai and Shenzhen, which are not available to international investors. They are not part of the float. So in international portfolios, China, which I suggested to you is 12 or 13% of the world's GDP now, is probably 1 or 1.5% of the index portfolios because of the peculiar nature of the Chinese markets and the still significant amount of government ownership. So I think you want to look at your indices, and when there are problems where particular countries or types of stocks get underweighted, that doing the adjustment in your personal portfolio makes sense. And so I don't think I think you want to look at the whole portfolio together, but I don't think that means you ought to do exactly the same thing in your personal portfolio that you do in your 401k portfolio.
Thank you.
Hello, thank you for coming. You actually just answered part of my question, which was, so, you know, like in an ideal world, we would allocate our index funds globally, probably following some GDP metric, where, you know, like if the US is 40% of the world's GDP, you know, like we would allocate 40% of the portfolio. But my question was ties into that. So how do we correct for what is the, let's call it a non-GDP measure, and it doesn't have to be a measure. I mean, like the fact that China is not really a democracy of a, you know, like a Western type democracy, or the fact that the United States is running a deficit that is worrisome to some. So how, you know, like what correction would you apply into the ideal formula, you know, like given some of the geopolitical things going on in some of these largest economies? Thank you.
I think that's a very difficult question, and I think different people will have to answer that differently. I would have to tell you that I think in a way there are political risks all over the world. I think there's a big political risk in Europe, where I am not sure that the Eurozone is sustainable. I've always been a kind of a skeptic of this. It can work in the United States because we have labor mobility. It can work in the United States because we have a way of compensating the losers. If there's a lot of unemployment in Appalachia, we will pay unemployment benefits. We will have wealth, we will have food stamps and so forth. That doesn't happen in Europe. There's no central government. So yes, there are political problems absolutely in China, but I would say that they are the same kinds of things all over the world. So I'm not sure exactly how you would make those adjustments, and I think probably, and you know, I think part of it also has to be, you know, how comfortable you feel about doing this. And You know, it may be that you don't feel that comfortable realizing that the U.S. is only 40% of the world's GDP. You might want 60% in the U.S., although I think there are certainly political, you know, I'm not sure that the political stability in our tax structure, I mean, there's a lot of worries in the United States. We've made promises that, given our current tax structure, we can't keep. And I think we've got, you know, we haven't come to terms with a lot of this. So I think there are risks all over the world. We'd probably all answer it differently. And I'm not necessarily suggesting to you that you have to take my template of saying the U.S. is 40%, only have 40% in the U.S. But I do suggest that you think the U.S. is 40% of the world's GDP, and maybe if I look at my 401k, it's 100% in the U.S., that probably one ought to at least think that we ought to move in the direction of more of it going overseas, despite the fact that, as you say, there are certainly problems. But I do think if we looked honestly at what we had, we'd have to say that for all of the problems, there is this home country bias, and we probably ought to look carefully and ask whether we really are diversified enough.
Just out of curiosity, I was wondering if you had, say, $1 million in cash, how would you invest that? And if you can't name the specific percentages, maybe just some index funds that you would suggest.
Well, I think, again, it would depend in part on one's age. Let's say that you are talking about somebody who is getting close to retirement. I think I would use one of the target funds targeted to the year at which one was planning to retire for a significant part of it. If I was in my 20s, my sense would be where my biggest asset are the earnings that I have throughout my lifetime, I would probably think in terms of my investments of being far more aggressive. I'd have more equities than bonds. I would tend to be more international despite some of the risks than less international. And it also depends upon my temperament. Because if it's one thing I know, I've become the informal advisor to a number of the widows of faculty members at Princeton. And I really do understand how emotions and one's capacity to take risk is important. There was one widow, she was only 50 years old. Her husband died very young. And she was just so nervous, and we were trying to think of what's an optimal mix of stocks and bonds. And, you know, normally for someone who is 50, you would think that at least half in stocks, maybe more, would be appropriate. But she was just so terribly nervous. We agreed on 1/3 stocks and 2/3 bonds, and it's now the beginning of last year. All hell is breaking loose, and she comes into my office in absolute tears. I can't take it anymore. I have to sell all my stocks. Now, if I were just coldly thinking of the right thing to do, I'd say, hey, this is the time to rebalance, put more into the stock market. All I could do is keep her from selling her stocks. And so that's a factor as well. One's temperament is certainly a factor. You know, the old line was, J.P. Morgan was asked by a friend, the friend said, hey, look, what should I do? The stock market's going up and down. I can't take it anymore. I can't sleep at night. What should I do? And J.P. Morgan said, well, sell down to the sleeping point. So, you know, it really is partly, you know, and this is partly an emotional thing. So I think all of those are factors, and I can't just give you one answer, but I think giving you some idea of the direction in which I would put things. One more question. The hook is coming.
Thank you. In your book, you talk a lot about saving as well as investing, and I'm wondering if you could give some guidance as to what would be good targets to save, maybe at different ages and percentages.
Yeah, I think for most people, I would just say more. I mean, I don't think preaching to you guys I have to do, because I had learned at lunch that you now have a 401k where 99% of the people are in. Where I really have to do the saving preaching is so many people in so many companies are not part of their 401k, and they save absolutely nothing. And some people don't even join the company 401k when up to the match of the company. So I'm not sure that with your 401k that you have here, that this is something where you all are doing something that's wrong. But I think in general, I would say this. I don't think you have to save quite as much if you start early, because you've got that compounding effect. And where I think you really need to save, which could be 15 or 20% or even more of your income, are those people who did no saving at all when they were young, and they're now looking at retiring in 15 years, and those folks have to save a very high percentage. So I'd say, again, I don't want to give a particular number, but you know, less if you're young, more if you're older, and also to think, and you know, people I think don't do this, of maybe every once in a while, even if you don't keep a budget, to look at what did I spend money on last month, and ask yourself, do I really have a lot of stuff that really didn't give me much satisfaction? Did I need all of that stuff? Remembering that the opportunity cost of not saving when you're in your 20s, the opportunity cost of not saving $1 might be $10, $15, $20 in your 50s and 60s. So the opportunity cost is higher when you're younger, and you ought to at least think of those kinds of things. But I think you guys are generally okay.
Thank you.
Okay, thank you all very, very much.
No. Do you remember that saying, the boy ain't right? Yes, I do.
All right. So, anywho.
The traders and their roommates.
Bonds down 25 ticks.
The boy ain't right, Tony.
The boy ain't right. Not anymore, TP. Okay. Down 20 now.
What?
You said the bond's down 25 ticks. Bond's down 20.
All right, hold on. Let me pull this up. Let's do it. S&P's up 75 cents. The NASDAQ futures down 6. Apple's actually down 80 cents. I think that was a pretty good call in there this morning, thinking it wouldn't hold that little bounce. And TP?
Hello.
Hold it. What's the color you're not supposed to wear? Linda?
Purple.
Purple.
Purple is the color I don't like. What's the color you're not supposed to wear?
Green and white.
Green, monkey.
Why? Oh, the green screen or something?
Yeah, something like that. I don't know the reason.
All right, AV. All right, AV master.
Yeah, we don't use
the AV club guy.
TP, I think you look very handsome in green, and so does our audience. And I know Jenny's particularly fond of green. You'll be on her show today, right?
Yeah, I am. What's he? Why is he talking like this?
I don't know. I don't know. All right, are we ready?
Sit up straight. Fly straight.
Yeah, let's do it. Linda,
big
first
show.
page, please. We got now. TP, I gave extra time for the segment today. Just so you know.
because this is kind of what you've been talking about for the past couple of weeks is a discussion about the randomness of stock returns and whether or not there's any predictive value in anything at all. What do you want to lead off? Do you want to summarize what your thoughts are about the price movements of stocks or indices?
I actually just want to say that you and I have been on the same page for this. Tom and I don't agree on a lot of stuff in the world.
Most things. Cultural.
I shouldn't even say that. You know what? The scary thing is,
you guys agree on more crap than you think you do.
You're right.
No,
and I'm just thinking about that. We just don't like each other that much. So we act like we don't agree. We actually do agree on more than you think. But
you do.
It's more fun to be able to pick fights with them.
But
it is fun fighting with them.
But that said, there's one thing we've always agreed on. And that is that the stock market is a numbers game. The stock market that the edge that we have as traders, and the reason I can tell you right now, the reason I've been successful doing this for 30 years is because everybody else thinks they know what they're doing. Mm-hmm. If there wasn't somebody that thought they knew what they were doing, then I wouldn't have been able to make any money.
That they have some piece of information or some way of looking at things that's so wildly different than what everybody else has done that's the secret. They've unlocked the secret of the universe. That's kind of what it is.
So that the American public is the American public because,
it's the American public.
It's the American public, right?
So now what what we say is that you really can't, there's no reliable way to pick direction, whether it's longer term swing trade. I mean, we take bets, we make bets based on pot odds, volatility, things like that. But really, what the more important thing is that we have an expected range that we obey. Now, one of the things, this is a very shorthand version of this discussion. People can go and get books and encyclopedias on this stuff. We don't want to do that. But basically, if you look at that top formula there, potential stock return equals mu, which is an average, minus sigma squared divided by 2. All that really means...
Sigma?
Sigma. It took me 4 hours to get those little symbols on there. Anyway, what that means is that if you just take any stock, chances are it's going to grind up according to, let's say, the risk-free rate. Mu is a risk-free rate. It's all you really think about, because the rationale is if I said you could earn 2% risk-free, why would you ever accept any place to put your money that earned you a risky 1%? You just wouldn't. So there has to be some sort of, the stocks have to have some sort of risk-free rate built into that provides an upward bias. But that minus sigma squared over 2.
Just for 1 second, which is why the markets go up if you just count a pure number of days, there is an upward bias built into pricing. When you look at the pricing, the future price of S&Ps and things like that, there's an upward bias. It used to be about 7%. I don't know what it is. A
little lower now.
Right.
But the point is, and with interest rates at 1.5%, 2%, or whatever they are, broker call, that's not really as nearly big as that minus sigma squared divided by 2. Okay. All this really means is the sigma squared is the variance of percentage returns. Okay. So you've got this upward bias of interest rates. That's all it really is. And then you've got this volatility component that really says we don't know where it could be up, could be down, Could be up if sigma is big, could be up or down a lot. If sigma is small, could be up or down a small amount. This concept underlies, you'll see a variation of that little formula, that little bit, that piece there. In most of the option pricing formulas, in most of the Greek formulas, in the probability calculations, all that stuff relies on that mu minus sigma squared divided by 2. And then the variance of that is just sigma times the square root of t. Won't get into that right now. But what that says is the efficient market, that all this information is packed, everything you know, everything Tony knows, everything I know is already built into a stock price. And that is even reflected in option prices, all the potential price movements that we're arguing. You think something's going to move big. I think something's going to move small. You're buying up the strangles. I'm shorting the strangles. And that price all evens out. Okay? That's what an efficient market is. There's nothing bounding. Nothing says, well, Tom, you know, you're bearish on volatility. We're not going to let the VIX go to 25. Okay? There's nothing that says that. But that.
So how did this cup get here? I'm sorry, nothing.
Yeah, it's like so. But the point is that on any given day, a stock might be up or down. And this is not completely random. Completely random would be IBM's 200.
Yeah,
and now it's 3.
Right.
No, it doesn't work that way. It starts at 200, goes up a little bit, down a little bit, up a little bit, down a little bit. Okay, so who cares? Okay. Right? Big deal. I can get this from any book.
But you understand that this takes all the fun and the excitement out of this. Kind of takes all the fun out of everything.
Well, unfortunately,
but so
it's kind of deflating.
Okay, so is it the chicken and the egg thing where if you take all the fun out of it because you actually give because you believe in this kind of the random walk
sort of
that takes the whole all the stuff that gets sold to
Facebook.
I'm talking about that. I'm taking all
Hewlett Packard,
all the stuff that gets sold to individual investors throughout the years to give them an edge is essentially rendered worthless.
Oh boy.
Let's move on to the next slide, because this in and of itself doesn't really mean. Well, this isn't a strategy.
I understand.
Okay.
The strategy piece is where the value is. Let's go to
now. Let's go to this next one.
Okay.
So what I did, and as I said, I'm curious, because I don't want to test random walk. I mean, how do you do that?
No, you don't. Right.
You don't test it. So what I said was, do the models basically conform with what I see in actual price behavior? So all I did, and this is not some sort of grand test for all the markets, I did what was convenient for me given the time I had. I used the 30 Dow stocks. Why the 30 Dow? It's a universe of 30 stocks. Fine. They have liquid options, okay? They're known stocks. So that was a place for me to start. All I did was I looked at the last years of data. May 1st, 2011 to May 1st, 2012. Who cares? It's just a chunk of time, right?
Yeah.
Then what I said was I went back on every May 1st, June 1st, July 1st. What was the volatility on that day?
Okay.
And then out 30 days, what was the expected range of Alcoa, Bank America, Caterpillar, ExxonMobil? Then, theoretically, the stock, starting on May 1st and then now leaping forward to June 1st, the stock should land in there 68% of the time. I didn't care about options expiration. I didn't care about earnings, dividends. I just said, where does it land?
You didn't care about the news?
What news? What, I'm supposed to read the newspaper for the past year? No,
news. You didn't care about news. What if there was an abandoned baby?
No, I didn't care about what level of volatility was, because volatility went up, it went down. If you remember, volatility is bouncing up and down for a lot of these stocks. I didn't care.
What if we were oversold?
It doesn't matter. Okay.
What if the stochastics were pinned?
What? What's a stochastic? Stochastic means a random process. You're saying the random processes were pinned?
I'm throwing these. Go ahead.
I know.
He just uses big words. He doesn't know what they mean.
I know. So let's move on to the next. So what are the results of this slide? The results of this test, and this is, you can pick this, well, TP, really, I would have used a different this and that. Fine, whatever. All I did was use my simple models, the models we talk about, the expected range.
It doesn't matter. I understand.
Alcoa, it landed in there 67% of the time, right on the number, okay? In other words, a few times, 4 times it was outside the range as expected, 9 times it was in, or 8 times it was in the range as expected. American Express landed more times. Bank America, or Boeing, landed more times. Bank America, the big failure, very volatile stock last year, was outside that range.
Worst performing stock on the Dow.
Worst performing stock. The ExxonMobil, 100% of the time landed there. Average was 81%, okay? Average, if you just said, of these 30 stocks...
Well, the market didn't go anywhere last year. Remember, the market closed unchanged.
That's the whole point. So what this is in 2011 and 2012, this is not any sort of like grand, this is the way the world works. What this says is that 81% of the time, that in these 30 stocks, they landed in their range as predicted by the volatility, okay? So volatility was, whatever it was, 20%, it calculated a range. Did it land in there, yes or no? 81% of the time of those 30 Dow stocks, it did. Okay? Now, what I don't want people to do is say, oh, well, you mean ExxonMobil lands in its range all the time. In 2011, 2012, it did. That doesn't mean you go short strangles in here. That's the whole point. This is not a trading strategy. This is just a world view, sort of. Okay?
Okay, perfect. So, but there has to be a takeaway from this.
As we go to the next slide.
Okay.
Okay. What I see...
Listen, the man's prepared today, okay?
Unlike most days.
Unlike most days,
Tom's
right.
Tom's catching it. He's getting a hedge. Here's my point.
By the way, be prepared June 8th. You got to fill in for our fearless leader over here.
Oh, June 8th, he's gone again?
Yeah, he's, his whirlwind tour he's going on.
He's a piece of work. So the point is...
Another vacation day.
All this does, and here's what the central part is. Don't read more into the data, any data, whether it's volatility data, random walk testing, price data, chart data, news data. Don't read anything more into that than is out there. The only thing you can rely on is a price. That's all it is. What's Hewlett-Packard now? $22. Doesn't matter what you think about Hewlett-Packard. Doesn't matter if you like it or hate it. All that matters is $22 right now. That's it. So the point is that when I see that 81% of the time that the stocks landed in a range where they were expected to land in there 68% of the time, then volatility overstated those potential moves. In other words, it overpredicted the range, okay? So volatility was a little bit too high in there. Now, you can say, well, Tom, the reason that happens is that the model is imperfect, returns aren't actually normally distributed, there's more of a jump diffusion, yada, 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 wider tails, narrow peaks. I've seen that.
Okay.
I get that.
Hold on for a second. Before you finish this up, we have to tell why we're doing this. It has to, because we've spent a long time, 9 months now, on the air. There's a reason that individual investors lose 80% of the time, and that professionals win 80% of the time. And effectively, based on what you said here, this gets closer to that coin toss, okay?
Exactly.
So if you're flipping a coin hundreds of millions of times, which is essentially what this is, how can one group lose 80% of the time and one group win 80% of the time consistently? That's first question. Second question is, why do we continue to follow two sets of information in this business? One, which I will call random, noise-filled news, which clearly does not lead you to a better result. And the second thing is, when there's no statistical evidence to prove one bit that there's one system out there that can outperform this, and I challenge anybody you want. Go find.
We have a contributor who's going to maybe in June have something different.
We don't. We have somebody that's going to. We can line up people for. We could go from here to the Board of Trade in Chicago with people that can tell you that they can outperform, but there's not one statistical shred of evidence that can confirm that with $1 placed on the line.
Look, if I could figure this, honestly, if I can figure it, anybody can figure it out. But the math on this isn't particularly difficult. Okay,
I'm not saying.
But here's my point. Here's my point.
What?
Is that you can deconstruct these models,
of course,
to give it a different. It's not 50-50. You can say, I think there's a 51% 51% of the time it's going up, 49 down. You can kind of come up with probabilities based on that too. It's not that hard to do. Until they can say there's an X% probability of this event happening, I don't care. Your bias of whether bonds are going up or down doesn't matter until you can actually put a probability on an event. My point is, you got to think like a casino. What you guys have been doing over and over again for the past year is when a trader puts out many small individual bets over and over and over and over, many little samples over this whole universe of events, those numbers work out. Now, here's why. Why do 80% of people lose money? Because no one has told this story yet. Or if they have, it's been buried in a book that's 500 pages.
Why has no one told this story publicly? Why has no one ever been out there
because
talking about the story?
Traders who make money using this approach don't write books. They don't do TV shows. Okay, that's what it is. Okay, so all this content.
So why do we?
Because all I sit there is I trade. Could I write a book? No. I mean, I can barely put 2 sentences. This about is the limit of what I can write.
Write a nice magazine
with a lot of help. But my point is that the story for I've got a secret. I've got the key to the universe. I've got, if you just watch this indicator or whatever, that's been the easy story. That's been the appealing story. This. Well, it's mu minus sigma squared divided by 2, yada, yada, yada. Vol is overstated.
Hey, sex sells. Okay.
You got to make this sexy.
This is not sexy. Let me tell you, this is a true story, quick story. 1980, I'm working for Drexel Burnham in New York City. I have 3 guys that sit next to me, really nice guys. I thought they were like a lot older. They're probably like late 20s. I was early 20s. They're technicians. I had never met a technician before. They did everything by hand. I thought these were the most brilliant guys I ever met. They said, you come to Chicago and you trade for us. You do what we tell you to do, and you can also trade for yourself. And then
just do what we tell you to do, monkey.
No, for us, do what we tell you to do for yourself. You can trade, and we'll pay for the whole thing. That's how I originally got here. When I got to the floor, one of their friends was a trader on the floor that they had gone to law school with or something. He had a law degree. He decided he didn't want to practice law, and he decided he would go hang out at the track. But he realized that the track, because his mind wasn't all there, and he still trades today.
The boy wasn't right.
The boy wasn't right, but he still owns a prop group at the Seaboat now, and I won't mention names. And so he hanging out at the track, and he says, you know what? I wasn't into hanging out the track. I just didn't like the odds. So I came to Chicago to trade. So he's telling me, and I said, well, I got these 3 guys in New York. And he goes, I know those guys. Sure, we were friends. We went to school together, whatever. He goes, and I'm going to do what they tell me to do, and then I'm also going to be able to trade. He goes, let me tell you something right now. Okay? This is my first day in Chicago. I wasn't even a member yet. I was just checking out to see if I wanted to live here. He looks at me and said, listen, whatever they tell you, and he goes, I like those guys. Whatever they tell you, doesn't mean crap. Just do the opposite. He goes, you want to make some money? Just do the opposite of whatever they do. Now, they were out of business 3 months after I moved to Chicago. I've told the story lots. They blew out 3 months later. But the first time I met this guy, and he was friends with them, and he told me something that he clearly knew that I didn't understand at the time, which is whatever they tell you, just do the opposite.
Those are words we've used 100 times to people.
Now, fast forward 10 years in my career, I'm friends with a guy that ultimately, I think one of the best traders in the world. And I'm in his office, and we're talking about some rates for something. You know, it's a clearing firm thing. We're talking about some rates on a trade, something like that. I tell him, you know what? I think the stocks can explode. And he looks at me, and I'm telling you, one of the greatest traders I ever met. He looks at me and goes, what the F do I care what you think this stock's going to do?
Right.
Okay. And that's so doesn't my opinion mean anything? He goes, if I had the time, I would just sell everything you're about to say. Like, he didn't even care. He just cared the fact that I was opinionated, that he just wanted to fade me.
Yeah.
So it didn't even matter. Like, whatever I said, he would have done the opposite. He never would have listened to one word, but he didn't even care about one word I was going to say. Fast forward now another 10 years. Now I build Thinkorswim. And I go out there, and for the first time, I meet retail customers. Now, my mind has already been, by 20 years, mushed by all this contrarian theory. Now I'm starting to meet customers, and the first thing they're telling me, my phone would ring every day, multiple times, and say, Tom, I built this thing. I got this study. It's better than anything anybody's ever done. It's an Ikimoto. It's a Ichimoto chart. It's a Ichimoto cloud. There's 50,000 things. I don't even care what it is. It could be I've got this group that's the most amazing. And every single person, I said, listen, if you have customers and you're engaging them, I'm interested in talking to you. I have no interest in whatever your thing is, I couldn't care less. Because no, it's not like everybody else's. Mine's better. I'm like, there's no statistical evidence that yours can ever even get to 50-50. Okay? And I've seen people spend hundreds, starting at millions to tens of millions to hundreds of millions.
Sure,
and
chasing the Holy Grail.
And it all comes back to the group that makes 80%. And I don't want to ruin the whole world. I don't want to take all the sex appeal out of, this study or this abandoned baby or this cycle or all this stuff. But in the end, okay, if it helps us to build assumptions and helps us to be consistent, that's cool. But in the end, thinking that it's going to help us to make money, that's not what it's about. And if you want to be successful, we're telling, is it a secret? I don't know if it's a secret.
No, this is not a secret.
I don't mean that. I mean in the sense that we're finally breaking this open.
Words.
Well, but think about this. How is CNBC worth $2 billion when nothing on there is of value except engagement?
Well, because engagement is valuable.
That's it.
Engagement is valuable.
But it doesn't make people money.
Those are two questions. Those are two questions. And I tell you what, most of these people who come up with the super duper studies mistakenly believe that they're going to make money trading. They don't understand that their value is engagement.
Exactly. Okay.
That's what it is.
So I always said to people, hey, listen, I'll give you X amount of money to be my marketing partner because I think you add value to this business because you can engage people. I don't think what you do means it. And the answer was always inevitably, listen, Tom, appreciate your support, and I'm going to prove you wrong.
Right.
And of course,
with trading, rather than saying I'm going to get 2 million customers,
they never proved me wrong with trading.
That's exactly right.
The trading piece to it, which is why we trade live on the show, is because the only way you can actually prove something is by doing it. We do it. Okay. And I know this is we need to do this every single day forever. But think about this.
Well, that's what we're doing anyway.
Think about this, TP. If you told this to some 20-something, they could believe this because they don't have some preconceived notion in their head. They don't have an idea that there's something else out there.
What this is, it's a little like this constant wind. This is a fact of the markets, okay? And if you want to it's like Mount Everest is pointed uphill. I can not want to climb uphill. I can want to ski downhill. But the point is, I always have to go up this hill. Unless I'm prepared to go up this hill, then I'm not going to climb Mount Everest. This governs all of your investments, all your trades, all your money, that it is this constant push, okay, this random behavior. Unless you understand it and incorporate it into your own strategies, then you're missing out on it's that mu minus sigma squared. The elephant in that formula is that sigma squared divided by 2.
So years. Go back to the first slide, will you please, Linda?
The elephant in the room.
So years of.
Is that what I said?
I think so.
Yeah. So years of value line.
I'm a poet.
You're good.
Years of value line, Zacks Research, Morningstar, S&P Research.
My first job,
all these research companies, it's all just engagement.
I was a cold caller for a brokerage firm in Philadelphia. So what I thought, because I thought I was, I'm
That was
smart.
you?
Yeah, it was. Hi, Mr. Batista. Would you like to buy some
sure,
was it blah blah blah? Point is, what I would look for is those little tear sheets, those little books of those information, all the financial. I thought there was information in there. I thought there was something value. I couldn't make heads or tails out of any of it. And I would watch the stocks go up and down and say, well, it doesn't make any sense at all. Why don't they all read this book, right? Go to business school. Well, it's the decision. It's a decision. It's a business that the CEO decides, the company does, that changes value. And when I was sitting there listening to the dean of the business school up there talking about this, IBM, this was back in like 1992 or 93. IBM had just sold off like some large percent. So me being a punk raised his hand and said, what business line, what decision did IBM make, that the CEO make in the past 2 weeks to push the stock price down? Dead silence. He couldn't answer that. So the point is, it's not news. There's nothing that, it's all this random behavior that governs the price of stocks and other assets.
And so let's take it a step further, because I almost want to be violent about this. Because the only way that we're going to change this whole industry, change the world, whatever it is if we almost get to be violent. because we have to.
You're not going to be hitting your kid downstairs.
No, but the message doesn't.
No, it doesn't connect. It doesn't. And I'm not saying that what I wrote up here is going to, oh, well, Tom Preston finally explained. No, this is a small attempt to explain it to our viewers, to you guys, that sort of thing. It's not sexy. It's not fun. If we can make this fun and the logical choice for young people to manage their money and trade until the day they die, from when they get their first job at 18 or 22 or however they're old, till the day they die, then that will win. Then the America, the market's going to be smarter for it and better for it and more efficient for it. So it's, it's just banging on the drum. It's the drum beat. Drum beat.
We've been kind of trying to say something along this without stepping on the toes of everybody in the industry, but I kind of got to the point after doing this now for 9 months and just watching where the resistance is, that we have to be much more aggressive about the message, and it means we're going to lose some friends along the way.
It won't be the first time.
It won't be the first time.
I don't have any friends anyway. So.
But I can't.
That's the reason why I have 2 dogs.
I've tried to play nice guy. I've been in now for 10 years playing nice guy. I think it's really worked to be nice about it. It's because we focus just on the strategies, but there has to be this component. Now that doesn't mean that all technical analysis is because it's all engagement. It doesn't mean the books and the media and everything else, it's all bad. It's not bad because we need engagement. But when you get public offerings like a Facebook, you can get as much engagement in the marketplace out of a Facebook IPO than you can get out of a year's worth of Bloomberg TV.
Because what I would love is for the person who bought that one share of Facebook, saved up all their money, bought it at the opening price, and now they're down $6 on it, and then getting them shaken up like that, I want their next trade to be based on that. That's the whole point. You're engaged. You didn't like the way that worked? Let me show you. Okay, do the opposite. Okay? We have to metaphorically tell the American public, those 80%, to do the opposite. You bought the share in the opening price? Forget it.
Hey,
that's not the way to play. That's the way to play.
Have you ever been to Las Vegas before?
In slightly different venues than you may have frequented.
I just want to know if you've ever been to Las Vegas and you've gambled before.
Yes,
Say yes. Okay.
Well, the next time you go to McCarran Airport, we're advertising.
Okay.
I know.
That's not where I was going.
I know.
The first time you went to Vegas and you sat down at a table and you didn't win.
I had no idea.
You didn't go, oh my God, I'm suing you.
That's right.
Because you told me that this was the place where I was supposed to have fun and make money. I just lost money and I didn't have fun.
My $5 blackjack play.
I'm suing your ass.
Lost. Well, that didn't work.
The first time you gambled, probably Atlantic City, right?
That was Atlantic City.
Same with me.
The weekend it opened.
When kids our age now, they get on their friend's private jet and they go to some casino.
Sounds like a rant.
Well, no, they go to like Foxwoods or something.
Whatever it is, or they'll hop on a plane. Yo, Dad, I'm going to. I'm hopping on a plane
to go to Vegas. Love to be there for dinner, Dad. But
I don't think we ever got on a plane. Okay, so we would drive, 8 people in a little car all the way down to Atlantic City, and when I lost, came with my, worked my butt off to make $100, whatever it is, and we couldn't even ask our parents for a penny to go. Of course not. So I go down to Vegas. I go to Atlantic City and sit down. And if I lost, the first thing I did is I didn't really go back to the casino and say, you know what? I'm suing your ass. Okay, because this was supposed to be fun, and I didn't have any fun.
Of course not.
Exactly. I got engaged. I'm like, I want to beat this casino, but then I realized it took me 15 years. But I realized 15 years later, I can't beat you. Okay, so I might as well just enjoy the time I'm here. The markets didn't take me that long. Markets maybe a year. 2 years,
because you learn in dog years. When you're trading, you learn in dog years. Every expiration is you
don't last,
or you don't last. You survive, and we all know the stories. Is most of the traders that try it don't work out.
But we didn't have the technology. We didn't have the education.
It wasn't nearly as formal,
and it wasn't as efficient.
Easy.
It's even if the more efficient it gets, the more relative it is.
Some of the things we were doing when we were trading.
I understand
that. But the point is the liquidity, the technological efficiency, and the liquidity in the markets are better than they ever have been. This is, and I hate to sound like such, this is a unique opportunity. This is the best time for retail investor, for a person who has never done anything with his or her money before, this is the perfect time to start. The technology has been commoditized. You could argue 10 years ago when we started Thinkorswim, well, it was kind of a boutique, didn't have a lot of reach. Now, a lot of the best tools are on multiple platforms among the biggest brokers. You can get the best tools. Internet streaming data is free. Okay, I can press the button, get an execution or a can fill in milliseconds. Tight markets, there are 60, 70 different products where the options are trading in penny-wide increments. It's the best that it's ever been.
Okay, everybody gets that.
Everybody gets that.
Everybody gets that.
You should be. This is the way to do it.
The hurdle for everybody, TP, is they accept the fact that technology is good. They accept the fact that the education is better. They understand that most of the rates and everything else has been commoditized. What they still can't get their arms around is how to make money. Because in the end, you still have this 80-20 breakdown. It's not. We're not improving on that 80-20 breakdown. We're not.
Well,
we're not making a difference.
It's kind of pessimistic.
Okay. No. But we're going to get there. We're not breaking down those numbers yet.
Do we have a replacement for him? Can we get somebody a little bit more happy?
I am happy.
This is happy.
I am happy.
This is happy. You should have seen yesterday. Yesterday was unhappy. This is happy.
I'm happy.
I saw the show.
This is happy.
I'm happy. I just want to change those numbers. I want to get
Of course.
I want to get it so, Tony, we can say, hey, you know what? When we started this show, 80% of the individual investors lost and 20% made money. Now, of course, those numbers get skewed a little bit in a bull market, whatever it is. But I want, in a flat market, I want that number to be 75% lose money and 25% win. Then you know what we've done? Then we've turned on millions of people.
Moved the needle.
We moved the needle.
Moved the needle.
That's millions of people.
You're 100% correct.
Now, how do we do that? We start
with one.
We start with one.
That's right.
We've been working hard with Tony.
Well, you're a great example.
Oh my God!
Because it's like taking a rescue dog.
Well, Mortimer,
it's like I'm telling you, it's like
you win, Mortimer.
I don't know what
$1.
I don't know what I did with the 20 years before you two monkeys.
It's just like, you know how some people go, like they'll say, I'll go, that's a cute dog. They'll be like, it's a rescue dog. I didn't ask you if it was a rescue dog. Okay, I'm sorry, my dog was a pedigree.
It's morally superior. Like, I have 3 rescue dogs.
Okay, like
I am morally superior.
He said that to me. She goes, I have 3 rescue dogs. I'm like, I didn't ask you if you had a rescue dog.
I have 3 rescue dogs.
Okay, it's a nice dog. Okay, it's a rescue dog. Okay, I don't care about that.
I rescued 2. My dogs are 2 rescue dogs. I rescued them from the other home they were living in.
My dogs were show dogs, and I'm proud of it.
Yeah.
So, but we rescued you.
Did you have to get your dog neutered because it was a show dog, so it wouldn't compete against the other dogs?
Wouldn't
I had a woman tell me that. I had a golden retriever I bought, and
it wouldn't give anybody else an unfair advantage.
You will neuter him. I'm like, you're kidding, right?
My dog, I had to sign for my bloodhound. No, they didn't care. Those dogs they give those dogs away. But for my bloodhound, they were like, we'll give you the dog and a year's supply of food for, what do you think, $25? That was
sound reasonable? I'll take 15. But 25 really helps us out.
But my dog de Bordeaux, I had to sign a contract. That's my French Mastiff. I had to sign a contract because he was a show dog that I would get him
neutered.
Yes,
and you would never show him. I had to do that with a golden I had. The golden you had, Goose.
Once you get him, once they're neutered, they can't be.
Right. Well, I would promise never to show him and get him neutered. That's right.
Goose was a cool dog, but he wasn't a show dog.
Goose was a show dog.
I don't care.
He was a show dog.
Okay, whatever you say.
How could you say on there? What's the name of that dog? What is it again? Shoopy doopy jiboos. What did you say?
I know I wasn't going to go there with him.
My dog de Bordeaux.
My dog de Bordeaux.
From the Bordeaux.
He's the dog.
Like a little croissant.
Listen, when you're,
I've got my beret. I've got.
He's so
dog.
Samson could eat that.
Have you seen the movie?
Samson could eat that.
Have you seen the movie Turn and Hooch?
He could. Thomas, we're back, my friend. Trend trading and equities.
8:45, Tuesday, June 11th. Market down, bat. We're going to have some fun. You ready to blow the world into little tiny pieces? And I don't mean that literally. You ready to blow up the whole financial industry?
Yeah, you go.
The financial world. You ready to blow it up?
Yes, sir.
Have some fun. Just make it something different. let's call this table talk conversation for water cooler conversation that can go lots of different places. Fire up, Linda. Let's give all the firms time so they can grasp this. On Monday,
Do the screen captures.
On Monday, yesterday, we showed how perfectly the last 63 plus years of market movement fit into a log normal distribution, proving the case, at least in our eyes, okay, maybe not every economist, but proving the case in our eyes that market movement is consistent with Brownian motion. We are not going to rewrite the rules, change the script, okay? And we're going to keep this incredibly clean. Let's go to the next one. This could raise the argument that Brownian motion may hold true for the overall market, but not for individual equities. Because you know what? It's easy in the S&P 500. There's diversification there. You know what? Everything is going to normalize. But you can't get that same normalization in different equities. Certainly not for commodities, and definitely not for currencies. The yen's up 200 ticks today. The thing is blah, blah, blah. You know, we're all over the place. Today, we're going to address the issues: individual equities, currencies, and commodities. You know what? We went back 63 years in stocks, but we don't have 63 years with individual stocks. For example, Apple only came out in 1980 something. You know, Priceline's only, 20 years old. There are different currencies and commodities we weren't even trading 50 years ago. Let's look at the issue. Let's go to the next slide. So we looked at available historical data on a variety of stocks, commodities, and currencies. We were looking to determine whether or not the individual products trended in a predictable manner. Now, remember, the beautiful things about predictable manners are that there are no, quote, variables. Everything's fixed in the option pricing models that we look at. So when we apply a strategy to something, we're not picking some arbitrary numbers. We're not plugging and playing something to make it fit our own agenda. Okay, correct. We're not backfitting it into what we want to see happen. Let's go to the next slide. So if the individual security was up or down the day before, we asked the question, does that have any bearing on what will happen today? Yesterday, the yen was down 133 pips. Why did we buy it? Okay, it's because we don't believe it has any bearing on what will happen today. If this were true, we would expect to see abnormalities in the distribution curve. Okay, so if what happened yesterday has any bearing on what happened today, we would expect to see abnormalities in the distribution curve. Let's go to the next slide. So we counted the number of occurrences of consecutive up days and consecutive down days. We then plotted these occurrences on a graph to better understand their distribution. We looked at individual stocks that we chose at random. They just had to be liquid, in-play stocks that you'd recognize, okay? Let's take a quick look.
Just got filled on my Pandora puts at 55 cents.
Now that's cool. We sold those puts in Pandora yesterday? Or the day before yesterday?
The day before.
And we bought them back today. I like it. We sold them at $1 and bought them back at 55 cents.
That's correct. And sold them on the 5th.
That took a whole day. Mm-hmm. Okay, here's Apple. Consecutive ups and downs. Okay, now anybody that wants to tell me that, because Apple is not a stock, first thing you'd say about Apple is, if I said to you, blind taste test, does Apple trend? You say, oh my God, it's the most trending stock I've ever seen. Went from 400 to 700, back to 400. It's a total trending stock. Really? Well, consecutive up days and down days, 1,798 to 1,799. Is that unbelievable?
It really is unbelievable.
How about you want to go from 3 and 4 consecutive up and down days? They're exactly the same at 900. How about at like 4 or 5 down? Look at these numbers. It's freaking scary.
It really is.
It's absolutely scary how perfectly distributed Apple is. So now you want to go back to and remember, Apple only has a 35-year history. 33-year history. Mm-hmm. So it's not 63 years. Look at how equally distributed. I mean, we could go on forever, but when Apple goes up, it comes down. Now, when Apple was approaching 700, there were a bazillion analysts that said Apple's going to 800, 900, 1,000, whatever it is.
1,200.
Nobody put context.
They jumped over themselves to get to a higher number.
Nobody put context around those higher projections, meaning nobody put the actual percentage chance that they get there. But more importantly, not a single analyst ever in this industry suggested that, you know what, looking back at Apple over time, it has a history of not trending. It has a history of, let's call it, consecutive up and down moves. So it makes the most sense to me that Apple will probably go back down to around 400 rather than trade up to 1,000. Nobody said, hey, you know what? Just looking at history, it has a tendency to just revert to the mean. It has a tendency to create a normal distribution model. And if it went straight to 1,000, that would be a very difficult distribution model.
Certainly look a lot different than that.
That's right. Wow. Look at Apple. Now, when you have some time and you break this down, you're going to look at this and you're going to go, okay, this stuff is freaky. 1,798 to 1,799.
Would never have guessed.
Never in a million years.
No.
Because the stock has gone from wherever to wherever. You know, it's crazy. Let's go next slide.
From 0 to 700, back to 400.
So IBM being around for a long time, you'd say, okay, there's a better chance that IBM would be kind of equally distributed.
Mm-hmm.
But when you start to look at it, did you know it would be distributed to one day over 63 years? The number of consecutive up and down days to one different. Listen, you can say whatever you want about the craziness of this whole discussion, but when you start to, or at least the necessity of this discussion, but when you start to break down the numbers, 3,219 up days and 3,220 down days, back to back consecutive.
It's
1,583 with 3 days in a row, or 1,589 up or down, 782 to 769. Look at these numbers, man. You cannot sit there and say that you cannot ignore this into the future and start to think that, okay, I'm going to build an algo that's going to blow this away. Bullshit. You can't do it. It's just ridiculous thinking. We waste billions of dollars on idiotic newsletters. Some people charge $500 a month for a newsletter. Some people charge $100. They don't know anything. They can't know anything. There's nothing to know. You want to learn something? There's a few strategies. There's things like that. There's certain approaches. But there's more in this than there is in hundreds of thousands of dollars in newsletters.
Well, once you embrace this, you can lose all the rest.
This is Priceline. Priceline. This is Priceline. It went from $1 to 700, whatever it is, back to whatever. Who cares? 903 to 900. Look, this is Priceline. We sit here and we say sell into strength. And you look at us like, that's crazy. It's trending. It is, really. Priceline's had, since whenever Priceline came out, I don't even know how many, 20 years ago, whatever it was, it's had 6 day, whatever it is. It's had 13 times it's been up, down more than 7 days in a row, and 14 times it's been up more than 7 days in a row. Over 20 years, maybe that happens, once every year and a half to 2 years.
I can't play for that.
That's right. You want to play for a stupid trend? All yours. And if you're going to tell me trends are higher highs and lower lows, we're going to show you the next couple of days that it's exactly the same. That even if you did whatever metric you use, it's the exact same. If you're worrying about the magnitude of the moves, it's the exact same. If you're worried about whatever your definition of a trend is, it's the exact same. And if you think it's not applicable to random walk, then I'm sorry you wasted all that money and becoming an economist.
Don't stop now.
$250,000 is a lot of money to buy, for a textbook definition of something that you can't argue with what there's no case to make here. GE, another one, should be just like IBM. And you know what? It is. Look at these numbers, Bat. They are exactly the same. And how come? And even worse, how come in this industry?
Talk about a pin, right? we always play for no movement. That's no movement
in an industry where there are thousands and thousands of analysts and everything else. Why are you all wasting our time? Why are you showing us all the garbage that means absolutely nothing when you could just say, hey, you know what, over time, G is going to have relatively the same amount of consecutive ups because you know what? That's not sexy. That doesn't sell.
Because they need a yacht.
That's right.
That's right.
Because that's where all the customer yachts are. Go back. Don't go there yet. Go back. That's where all the customer yachts are. You know where the customer yachts are? They're parked outside of the brokerage firms, and they're parked outside of the investment houses, and they're parked in the little harbors or whatever it is, because the more assets you gather and the less information you have, the more apt you are to be satisfied with mediocre, underperforming returns rather than try to do the stuff yourself. It's embarrassing. We have to change. It's really embarrassing. We are the most financially literate country, and this is probably our worst effort. We always joke, why haven't they found a cure for cancer?
Yes.
Okay, and I guess it's pretty hard to find a cure for cancer. But to find a cure for a distribution model with respect to the stock market, come on, man. We got a small team here of 5 researchers. This is embarrassing. And we're not talking about an industry that doesn't make a lot of money. I mean, I love the financial industry because I think it's, we've built one of the most amazing infrastructures with respect to marketplace efficiency and all the technology, liquidity, places to go. Total, everything. We have the best marketplace in the world. But how come we seriously can't deliver?
Better players in that.
Well, how come we can't deliver the concept, at least the debate around different subject matter? Why do we keep going back to the same old garbage? Consecutive up days and down days. This is G. Go to the next one, please. Every individual stock we looked at was nearly perfectly distributed. Again, proving random movement in spite of or without objection by the economist view. So we said, you know what? This is too clean. Looks like we fudged everything. So let's look at commodities because there's one thing we hear for sure in this business is, this market trends, whatever. But commodities are the most trending market ever.
Always. And I got to be honest with you. I've said it myself.
Of course you have. Everybody has. I did. I believed all the bullshit. And I thought, you know what? Some stocks trend, some stocks don't, but commodities don't ever get in front of that trend.
Correct.
So, in fact, we've always said they're the most trending underlines of the world. And I've heard a gazillion people say, you can't fade that trend of commodity. These things go forever. Here's what we found. This is the agricultural, which is the softs. This is the agricultural, DBA is the agricultural ETF. We just use some of the ETFs because there's more data, but it doesn't matter. Same thing. 418 to 412. Notice the fewer number of days because these ETFs were started later on. Now, the cool thing about that is for people that want to argue that, hey, they go back, you're going back too far, so you're smoothing out your distribution curve. How about this?
It's amazing. I mean, amazing. This is corn, wheat. I mean,
everything.
This is amazing.
Let's go to the next one, Linda.
I never in a million years would have said this.
This is gold.
Not in commodities.
2356 to 2382. This is gold. I'm bringing this stuff up because I want to blow your mind. I want to open your eyes. I want you to think, I want you to say, you know what? I'm going to now really start to focus on what these guys say with respect to ideas, with respect to strategy, with respect to distribution, number of occurrences. This makes the case for managing winners. Managing winners, because you can't manage anything but winners. This makes the whole case that every time you do something, or almost every time you do something, your probability of a touch is going to deliver you the probability to have an opportunity to make money, almost all the time. If you wait long enough, if you stay small enough, add enough duration, and manage your winners successfully, you don't have to worry about anything else. Doesn't matter what you do.
Correct.
Let's go next one.
And going with the strategy.
This is USO.
50-50.
467 to 468. This is USO.
Soil. I know.
The soil. It's a pure play. It's scary, man.
It really is.
And when you start to, and when you get to the point where, when you and I are saying it's scary, we're making the case for what we do every single day. I'm really bothered by the fact that I don't think the industry has intentionally defrauded the customer. I think they're just plain out stupid and never committed the time. Because I used to think when we were building Thinkorswim that the industry can't be this dumb not to have built really aggressive front-end technology. And then I found out they were. Like, I used to think it was just like this big conspiracy. Let's not offer the customer something so we can continue to charge high rates. And then when we finally built it, I realized, you know what? It has nothing to do with the fact that they were doing this intentionally.
They just didn't understand.
They're just so stupid. It's amazing. Like, this is the dumbest. There's the most money. There's the most money out there in the most efficient marketplace, and yet the domain skill is just off the charts dumb. Let's go to the next one. So those are, again, near perfect distribution, but we're not done because the one thing that's 100% sure that trends is currencies. Because we've heard everything about, every marketplace trending, and we're trying to prove that wrong. But currencies, it's not possible because currencies have external forces like the big central banks, like the Bank of Japan, the governments, all the regulators, all the regulation. We would fully expect, don't fight the Fed, everything like that. We fully expect to see different results. Here's what we found. This is FXC, which measures the US dollar. And we want to use the smallest, 496 496 up, 495 down. Those are trends. Okay? This is FXE. This is the US dollar. Let's go to the next one. So this one's FXY. This is the Japanese yen. You know the Japanese yen. You've heard of the Bank of Japan, right? Those guys are always messing with markets.
Everything.
They control everything. They mess with all the markets. They set all the trends. Okay? They want to push it lower. They push it lower. They want to push it higher. They push it higher. 415 to 418. I mean, listen.
I mean, I'm speechless, and this is not easy to do. Honestly, I mean, it's just so compelling.
Yes. Amazing. Let's go to the next slide. Even for currencies, the distribution is nearly a perfectly normal distribution. So what does this tell us about the nature of the markets? Only with randomness would we expect to see a distribution curve on everything we test turn out the same. We are left with the fact that the statistically random nature of the market is the only certainty that we can come away with. Now, again, how do we take that? Because if we weren't able to, here's the thing, we have got to make everything we talk about investable. And the reason this is investable is because now our focus is on what it should be. Staying small, staying aggressive, number of occurrences, staying small, staying aggressive with number of occurrences, and at the same time, managing those winners. Because now it all makes sense. You sell into strength, you buy into weakness, you do it all day long, you never stop. And you stay super small.
Control what you can.
Control what you can. And you get engaged by thinking you know what's going to happen next. That's cool. I'm fine with that. I always have an opinion.
Of course.
Is that the last one, Linda? Anyway, that is all going to go in the archives. We're not done with this whole discussion yet because there's been an incredible amount of feedback. We thank everybody for it. I am so far behind. I mean, it's only Tuesday, and I'm already feel like I'm a month behind. So if you wrote to me over the weekend or yesterday, I'm behind. It's not that I'm ignoring you or don't want to answer you. I just can't keep up. But that's a good thing. And we'll do our best to catch up. Just please keep the email short. Write peace on the bottom if you don't need a response. And Tony and I will do the best we can. But we only have, we're already on a path to major destruction. The good news is all of it's archived. You can play with it. You can talk about it. You can, and you can expect a lot more from us because we are aggressively going to take this approach. The more that you support Tasty Trade, whether it's through Bob or opening accounts, it allows us to expand our research team. And that's really important to us, as you can see what we are able to deliver as soon as we're able to kind of ramp up our staff. And so we appreciate everything from everybody. But I promise no money comes out of this company. Money just goes in. And we're trying to do something different.
It's like a Roach Motel.
It's for the love of the game. 9:03, we're back with a very interesting discussion.
Oh, you're not done yet. What else you got?
Oh, no, I'm not done.
We're going to have some 90 seconds as we get Tasty on the Tasty Trade Network.
And welcome back to Tasty Trade. I am Dylan Radigan. Nice to be seeing you once again from Tasty Trade Studios here in Chicago. We're about to begin. In fact, we actually have begun. Episode 3 of 10 Reasons to be a Tasty Trader. Now, before we get into things, we're going to work on the third item on our list here today. Let's review what the 10 principles that we've been working around have been before we get into the deep dive. So if we can call up the list, I'll just review it with you real quick. But obviously, you probably remember, you do want to stay liquid. If you can't get in and you can't get out, then you're not really trading, are you? The one thing that we can statistically back up is the idea that mean reversion in implied volatility is a fact. This is driven by none other than human nature, which is that pure present anxiety about future uncertainty is unnecessarily high, and quite honestly, there's nothing you can do about it because it's biological and plays itself out in the mathematics of the financial markets, even in that place. At least in this instance, you can make money on that biology as opposed to worrying about what your child may be doing or whether they're going to get hit by a bus or whatever today, which chances are they won't, so don't worry about it, but you might be more worried than you should be.
I think you're scaring me.
No,
Okay.
we're not getting to you yet, Sosnoff. Just relax.
Got it.
Number 3. Trade small, trade often. That's going to be our focus today. This is very important. Again, I'm not going to overemphasize one over the other because obviously I could say any one of these is the most important thing. They're all very important. They're all the foundational principle. I would say trade small, trade often can be misconstrued and abused, and we're going to try to disabuse everybody. We will disabuse everybody of some of the misconstruing, and we will properly construe it in just a moment. Probability never lies. We'll do that next week. Implied volatility is overstated, which really goes back to number 2. I just talked about that. Take profits and give losers duration. This one is a very mechanical, goes to the later portions of it. But again, you make a little bit of money, you take the money, you're losing money. Extend duration, improves your odds, which goes to number 4, the probability number. Passive investing and destructive to wealth. Active investing works. Those two will be obviously not without some controversy. I ultimately believe it comes down to how you define the words passive and active, but we'll get into that at a later date. Trading a skill that can be developed. Well, this entire undertaking is really an effort to articulate that and understand that. I myself as Exhibit A in terms of the development of that skill at this point, somewhere in that process. And how is that skill developed? Well, through mechanical behavior as opposed to emotional and sentimental behavior. As I've joked around with Sosnoff in the past, the most dangerous thing you can have in this marketplace or in the investment world in general is an opinion. Anyway, that got me with Tesla a couple of times, but I won't get into that. Tom Sosnoff sits across the desk from me. He is not only the founder of this entire undertaking, but he is a man on a mission to increase the size of the community that understands these things, to create engagement in investing in America, and to correct for some of the unintended consequences of the investment culture over the course of the past couple of decades in this country. It's a pleasure to see you, Mr. Sosnoff. How are you?
Pleasure to be here, Mr. Radigan.
So, trade small, trade often. What does that mean to you? Why is that so important?
Well,
why is
it's significant to me because it's not something that I was brought up with in the trading world. So in the trading world, when I first got involved in this business, it was basically, be big, get as big as you can. Size was everything. Who the biggest traders got to eat the most type of thing. What we've learned since we've entered the new age of technology and content and screen-based trading is that was completely all wrong. And this is really a game about how do you protect yourself? You protect yourself with a successful strategic approach, but the defense is size. And so the way that you commit to smaller size trades and the number of occurrences that you're able to create across the board, that leads to direct correlation to success.
Back it up.
So I brought a prop for you to back it up with.
Okay.
But I have 5 pennies here.
Oh, look at you, high roller.
High rolling, right.
Okay.
And if I was to hand you these 5 pennies, I would say, and let's say you had a portfolio of X, whatever X is.
Sure.
So you took.
I do have a portfolio of X actually, and whatever X is.
But if whatever X was, and you took 20, you took your 5 pennies and made each one into 20% of your portfolio, and you threw them up in the air to just bet on direction. There's a number of times when you're going to come up all heads or all tails.
Sure.
Because it just
happens.
It happens with only 5 coins. And so what ultimately...
Well, 1 out of 2 times.
So you're either going to be a genius or a goat. One of those 2 things is going to happen multiple times, but there's not going to be any consistency to your returns. I also have a... Beth, can you throw up the slide that I like to use? Okay. So as you can see here on the first 2 bars, that's just an example of having not that many, a very small number of occurrences. You're either going to be all right or all wrong. Those are the first 2 bars.
That's what this bar is here, or this bar here.
And as you increase the number of
I kind of like this bar here.
Of course you do. That's like 5 heads.
Yeah.
But what if you
So why can't we just do that?
Because that's pretty hard to do.
Because then you end up with a bunch of 5 tails as well?
And then you end up with no success.
Okay.
But as you increase the number of occurrences, you end up with some expected, you end up close to achieving your expectations of results. So what happens here, again with the example of the coins, instead of Dylan Radigan putting 20% of his capital into 5 different trades and just betting on your ability to
heads or tails,
why not do it over 5,000 trades? Then you're going to achieve...
Because then I'm moving out here, basically.
That's right. And so as an investor, as an engaged investor now who's learning about finance, if I can say to you, hey, Dylan, here's a way for you at the end of 2016 to have a predictable results. Now, there's a difference between predictable results
and between actual returns. There's no way to predict your return, but you can predict your results. That means
That seems nonsensical. I think you're talking gibberish, you're talking circles, you're talking nonsense.
Actually, it's
you can't
really
predict
sensible.
my returns, but not my results, or whatever you just said.
I can't predict.
They're the same thing. I mean, you cannot predict my results, but not predict my returns.
But actually you can. That's the beauty of it. So if I can say to you at the end of a process, listen, here, if you're a baseball player, I'll make it simple. If you're a baseball player, if I can tell you that by using a certain style or a certain strategy played, certain whatever, you're going
keep my back elbow up.
You're
above my
going
shoulder.
to put the ball in play. You're going to put the ball in play 90% of the time. Then it's incumbent upon you to make sure at the end of the year your batting average represents the fact that you put the ball in play. Make sense?
No.
Okay. So let's say you're Dylan Ratigan, the home run hitter. You go up to the plate, you're going to bat 500 times next year. But if you strike out 200 times out of those 500 times, and then the remaining times you fly out, you ground out, whatever it is, your batting average is going to be about 200.
Okay. Maybe even 180.
Or maybe even 180, or maybe even 160.
Could get cut.
Yeah. The flip side to that is if I go up there and say, Dylan Ratigan, 90% of the time you go up to the plate in 500 occurrences, you're going to put the ball in play. You're going to then tell me, you know what, my batting average is going to be about 350. It's going to be double because I'm always putting the ball in play. And then it's
therefore the predictability, I should say, of your results does have an influence in the prediction of your returns.
Well, yeah, because then the challenge is on you to make sure that you're doing the other little things that matter, which is part of the other, 7 other tenets of taste trade that we talk about, which is managing your winners, which is letting your losers go, all these different things.
In other words, how you play. So it's one thing to put the ball in play, and then all these other things where there's liquidity or everything that's on the list, that's how you run that's how you play the ball.
But to get started in this process, first you need a liquid underlying. Second, you need to have situations where you're setting yourself up to win. That's right. And then third, you need to have both the technology and the methodology, kind of the brain power that allows you to be committed to create the right number of occurrences so that you don't end up with 5 heads or 5 tails. You end up with something where you can plan, or you'll have an expected statistical chance of success.
Got it. We're going to take a momentary break. You've heard the philosophy, but what is the reality? What is small? Is it 1% of your portfolio? Is it 5% of your portfolio? What is often? I used to be passively long. Now I trade, 5 to 10 times per expiration cycle. Is that often? Dr. Jim, Jenny, and James talk about what small and often actually are here on Tasty Trade right after this.
And welcome back. 10 reasons to be a tasty trader. Today's subject, trade small, trade often, can be misinterpreted as mindless encouragement to generate commissions for other people. But in reality, it is the foundation to the differentiation of your trading from the randomness of a coin toss to the predictability of statistical probabilities that can actually be calculated. Fair? So the question is, that I've had and still have, is okay, want to trade small, trade often? That's great. Well, what is small and what is often, right? How is always the answer in life. So it's one thing to have your big platitude, your big what, your big slogan, but how do you actually do it? Here to answer that question, some people you know. To my immediate left, our friend Jenny. Hello, Jenny.
Dylan.
Nice to see you, Jenny.
Nice to have you on.
Pleasure to be sitting adjacent to you. On the couch, Jim.
Yo, Mr. Ratigan.
Nice to see you, Jim.
Good to see you as well.
And in the Batista Memorial Chair, James.
Dylan, good morning. How are you?
Can I call you Jim?
No. We get too much
There
confusion.
have been lots of mix-ups. Yeah, lots of mix-ups. I get most of the credit I get for what I do is actually his work.
Really?
Yes.
How do you feel about that, James?
Just happy to share the wealth.
Really?
He's a team player. He's a team player.
As long as the name gets
As long
the
as the
honor.
Tasty Trade name is out there.
All right.
That's all that matters.
All right. So, Jenny, what's small, what's often? What does that mean to you?
Well,
How do I calculate? Forget what that means to you. How do I figure out what that means to me?
Well, often is enough to have the probabilities work out. And I always want to be closing a winner. So I was just looking through my account right now. I have about 20 different positions on right now, and I closed 3 winners this morning. So I always want to have something to do in the morning. I want to open my account and see if there's something going on that
So
I can do.
often is enough to be able to do something every morning. For you.
For me. And again, I'm not so worried about keeping the numbers up because I have to meet those probabilities, because I know I do that by I put on probably 3 to 5 trades a day.
Okay.
Which is small compared to Tom and Tony.
Sure.
But large compared to some other people.
Of course,
Yeah.
like me. Is there a mathematical answer to what's small and what's often, Matt? Jim?
Yes.
Who's Matt?
I don't know. He's
I was
not in here.
Nashville. It's a totally different thing.
You know, for me, so when it comes to trading, when it comes to numbers, when it comes to your portfolio, right? Like you talked about the how. Before I even talk about the how, for me, just as a life axiom, I want to know the why. I want to know the why that's underneath everything. And so for me, when I hear trade small, trade often, you hear Jenny say it all the time, we preach it on the network constantly. When you look at these statistical theories like the central limit theorem and the law of large numbers, a couple things I've talked about on my show recently, they actually show you that what we're talking about, we're not making this up. Like, if you trade enough and you stay small enough to be able to do that, these statistical theories start to work for you over time, and the probabilities start to become something that's very, very real, very, very tangible, not just some abstract, ethereal thing up in the sky that may or may not happen. The reality is this. The statistics show us that these things will converge on their expected values over time. And that, to me, is the most important thing in this whole
I get
discussion.
all that, but what I'm not getting out of any, you notice how they're not answering my questions? I'm going to try this a third time. What is small and what is often, James?
I think what they're both hinting at in a way is that it's objective to a point, but it's also subjective based on the size of the trader, the time that the trader can commit to it. You know, Liz and Jenny talk about this a
Fair
lot.
enough, but what's the minimum? Like, there has to be some basic minimum.
I would say several times
Number
a
of
week.
occurrences that is necessary to at least have a chance at moving beyond randomness.
I would say several times a week, definitely.
You guys agree with that? Several times a week would be the minimum
sure.
sort of speed of the airplane to get lift from randomness?
At least a couple trades a day. If you're not on every day, then make a goal of 10 to 15 trades a week.
Okay.
I think
that's
so.
sort of that you think is the minimum to sort of get beyond randomness.
Right. I think that I used to hear, about 30 trades a month.
Which is one a day.
One a day moves you over.
So do something every day will be sort of the
I
To
get
the
it.
point that
People.
you're not detrimental to your account, though, right? Because if you're trading and you're building up these occurrences, and as we were talking about SPY, TLT, the VIX, you're getting into all these products. Don't get to day 5 and say, okay, I did the trades the last 4 days. I've used up X% of my account. I'm comfortable with X%, but the method is one more. Keep doing it. Don't you can be on your Bob the Trader subscription. You're seeing Tom trade every 3 minutes. You're seeing Liz and Jenny trade every hour. But you need to be consistent with what your account has an ability to do.
which brings us to small.
Right.
What's small, Jim?
Yeah, first of all, how many times per week, right? For me, getting the why in place is critically important. But now to the how. When you start looking at the law of large numbers, to have the actual statistics converge, you need to get your observations, you need to get your number of occurrences into the hundreds. So now if you put that in practical terms, if you were to do 1 trade a day, there are 250 trading days a year, give or take. That's 250 occurrences per year. That's large enough to start to decrease that variance. That's exactly right. To start to see your results converge on their expected values. And in terms of what is small, this is going to be largely a driver of account size. If you have a small
so it's
account,
be a percentage of your account.
a percentage of your account. So defined risk, right? Somewhere around 1-2% maybe of your account size. Again, if you have a huge account, you may be in the tenths of a percent.
Okay.
But if you have a small account, 1-3% is realistic.
Jenny, small to you?
I think small is the game changer. I think Liz and my trading changed immensely once we got a handle on small. And small to us is. So I heard you mention Tesla earlier.
Yeah.
And you mentioned,
My opinion was a problem.
And it's not if you traded small enough, because if you trade small enough and you know the worst case scenario, no matter what you're doing with selling premium, straddles, strangles, whatever, your worst case scenario is you're going to be long and underlying at 95 or short XYZ at
Sure.
100. And if you enter that trade small enough and you know what your account can handle, okay, I can handle being long a couple hundred shares of Tesla, or I can only handle being long 100 shares of Tesla, then you can carry that and continue to improve
So
your...
the issue, your pushback on me is that the issue is not my opinion. The
It is
issue
your
was
size.
my size associated
Yeah.
with my opinion, which
And
made
it-
me then feel very burdened by my opinion.
It's the size. So I never put on a trade if my account can't carry that position, because I don't want to ever be forced into having to close a trade because my account
Because
size
of account
can-
size.
Yes, yes.
Small to you?
100% what they said.
Okay.
You know, a few tenths of a percent for a much larger account. I would say a maximum. If you're, you know, when you're moving into undefined risk in a smaller account, at least you're increasing your probability. So maybe up to 10% in a $20,000 to $30,000 account, but you're not going to want to go beyond that. You know, you're going to want to diversify based on product. You know, we talked recently about SPY and going instead to the sectors where the ETFs are cheaper, so you're going to be using up a lot less capital, maybe even collecting a similar credit while still having those same probabilities.
It's interesting, though, just in listening to you and sort of integrating what you've all said up to this in the past few minutes, much like, you know, so going back when we talked about liquidity a few weeks ago, I mean, that one is, you know, as simple as dropping a rock on your shoe, okay? Like, if you cannot buy it and you cannot sell it, then you should not do it, right? Like it's like Fred Flintstone trading, right? And yet, it continues to have to be emphasized. People have to continue to emphasize it to themselves. It continues to be the number one reason, the foundation that why is basically don't drop a rock on your toe the biggest thing. And the reason is because your own opinion and your own ego and your own sort of beliefs make you want to do something that makes you pretty sure. You're like, listen, there's no way the rock will hit my toe on Tesla or whatever the thing may be. And so and I would say that the greatest threat to trading small, much like the greatest threat to deviating from liquid instruments, is your opinion, right? We're going to Tom's point when we started out on the floor of the SIBO, that to be small was to lack conviction, to be small was to lack power, to be small was to lack credibility. You wanted to be if you believe it, right? If you really think Tesla's so great or whatever it is, if you love it for $1, you should really love it for $10.
So, I think, you know, finding liquid
Like you
product-
must have done that. You must have deviated from small because you believe something at some point in your career.
So one time we did a segment, my GDX position, Liz and I we have similar positions. One time our GDX position got so big, and we did a segment called GDX or Bust. You never want to wake up in the morning and have to look at one product because that's going to make or break your account. So that was a big lesson for us, and we really scaled back after that. And now nothing's going to make or break me. I'm not going to wake up in the morning and see, oh my gosh, where is Tesla? Because I'm going to have a terrible day if it's not up. So you never want that to affect you. And if it does, you're trading too big. So scaling down, and if your account can't handle large products, trade small products like James, trade low price products like James said. And so I manage 4 different accounts. One's a very small account, and that only sees low price products. It doesn't see any high price products.
Yeah, which is where I was about to go, which is you can think you're small because you are one contract, but if you're one immense, highly leveraged contract, you're not small.
You're not small. No.
So can you elaborate on that a little? Because in other words, you can misinterpret small
That's
as...
exactly right.
I'm
Because
only
of the underlying product. You sell one straddle in SPY.
I lived it with LinkedIn a year ago.
One straddle with SPY is $4,000, right? So I mean, you know, if you've got a $40,000 account, maybe you can afford to do that.
But that's still 10%.
That's kind of the limit, right?
Like that's a pretty big small position.
Right, but if you've got a $15,000 or $20,000 account, you could do that, but you probably shouldn't.
You're a third of your account.
That's exactly right.
On a one contract position.
So you are waking up.
But the screen says one.
You're waking up SPY or bust, right? You're waking up GDX or bust. You want to get away from that situation, right? So anecdotally, I can say with full confidence that every trading disaster I've had in my life, going back however many years it's been, has been either because I was too big to begin with, or even if I felt like my size was suitable to begin with, had I been smaller, it would have been much more beneficial to me. And so just anecdotally speaking, and I know that a lot of our viewers out there probably have a similar experience, if you
Where
really...
your worst trading experiences of your career have been because of size.
That's exactly right. Because at the end of the day, with the Tasty Trade philosophy, we have an edge. So think about that, right? If you're playing a game where you have an edge, what do you want to do?
Well,
you
especially when that edge only manifests at a minimum frequency, right? Where in order to capture the edge, it's like playing, like it's the same thing with playing the numbers on a blackjack table. Like, anyway, I didn't mean to interrupt you, but the point is that edge is a derivative of frequency.
That's exactly right. So you trade small, you get the frequency intact, right? You want to extract that edge. You want to keep playing this game over and over again to extract that edge. If you have an edge, you trade small to extract that edge. If you don't have an edge, to use your analogy, if you're walking up to the blackjack table where the game is against you,
where the edge is against me,
if you keep playing, you're going to lose. So what should you do?
So I have to bet up.
You should bet once and bet big. It's a totally different game. It's against you. But if I walk up to the table, or if I sit down at my trading desk,
it's 55-45 to me. I just want enough of occurrences.
I just want to sit down and keep playing.
If it's 45-55 against me, then I have no choice but to bet up.
You got it. That's it.
What I do with blackjack is if I win, I leave my winnings, and then I bet. I always bet up against. I always bet to win a second time when I win.
And I'd be willing to bet that system has not worked out very well for you because the game is against you.
It's actually worked out very well for me. I mean, if you don't bet up, you can't make money in blackjack. If you just play the same number, if you play the same $25 or $10 or $5 or whatever it is, anyway, this is the exact opposite of that, which is your point, and it hasn't really worked out that well for me. But quick blackjack anecdote: years ago, did a documentary on Las Vegas. Had to spend was working at NBC. We had to spend weeks living in Las Vegas. Okay, this is not like weekend in Las Vegas. This is like you know live in Las Vegas, which is a weird thing to do. And so like you're finding yourself like you just go to the blackjack table every night, right? And you become, and because of what they do with your sensibilities with the chips and money, you become much more indifferent to money because it's just the whole thing becomes this carnival of chips and the lights and noise and all of a sudden you're sitting there and so I'm sitting there and my producer walks up to me and he sees and I've got this big pile of chips in front of me and he's like, "Oh, it's unbelievable! What a night you're having!" I'm like, "Fear not, I will not leave until the table is empty."
That's what happens in Vegas. You go and no one ever goes.
Of course, yes,
money.
I'm up a lot right now, but you think I'm leaving right now? No, I will not depart this position until the table is empty.
Because you're just there for entertainment.
Well, I don't know.
Never
I was there
Vegas
because I was assigned to go there for work, and I had nothing else to do with myself.
And see, it's interesting because with that statement, you actually knew inherently, innately, that the game is against you.
Yes, and your whole point is that this is the exact opposite of that.
That's right. If you establish
frequency.
a certain number of trades. That's right.
And trade small enough. You should never have to close a position I personally don't think you should have to close a position at a loss and not be able to continue to chip away at reduce your cost basis or improve your sale price. If you traded small enough, you should be able to carry that position. If you have to close it, it was too big. That will change. That will change. That's a game changer in turning, a struggling trader into a profitable trader.
And the point behind a lot of this is also when do you size up? Eventually your account will get bigger. When do you go into that? So I had an experience very early on with earnings iron condors, selling 5-point wide iron condors around big stocks for $1, risking $400 each. 3 days in a row, Monday, Tuesday, Wednesday, made $100 every day. Third day, doubled up. Did it in Google and IBM. Both of them were losers, so that was 300 in winning, and then 700 on the fourth day. I sized up way too early, and that's it's keeping it consistent. I rolled as you did with blackjack, rolled my winnings, doubled down, and that's what'll take you out of the game. As Jenny said,
that's what's been my downfall every time is a series of winners that then I think to myself, if I had played those winners bigger, I would have X. So from now on, I guess I'm just going to play them bigger, and then.
Exactly.
It's an evil moment, actually.
It is, for sure.
I'm hoping that it doesn't happen again. I guess I'm in control. He's James. He's Jim. She's Jenny. We did not invite them all because their names start with J, but it is what happened. Final thoughts, episode 3, 10 reasons to be a tasty trader, right after this. We really hit it through the entire conversation, but I'll lay it out in black and white for you right now. there's a distinction between random outcomes and statistical probabilities. Statistical probabilities only kick in with a minimum frequency. That minimum frequency is the necessary floor. Think of it like the minimum speed for which an airplane takes off, or the minimum speed that you have to be pedaling a bicycle in order to hold your balance. There's a minimum frequency of trading occurrences necessary in order to eliminate the randomness of trading outcomes. This is obviously logical. It is also something that then becomes foundational to the next pillar of this, which is staying small is the necessary prerequisite. I say it helps manage risk, but really staying small is the necessary prerequisite in order to achieve the minimum frequency necessary to eliminate randomness. If you are not staying small, you cannot achieve the minimum frequency to eliminate randomness. And at that point, you end up with randomness. And to James's point, that randomness, unfortunately, because of the way risk plays out, is a little winner, a little winner, a little winner, a huge loser. And that ends up with a net negative return too often because the sizing was wrong and the frequencies were too small. Whereas if the sizing is kept under control, you're able to achieve the minimum frequency to endure the inevitable losers and still come up with a higher probability of generating returns that are plus rather than minus. And that really is the foundation of the trade small, trade often mantra that you hear around here so often. And that is reason number 3 to be a tasty trader. We've covered liquidity. We've covered high IV. We've now done one of the biggies here, trade small, trade often. Next week, we'll look at probabilities specifically and how reliable they actually are when we talk about these frequencies. I am Dylan Radigan. This is Tasty Trade, and we are back with more Tasty Trade Live right after this.
Hey everyone, hope you liked this video. Click below to watch more videos, subscribe to our channel, or go to tastytrade.com to watch us live.
And welcome back to Tasty Trade. I am Dylan Radigan, and this is edition number 4 of 10 Reasons to be a Tasty Trader. Quick review for you. The 10 pillars: liquidity, sell options when IV is high, trade small, trade often. We just did that. Today we're going to focus on probability never lies. What does that mean? How are the probabilities calculated? And why would you deviate from probabilities at all? Also on the list, implied volatility, taking profits, passive and active, trading as a skill and as a mechanical activity. We'll get to all those at a future date, but I want to focus in today on probability never lies. What is probability, and how do we know that it never lies? I'm going to begin with Mr. Sosnoff himself, who's sitting across from me. What does that sentence even mean?
It goes back to, I'll tell you the origins of it.
Please.
So on the old trading floors all throughout Chicago years ago, they used to say, first thing they said when I got to the trading floor is options never lie. Now, the reason options don't lie is because they were priced so efficiently, but we never realized that. So it was really what they were trying to say was probabilities don't lie, but they used to say options never lie. And then there was always futures never lie, options never lie. And the reality of it was we just transposed it to where we are today, which is probabilities never lie, because I think that's really, option.
But what does that mean? Whether it's options never lie or probabilities never lie? Well, options. I mean, because in other words, they calculate the probability of the weather all the time, and they're wrong constantly.
Well, when we say they never lie, it's a little bit of a poetic license. Okay. What it means is a little bit better than 68% of the time, they never lie. Okay. So 68% of the time, we're right 100% of the time.
Understood.
Okay.
So, but what it means really is that the implied probability of an outcome as expressed in an options price is correct 100% of the time, 68% of the time.
That's right.
That's the reality of it.
That's the reality of it. And that's because the pricing, the variables that go into pricing derivatives products like options are pretty fixed. I mean, in sometimes when there's interest rate volatility and rates are moving around, things like that, there can be some open-ended variables. But for the most part, pricing is fairly fixed and it's static. or the variables are static. So you end up with this very efficient pricing most of the time. Now, as that doesn't do you any good because there's no advantage there. The advantage comes with the strategy that you apply to that pricing. And that's all, and that's what we mean by that.
So walk me through that a little bit.
Okay, so Beth, if you can fire up the screen, we put one slide here. So on the top line here, we show that the expected percentage inside the implied move. This is just basically your 68% of the time, and this is the S&Ps, the Nasdaq, and the Russell. What we have below that is we start to talk about, when implied volatility is at different levels, how much of the time they actually stay within that range, the predicted range. And as you can see, the amount of time is much greater than that.
Right. Than the 68% that's implied.
And so you end up with, that's where we feel like we have a little bit of an opportunity, is that, obviously with the most amount of fear and the highest implied volatility.
So when implied volatility is between 25 and 50, the move ends up being within 2 standard deviations? Or
within one standard
deviation, 91% of the time.
That's right. That's right. So
for the S&P, or in 1 standard deviation, 84% for the Nasdaq, or 87% for the. But is that not probabilities baldly lying? Because you're telling me 1 standard deviation is saying it's 68% of the time, and yet it's happening 91 or 84 or 87 or 70% of the time.
It's not boldly lying. What it is it's taking what happens in the marketplaces, and we've talked about this in weeks past. What happens in the marketplace is there's a premium that's applied for unlimited profitability, and then there's a deduction. So in other words, if you're willing to limit your profitability on a trade, you're going to get a higher statistical chance of success. And if you're willing to take the opposite side, which is you want unlimited profitability, you're going to have a lower chance of success. That's just the way pricing is.
I understand.
So the bet here is always that you're going to, you're not going to price something if you're taking an unlimited. If Dylan Radigan's selling something and taking an unlimited amount of risk in the process of selling it, you're going to make sure that what you're selling has a premium built into it.
Sure. And
if you're buying it, you're going to pay a little bit of a premium for that
because of the payouts, basically.
Yeah, and that's all it is.
So how do I apply this understanding to trading my Tasty Trade account on any given day?
Well, there's two.
What does that mean? I understand staying liquid. I understand selling options IV is high. I understand trade small, trade often. Right. How do I apply this concept of probability never lies to my
So we have a real simple
activities?
We have a real simple way of explaining it. Imagine right now when you invest, you're learning how to invest, you're finally becoming engaged with the markets. The first thing you think of is, I have to be right. Dylan Radigan, I have to be right. So I'm going to decide to buy XYZ stock or ABC stock. I need to be right. So the first thing you do when you see this is you start thinking to yourself, you know what? I didn't realize I had a chance to pick a strategy where I'm basically challenging the market to beat me.
Right.
And that's the difference. So the way to make this applicable is you come up with different strategies in which we talk about.
So this has a lot to do with basic order genesis.
That's right, of course.
That probability never lies is the foundation upon which orders are generated.
Which is the suggestion of, rather than me trying to beat the market, let the market try to beat me. And if something has a really an 80% chance of if the inverse of that, a 20% chance of beating me, and it's priced on a 68, it's priced on a 32% chance of beating me, then I'm going to take that shot.
Right.
That's the advantage you get for taking unlimited risk with limited profitability. And so essentially our argument is, if there's a situation or a strategy that you can create that as an investor, and you can say, hey, go out there and see what you got. See if you can get my money. We love that.
Is there a way to prioritize this?
Well, you can prioritize.
Does that question make sense?
Yeah.
In other words,
so the priorities go to opportunity. You talk about it all the time. You talk about inflated volatility and heightened fear.
Right.
So as you can see here, the numbers go up dramatically by let's say 10 to 15% higher. Statistically, they're more advantageous to you if you have the ability to wait for higher implied volatility. It's hard to do. Sometimes it's frustrating because you don't get higher implied volatility. But if you have the ability to just be a little bit more patient, you get some heightened opportunity.
How is it that probabilities in the financial markets don't lie in your poetic interpretation of it, but probabilities in other markets like weather do.
Well, weather, sports, things like that, everything else. Well, here, the difference is that you have a two-sided market here. So when you have a one-sided market, probabilities can't be as accurate.
Sports is two-sided, right?
Well, they're two-sided with a big 10% cushion in between. So, and there's a lot of sports markets. Like if you wanted to bet on your favorite baseball team to win the World Series, you could only bet on them winning the World Series. Right. You can't bet on them not winning.
Right.
So there's a lot of the sports markets are only one-sided, and the ones that are two-sided have a 10% VIG or 10% premium in between those markets. So they're very, very wide. These are efficient one-tick wide markets with a buyer and seller on both sides. So there's no room, either side. Both sides are making a simultaneous bet. So there's so much efficiency here that it works.
Fair enough. Tom Sosnoff, probabilities never lie. This, 10 Reasons to be a Tasty Trader. We take a break. We're back with the boys, Ryan, Frank, and Mike Butler, with some anecdotes about maybe when they thought probabilities were lying. We'll see. I don't know if they do lie or not, but we're going to talk about it right here on Tasty Trade right after this. All right, welcome back. 10 Reasons to be a Tasty Trader. Our focus today, probabilities never lie. Sitting with me, Ryan, Frank, and Mike Butler. This is an all-male trio here. I got spoiled with Jenny and Liz the past couple of shows, but it's nice to have the boys in the room. Frank, it's a pleasure. Nice to be seeing you. We just met each other, so this is a new relationship for us, but it's nice to see you.
Glad to be here. Thank you so much.
Yeah. What do probabilities never lie? What does that mean to you? And how do you, it's not even so much what does it mean, because we just talked about it with Tom, but how do I apply, again, and I touched on a little bit about this. Liquidity, trade small, trade often is very clear in my head how you apply that. It's still not totally clear to me how you apply the fact. I accept probabilities never lie, so what? How do I integrate that into my order genesis, my trade generation?
Dylan, for me, it's more that they exist, and it's understanding that you can use them as a gauge. I think that's also one of the kind of game changers or the really big eye-opening pieces for somebody that goes from just trading equities to trading options, because you can derive these probabilities. So we have the option prices changing around. They have implied volatilities as a result. We can then look at the area underneath the curve of that distribution and come up with a pretty good sense of the likelihood of a certain thing happening over a period of time. Now, we all know that that can change. Price can change. Those probabilities can somewhat change. But it's the gauge that you use to kind of enter into your trade. You could say to me, well, I think that Tesla, for example, is going to be $250 next month. And I can say, okay, fair enough. But I can also go in and look at the option chain, look at the probabilities from those option prices, and see that, well, you might be right. But right now, the market expects about a 10% chance of that happening. So maybe I just take the other side of it. Again, just using them as a gauge.
Butler, you agree with what he just said? Does that mean, in other words, that the real thing is that the idea, I guess, is that it allows you to separate yourself from yourself. I'll give you some way to, as opposed to me checking my opinion versus Frank's opinion, it can be in addition to my opinion versus Frank's opinion, it's mine and Frank's opinion versus the probabilities.
Yeah, absolutely. It gives you an ability to put context around the current prices of the options and kind of gauge it and view it across a strike bar, for example. And for me, I think it's another cool way to think about it is just the ability to take the other side. So like Ryan said, when you are just investing in equities, you can be long those equities. For the majority of America is long these equities, whether they're super short or super bullish, regardless, they're long. But with options, you have the ability to take the other side. So if someone wanted to bet and buy a call or buy a put that's extremely far out of the money, has a 10% chance of being successful, I can actually be the house, like you referenced in the previous segment of playing blackjack. I can be the house and allow that person to take that risk and basically bet against the fact that that's happening. And even if they're right just a little bit, as long as they don't reach that certain point, then I would be successful in that trade.
I mean, can you give me an example? Maybe Frank, can you give me an example of sort of why would I not just use probability all the time? You see what I'm saying? Like, in other words, does this then just come down to a battle between my own ego and my own opinion, my own point of view, and probabilities? Because obviously people put on low probability trades every day.
Yeah, absolutely. Because as premium sellers, people are taking the other side of what we're selling.
Sure.
Well, I think that the way I think, and a lot of tasty traders think as well, is I do use probabilities every day. Whether it's looking at a potential movie that you want to go see, maybe Joe off the street say, "Oh, I like this movie." Well, I'm going to look it up and see what an efficient market of thousands, hundreds of thousands have said, and try to confirm whether it is worth the ticket price. And in the same way, you use that probability of a very efficient market to see, a lot of people are bullish on this stock or that stock, but I'd rather just make my decisions in the market based off of a probability rather than a gut feeling. So to speak.
Although I would say the one thing that also gives me hesitation with this is the idea of some specific expertise is more valuable than some generic statistic. I know the metaphor that I'll use is if we're in this room and there's a sick baby, a sick 1-year-old is in this room, and it's the 4 of us and a pediatrician, and each of us get an opinion as to what we should do with that sick baby. And I have my qualifications and you 3 have your qualifications, and then we have a trained pediatrician. Do we take a blended average of those 5 opinions and then decide what to do with that baby, or do we overweight the opinion of the pediatrician? And I just wonder whether the issue with relying too much on probabilities is it suggests that, well, the average view of whatever's in the pricing is more valuable than the expertise of the pediatrician or the expertise in a particular security. Does that make sense?
Yeah, for sure. I think, in your example, maybe that's a little bit more subjective, where you have a market and you have everyone that's willing to pay a certain price. So to some degree, we're coming to a decision as to what those prices should be at this point in time. And objectively, we can then derive these probabilities from this implied volatility. And again, those things could change. New information could come out. All of a sudden, those probabilities change. But it's really the best thing that we have as a gauge to go off of when we're setting up our trades, because it's a snapshot of what the market expects right here, right now. We can choose to agree with that or disagree with it, but it's really, I think, one of the best things we have to go off of.
Again, I'm just trying to think of the reasons why I wouldn't use it. And the only reason why I wouldn't use probabilities is because there's a specific expertise that's not reflected in the probabilities to my pediatrician metaphor. And I still don't totally understand why the expertise over the outcome, Mike, is not on. Sure, if you know nothing, the generic crowd's opinion is better than maybe your opinion. Mm-hmm. But isn't there some opinion out there that's better than the crowd's?
So
in every situation?
Yeah, for me, I think it's important to focus on the fact that at the end of the day, we're dealing with imperfect information. So even though someone might have an expertise in a certain field, they're generally looking at a certain probabilistic outcome and picking that highest probabilistic outcome based on their information. Like if someone was an expert in oil futures, they're still going to be using probabilities to pick a direction based on the information that they have. In a lot of cases, maybe we'll get a report, for example, that would be very bullish, but the market will take it the other way and you'll see oil prices drop. So at the end of the day, I think it's still very probabilistic in their expertise and what the direction that they're picking. So
you're saying even the biggest expert, even the pediatrician, mm-hmm. has a limited selection of information about what's going on with the baby.
Correct.
Well, you can look at the other side of that too, which is really interesting, going back to the probabilities. Let's say that you have more information. Right. You do know some secret, right? And you look at the probabilities, and you can now disagree with those probabilities because they're much lower. The likelihood of this outcome is much lower based on what you know. The market's pricing it wrong or incorrectly based on, for you personally, right, as the trader. And that's what is really cool about this, is that you can't really do that with equities. You might know, okay, I know some information, maybe going to push it up or down.
Sure.
But you can set up more asymmetric opportunities if you disagree with the probabilities, or over the long run, just put on trades that tend to work out in your favor. But it's all on what you know relative to what the market expects, and then you can just make a decision off of that.
Frank, what are you thinking?
Yeah, no, I completely agree with these 2 young gentlemen. I think that what you're kind of alluding to is, why would me selling options outperform, a very well-educated analyst or fund manager? And, I think where we get that edge is that those analysts and fund managers, they have this limited information that they get from a certain company, and certain companies, not to directly play off the title of this segment, but they can lie. And these probabilities, they're instituted through all of these people in the market, those probabilities aren't going to lie. And, those analysts and fund managers tend to, like we talked about earlier, be, bullish or bearish. With the selling of premium, we can be bullish or bearish, but we can also, get an edge to that, which is selling, a call if we're bearish and a put if we're bullish. So we get an edge in the premium that we're selling, and we can also do what these very well-educated fund managers and analysts do.
How consistent is the relationship between the relatively moderate returns, Mike, of a high probability trade and the relatively superlative returns with low probability? I mean, in other words, is it reliable in that correlation as well?
Yeah,
where I make a lot of money on low probability trades relative to the dollar's risked and vice versa?
Yeah, the research team has done a lot of segments on this where, of course, if you're buying something that's super cheap but has a super low probability, eventually, at some point in time, you will probably make a ton of money on that trade. But over the long run, when you're looking at probabilities in the long run, most of those trades are going to be losers. If I've got a 99% probability that it's going to be a loser, but a 1% chance that it's going to be a winner, of course, my return on capital of that 1% time where I'm successful is probably massive. But those
is it ever big enough to offset the 99 pennies that I lost?
No.
So it's never going to be a scenario where it's worth losing the 99 pennies to collect the one big jackpot penny.
Right, exactly. And in the previous section, we showed that basically when we're dealing with implied volatility and we're selling premium, when we're looking at implied volatility overstating realized implied volatility, that implied volatility is basically the options price. So if I'm paying more than I should to have that long call or that long put, to have that lottery ticket, over the course of time, I'm paying more than I should, and that's going to really drag me down in terms of P&L.
Yeah, I think you have a choice. I mean, do you want to capture that premium with the understanding that once in a while it's not going to work out? You're an insurance company. Every once in a while you're going to have to pay out on that claim. But over time, and through that law of large numbers, which really ties into the previous pillar of trade small, trade often, the odds are going to be in your favor. So if you're able to do it and, mitigate your risk in a variety of different ways, but do it over a long enough period of time and have a high enough number of occurrences, then those probabilities don't lie. And in a lot of cases, through the research that we've done, we've shown that, you actually have greater odds than what you might be presented with at the time of the trade.
What about my desire for a high probability, high payout trade?
I think that's part of the art of it, is trying to figure out in terms of probabilities in the sense that, well, do I have a probability of profit? How do I then structure a trade where even if I'm wrong, I'm still, flat or up a tiny little bit? I don't necessarily have that big payout, but I didn't lose any money.
Right.
I think, again, that's just part of the art of it, but you can only really do that through trading options.
Got it. Okay, listen, Frank, Mike, Ryan, it's a pleasure. Thanks for the conversation. Thanks for being part of my my learning experience with this entire undertaking, actually. We're going to take a momentary break. We'll be back with the verdict right after this. Welcome back. Time for the verdict. 10 reasons to be a tasty trader. We're talking pillar number 4, probabilities never lie. A couple of things stand out. 1, companies do lie. 2, imperfect information prevails even over the greatest experts that may exist. And 3, relying on your opinion is a lousy way to allocate money, especially when you do at the very least have the benefit of the crowd wisdom as reflected in these prices, particularly in the deep, active, liquid names, so that at the very least, when it comes to trade formation, when it comes to trade generation, you actually have a tool upon which you can found your actual trade construction. So the verdict, I would say, is as follows. Much like only trading liquid products, the only risk and the biggest risk to deviating from the benefit of the fact that probabilities are there, to Ryan's point, they exist, and that they don't lie, is your own investment in your own point of view and the degree to which you are actually willing to supersede whatever those probabilities are reflecting with that point of view, which is no different than deviating from liquidity or deviating from the size limitation that is suggested. Again, so much of this comes down to our own ability, clearly, to manage our own state of mind and our own opinion relative to the mechanics that may be very blatantly in front of us. And that's been episode 4 of 10 Reasons to be a Tasty Trader. Probabilities never lie. We're back next week with pillar number 5. We're back on Tasty Trade right after this. Hey
guys, I hope you enjoyed this video.
Click below to watch more videos, subscribe to our channel, and if you want to trade along with us, visit tastytrade.com.
There's no good way to feel good.
Well, there's one way to feel good, and that's to get better at having control over your own destiny. Mr. Sosnoff and I were just talking about the election. We're not going to talk about the election right now. We're going to talk about 10 reasons to be a tasty trader. I'm Dylan Radigan. It's very nice to see you. Tom Sosnoff is sitting across from me. Our conversation today revolves around volatility. You've seen the list a few times. I don't know if we're going to bring it up this time, but the particular subject today is actually a personal favorite of mine, because not only is it where the opportunity is manufactured when it comes to options trading, as I have learned the past couple of years, but it also applies to life across the board. And I would even argue it's explicitly applicable to some sentiment coming off of the American presidential election, and that is the following rule. Implied volatility is overstated. Here's the list. Liquidity trumps all, forgive the pun, wasn't intended. Selling options when IV is high, that's related to today. Small and often, probabilities we talked about. Here we are today. Implied volatility is overstated. My interpretation of this from day one, when we first started talking, was, and that sort of was the first light bulb with me, because as you know, I was one of your larger skeptics when you first reached out to me. And I've become much less skeptical and much more engaged over the past couple of years, entirely attributable to your efforts with me, and which I'm honestly grateful for. But the thing that the first light bulb went off for me was with this right here. Implied volatility is overstated.
That's the easiest light bulb.
Present fear of future unknowns is overstated. And the reason it was so easy for me to recognize is because I suffer from this in my non-financial life, whether it's my anxiety about, where am I going to live, or what's my job going to be, or what's going to happen to the country. All the things, again, I mentioned the election. What's the future of America with President Trump, or what's the future of America with President Clinton? If she had won, either one would have been a fraught with volatility. Anyway, it's human nature.
This is the lowest. So picture a ceiling. You mentioned the light bulb.
Yeah.
Picture the ceiling where you don't have to get up on a ladder.
Yeah.
Like I have ceilings in my house that are, some of them are really high.
Sure.
And I can't change the light bulb because they're kind of this fancy.
You got to get one of those things where you got to like.
It's worse than that. There's like a cover to it, everything. I can't change the light bulb. So if the light bulb goes off, I can't fix it.
Sure.
This is a really low ceiling with an old school bulb in it. And the easiest thing when the first time I talked to you about trading, the logic that was the simplest to understand, that made the most sense to you right off the bat, was fear and uncertainty has to be overvalued.
Right.
It can't be. There's no such thing.
It's human nature.
That's right.
Even if you want to value it appropriately, you're going to overpay for it every time because you're a human being.
So what people don't, everybody thinks about markets as zero-sum games. Generally, that's the.
Of course.
So how do you change the perception of it's a zero-sum game, which means that I'm obviously disadvantaged, and then there is something out there that you can take advantage of that you didn't realize you can. If you ask people, can you take advantage of overpriced fear in the stock market? They're like, what? Are you talking about buying low when something's oversold? That's not taking advantage of overpriced fear.
Right.
Are you talking about selling something when it's high because, just because price is high? That's not taking advantage of overpriced fear. So most people don't recognize that there's an element to the stock market, and you included, originally the discussion was, hey, there's a whole different world out there that most people don't recognize when it comes to finance and it comes to efficient market theory.
And just the idea that stock prices, or any security price, whether it be a stock price, securities prices, don't mean revert.
Well, also it could be
volatility does.
It could be the value of anything. Like I remember when I moved to Chicago in the early 80s, I remember the first time I was looking for a car, we were buying gray market. They were offering gray market cars because we could buy them at a discount because fear of catalytic conversion and everything else. I guess my point is that there's always some market out there that has this overhang of fear.
Sure.
And it has this inflation in price due to some kind of uncertainty, whether the uncertainty is a regulatory uncertainty, whether the uncertainty is from something else justified from a binary event or anything else. There's always opportunity around that, but very few people know how to take advantage of it.
Right.
let's say you wanted to buy a piece of real estate and there was some kind of act of God, like a hurricane or something. Prices are going to be cheaper after the hurricane.
Sure.
The act of God risk remains no matter what.
Sure.
But the opportunity based on something that just happened creates, lower prices, which you may want to take advantage of.
So obviously yes to all of this. But this one, here's where you run into a challenge with this. Here's where I run into a challenge with this. I'll put it that way. Okay, fine. Volatility is overstated. We can give 1,000 examples. You just gave a hurricane metaphor, but we could stay here for a year.
Right.
Giving examples.
Insurance,
it's so prevalent.
Market, yeah.
The reason the insurance market exists, right, is people's anxiety about the liability to their. Anyway, we can go on and on about.
Yeah.
So, what's the overstatement? Some 6 or 7% in terms of there's the research math before I get into my.
Well, it's hard to say. So if you do it,
I just want to get some more definition.
Sure. If you look at overstatement with respect to illiquid markets, so I brought up insurance because the insurance marketplace is a fairly pretty illiquid marketplace.
Sure.
We talk about. And you don't have a lot of choices.
Right.
So you don't have a competitive exchange-based marketplace. So most insurance premiums relative to real risk are about overinflated by as low as 80% and as high as 400%.
Okay.
When you get into the stock market, it's very different because since you have since you have the ability to trade both sides of risk, it could be anywhere from, and not on a number of percent points, it could be, let's say, 7 to 10%.
Percent points overstated.
That's right. So you're talking in most cases, usually it's somewhere between 7 and 10 points.
Right. So let's just call it 7 points to be
700 to 1,000 basis points.
Okay. Fair enough. Well done. Nice use of basis points.
Perfect.
So we'll call it 700 to 1,000 basis points overstated on average.
Right.
Implied volatility.
That's right.
Is overstated. And you can demonstrate that 1,000 times. You've shown it to me. I've seen it 1,000 times. We've seen it in real life. We just see it with the election. All these things. Here's the real question, which is, it's all well and good that this exists, but where in the entire landscape of all the options, or even where in the entire landscape of all the liquid options, is that volatility overstated at this moment? Right? In other words, it's one thing on average for volatility to be overstated 700 to 1,000 basis points. It's another thing to be able to identify where it's overstated. So, for instance, we sold puts in the EWW this morning. Yeah. You see where I'm going. Okay. It's one thing to know when I walk into the room, it's full of opportunity. It's another thing to know which little door to open to find it.
So there's two points here that we have to bring up. One is you're asking for the context around the overstatement,
and I'm asking for the map to find where the jewels are buried. It's overstated for a reason, and it's not because it's not an evenly distributed overstatement.
So volatility is overstated. The reason behind the discussion is that when you sell volatility, you're limiting your profitability. Anytime you limit profitability, you increase your statistical chance of probability of profit.
Yeah.
So by limiting what your upside is, you increase your chances of profit. That's the premise behind it. The other that would be let's put it that way. That's my main takeaway as to why you have the opportunity to be able to do this.
I understand that, but it's not an answer to my question.
But so the context around it is when you measure it against itself. So, for example, you mentioned EWW, which is a Mexican ETF, and Mexican peso and Mexican ETFs have been under pressure since this election. So you measure the average volatility in there, looking back whether you want to do 3 months, 6 months, or a year. We usually use a year, and then you measure the current implied volatility against that. When you see that level is at the top of its, it's basically
52-week range.
It's basically pinned at 100%. So if you were to measure it from 0 to 100, it's at 100 right now.
Yeah.
So what you're looking at then is you have an asset that mean reverse, which is volatility. You have that current asset at the top end of its trading range, pinned at 100. That's where your opportunity is. Then you limit your profitability, and that's the way you take advantage of inflated volatility.
That answered all my questions.
That's the three-headed monster.
And the final tool to do that is some piece of technology to identify it.
Yeah.
Right?
Or some strategy.
We need some way to actually visually see when IVR is high and search for high IVR in liquid names.
All good pieces of technology include that today.
Accomplish that.
Yeah.
Got it. He's Tom Sosnoff. This conversation continues. 10 reasons to be a tasty trader. Kai, Jared, and the big guy himself. You know who I'm talking about. With us right after this. Welcome back. 10 Reasons to be a Tasty Trader. I'm Dylan Radigan, and we're having a conversation today about, I think it's number 5. Yes, it is number 5. Implied volatility is overstated. We've been over the liquidity and some of the other earlier items on the list. This one, as you can tell, is certainly a personal favorite. And, I think probably a favorite of a lot of folks because it's where the meat it is the meat on the bone, as it were. Anyway, Jared is immediately to my left. Kai's in the fancy red couch, clubbing. The club couch, club tasty trade. We need music. We need a soundtrack for you, Kai. We need some sort of trance or something. And then look over here. I mean, how do I benefit from?
It's an honor to work with a true professional.
So I'm going to start with you, Kai, though, on the couch. Just really more because I want a shot of the couch.
Okay.
But you're on it, so you're going to have to talk.
So I actually like this topic too because it is pretty difficult to understand for a lot of traders for this concept without looking at the data. So in the past 25 years, actually, the implied volatility overstayed the actual or realized volatility 83% of the time. So that's
4 out of 5 times IV is too high.
Exactly. So if you have 50%, you never make money selling premiums. It's a zero-sum game, right? So the implied volatility has to be overstated to make money if you're selling premiums.
So it has to be.
It's pretty powerful.
I mean, it basically is it destiny. I mean, Kai's laying it out. I mean, obviously liquidity. If it's illiquid, I mean, there's other things I could argue are destiny. You're gonna have to wait, Jared. By the way.
Sure.
Thank you.
I'm used to that.
I appreciate that.
I love his statistics that he threw out there, and I think for the retail investor.
But is it destiny? In other words, anytime that I pick an option, a trade that's not exploiting high implied volatility relative to itself, to my advantage, relative to I notice I used that word relative to itself. I didn't omit that phrase. Anytime I deviate from applying that aspect, much the same as deviating from liquidity or that type of thing, but am I basically betraying any of the opportunity that gets discussed on this network? And
it's historically 80+% of the time.
Right.
I won't be.
But do you live that way? I'm asking you.
100%. And
tell me some stories. Tell me some stories. I want some more stories. That gray hair didn't come cheap.
Okay, that's true. It didn't. I paid some valuable blood for that. Yes,
that cost some.
You're 100% correct.
Resources.
So I'm gonna go the retail investor because that's everything that we look at here. No retail investor can talk about what implied volatility is, nevertheless know that it's overpriced. So if they do know what to do about it.
Have
no idea. It's always overpriced. That's not the key. The key is realizing to itself when it's overpriced. You see, you can always sell somebody insurance. It's the reason why insurance companies.
The reason Geico exists.
Exactly. It's the reason why.
The reason Warren Buffett has extra airplanes.
It's the reason why premiums have been going down for insurance because that market has been so inflated and so fat. There's been no competition.
Right.
Now in the market, you have the tools to see that volatility is overstated to itself and take advantage of that movement to itself. Volatility, selling it all the time is a profitable business. That's not really the point. The point is selling it when it's at an apex, and that's when its implied volatility is overstated to itself.
And so how does that reconcile with Kai's 83%?
He's giving you a straight number.
That volatility is too high 4 out of 5 times.
Period. I want to take it to a different level.
And the whole point of this is that's what Kai's saying is the foundation.
Historical.
But that the tasty trade application of it transcends the foundational aspect of IV being overstated.
That's correct.
To being overstated relative to itself.
That's correct.
I think when Tom and Tony figured this out, I don't think they were poring over spreadsheets looking at option prices for the last 25 years. It was this. Were you?
For the first 20 years.
I don't know. Maybe I'm wrong.
For the first 20 years, I don't know if I could quote you what implied volatility was, period.
But there's something, the the philosophy
Yeah.
is that fear is overstated. That's a beautiful idea. It's something that I can really fall back on, and
Sure.
it makes it easy
So
to
you can
put
go to
trades on.
sleep at night.
Yeah, trades that are scary, things that are scary, just in life. It's easy. That's something that you can really buy into.
Yeah.
But then you actually go and see there's a mathematical result to this as well. Why that is? Why do people want this protection? Is it because some people don't like to be afraid? But when you say it's overstated relative to itself, that's how you are consistently profitable over time. You can just sell volatility.
Well, we can't pick direction.
That's right.
I mean, it's a 50-50
Right.
shot when it comes
Yeah.
to direction. I don't care what anybody says.
Unless you're me picking Tesla, in which case pick the opposite.
Depends on your time frame, right?
Yeah, yeah.
So I mean, you can't
lost
pick
money on the
direction.
Dylan Tesla
We've got to
trade
find
many
something
times.
else.
Many have.
Yeah.
So we got to find something.
Wait, so we can't pick direction.
Can't pick direction. So you've got to pick. You can still be directional in your nature, but you have to.
Meaning I can have an underlying position that's long spiders.
Sure, absolutely. But I don't want you to be long at today. I want you to take advantage of overstated implied volatility. I don't want you to be long at today at today's price. You want to be long S&P. The price up or down doesn't matter to me. I don't want you to be long it at today's price. I want to teach you how to be long it at a lower price, be paid at a lower price, but yet sell volatility where if volatility contracts and the S&P doesn't go anywhere or it only goes up a small amount, that you make more because you sold volatility, you sold insurance that's higher. Oh, think of it as like a car. You have insurance for 30 days. If you were to drive distracted, meaning with your phone in the car.
As everybody does.
As everybody does. Your insurance would be a lot higher. That's implied volatility rising relative to itself. I'm still the same type of driver. If you took my phone away all the time, my implied volatility is still the same. My insurance company's still going to charge me an overprice, but they wouldn't charge me as much as if they knew I had a phone in my car and I was texting all the time.
Right.
That's implied volatility higher relative to itself.
You can sell volatility and be profitable just selling volatility. But when you sell it high relative to itself, that's how you're going to be consistently profitable every single time.
Well, more profitably, and not every
single time. I mean, this guy.
83%. That doesn't mean every trade's a winner when I say every single time. But
so there's an interesting data. So volatility, we all know we want to sell premium when volatility is high.
Sure.
But what about when volatility is low? So the interesting stats is even when volatility is low, the implied volatility still overstates the realized volatility by 1.7%. So let's say we only look at it when VIX is below 15.
Sure.
It's still overstate 1.7%. So that's really powerful. That's a good thing to know to trading mechanically.
Right.
So even volatility is low, you can still trading. Selling premium is still profitable. Also, if you look at different time frame, durations, we look at 9 days volatility, 30 days, 3 months and 6 months, they all overstated. So
point is, it's incredibly consistent.
Yes.
Across the entire spectrum.
Yeah, time frame.
Which is why every time you do it, you make money. Right, Jared?
He's giving you a chance to retract your statement because
I'm not saying that every trade you make makes money, but I'm saying that if you want to go into this and be profitable over the long term, over the long run, there's only a few ways to do it.
Well, let's take it one. Let's backtrack for a quick second here. So, and let's just round and just say 8 times.
I'm not retracting anything.
So 8 times out of 10, you're going to be 8 times out of 10. You're going to have a chance to manage a winner. The other 2 times, you may never have a chance.
The window will never open.
That's correct. It's the same. Listen. Implied all the rules have to, or all the 10 reasons to be a tasty trader, all have to be put together. You can't just take one and
play
say,
football.
"Hey, I'm playing right." I'm
sure.
exactly. So
Right,
you know
sure.
you've got to piggyback each one on top of each
Right,
other.
and really we picked 10 reasons, but there are infinite reasons to be a tasty
There's
trader.
10 reasons, and then there's 10 subsets to the 10 reasons.
Right, well, we'll just rename this thing Infinite Reasons to be a Tasty Trader.
That's correct.
And we'll just
No
say
one's better
today's
than the
reason.
other.
I mean, you know, you don't want to pick one reason over another. Are there examples that you have in your own career? You talked about for the first 20 years, you didn't even look at what implied volatility was.
I didn't realize what implied volatility was.
So I'd be interested to just sort of anecdotally to hear your experience in.
No, that just came from doing so. Almost like think about it as a mechanic. You know, 30 years ago, you're talking about 25, 30 years ago when I was a floor trader, it was more like a mechanic when you'd bring your car in, he would listen to your car and he would say, you know what? I can tell a valve's not firing. And you, as the car driver who's been driving for the last 20 years, would say, I don't hear that. I thought it was the muffler. He goes, no, it's a valve. For sure, it's a valve. Today, you go in, they plug it in, and they go, oh, your valve's not firing. It's the third valve that's not firing. We got to fix that.
Right, and the robots do it.
That's kind of how far we've come. Now, I want to take that technology and give it to the retail investor, so the retail investor can say, yeah, you know what? This stock, I'm bullish on.
So you're saying 20 years ago, you were like, this market feels a little funny.
Of course.
And whereas now you can plug it in.
Time and time of doing it. Now you fast forward, you take the technology and you take the different things that you can use to find the trades, and all of a sudden you've got 20 years of experience and you've been doing it for a relatively small amount of time.
I mean, you were taking risk for the last 25 years when you were trading on the floor. And you were getting compensated.
I'm here too.
Yeah, right.
Sure.
Still right now.
Sure.
But the time that you want to take that risk is when nobody else wants that risk. And that's when implied volatility is really, really high, when people are afraid.
Right.
And just like this election we had 2 days ago, volatility was higher than it's been in the last quarter, easily.
Sure, but you guys talk about size and everything else like that. You got to put it all together. No one.
For sure.
No one reason
yes.
is the reason.
I don't want that to be the message.
You don't want the message to be that number 5 is the reason.
No, of course not.
If
Just because I'm here.
Just because you're here.
That's correct.
I mean, there's an interesting. The thing that occurred to me listening to you talk is, as I studied at one point, I learned to fly gliders. So it's like an airplane without an engine kind of a thing. And part of the teaching process, but it's like a fixed wing like thing. Part of the teaching, huh?
Piper Cup? They call them Piper
No,
Cup?
that's a single engine.
Oh,
This is literally a glider.
Gotcha.
It gets towed up, you click off, and then you fly your way back.
Gotcha.
And part of the teaching process, obviously they teach, there's instruments, right? How fast are you rising? With information, rising, falling, speed, whatever. But part of the teaching process is they take all the instruments in the glider and cover them and make you fly based on the sound of the air mass, the visual feel of your relative angle to the earth, all of that, as opposed to flying inside the cockpit reading numbers.
Sure.
And I do wonder whether our generation, or my generation and your generation, not to age you gentlemen, is actually a disservice because we don't have what you have.
Sure.
Right? Because we don't have the feel. There is. I wonder if there's less of a feel. You know, certainly, the argument with flight training is if you don't fly it on feel, you'll never learn to fly it on feel because you only fly based on the mechanics of the number.
Sure. Well, if everything were to shut down, it would probably be easier for me to make a trade than somebody who didn't have the technology here.
Right.
But somebody who has the technology here is going to be able to spot opportunity a lot sooner than I'm going to be able to spot opportunity.
Even if we cover the instruments.
Because when you start a trade, there is no even like IV number you can look at. Oh, this IV is 18% higher or low. You don't even have that. You just look at the option price to see that's higher or low.
It's just an option price.
It's kind of building up when you're trading more and more. So
you're like, that price is a little funkadelic.
That's correct.
Biggest place you can screw this up.
What do you mean by biggest place you can mess it up?
I mean,
size relative.
Because it sounds like what you're saying is, what I'm getting from you implicitly is the biggest way you screw this up is you abandon the other. You're
high implied
you get
volatility
bothered about
high IV can go higher and higher.
Right. Okay.
So it all comes down to the other tasty trade. Numbers you like,
which means
size
stay
is one
small.
of the
So the
first ones
biggest risk is you get yourself all heated up over a high IV.
That's correct.
You abandon your size. You abandon your liquidity.
You
because
abandon the other
look at
nine
this
mechanics.
Thing. Right. You abandon the other thing because you get seduced by the IV.
Sure.
So don't do that. Where are the camera?
Don't be seduced.
No matter how good it looks.
That's correct.
It's bad news. Kai's on the party couch. Jared's to my left. Johnny Cash over here. And the big guy, Tony Batista. Wisdom from the ages.
Pleasure working with you.
Pleasure to sit across the aisle from you, sir. We'll be back. Infinite reasons to be a tasty trader right after this. All right, welcome back. That was reason number 5 on our 10 reasons to be a tasty trader. Implied volatility is overstated. This is my verdict. Human nature is to overstate present fear of, that's a typo, future unknowns. this is applicable in the financial markets. It's also applicable to life. So it's to Jared's point, it can help you go to sleep at night, because if you're afraid, chances are you're more afraid. Your present fear of whatever you're afraid of, chances are, is worse than whatever you're afraid of actually is. Whether that's fear of death, or whether that's fear of Trump, or whether that's fear of Clinton, or whether that's fear of losing money, or whether that's fear of what your kids are gonna do, or whatever. The difference is, in this case, you can't make money on the overstated fear of what's going to happen to your children or whatever it may be. You can actually turn it into a profitable thing where you actually exploit that. And the market, to the markets, that's my second bullet point. Markets are the only thing that allow us to capitalize on human nature in this way, which, again, for me, makes this incredibly appealing. And the last thing I'll emphasize in the verdict is Tony's point, which is this can be very seductive. You can see huge implied volatility on something that you know can't possibly, you're like, there's no way this can possibly. And the risk with that is that it will seduce you to abandon your size restrictions and or your liquidity or any of the other reasons, to be honest. But liquidity and size are the first two things that go out the door when you get all hopped up on a situation like this. So don't do that like I have. It's bad. I'm Dylan Radigan. This has been 10 Reasons to be a Tasty Trader. Maybe it'll become infinite reasons to be a tasty trader. We can only hope. We take a break. We're back with more 10 Reasons to be a Tasty Trader. Rule number 6 right after this.
Hi, my name is Richard Rousseau, and in this video clip I'm going to prove to you without a shadow of a doubt that Forex is completely and utterly random. This revelation came to me about 3 months ago, in the end of 2014, and I finally managed to make this video clip now in 2015. Just to give you a little bit of background on myself, I'm a programmer, but also on the sideline had an internet cafe, and in this internet cafe the forex traders actually joined the cafe to do their forex trading, and that's how I was introduced to forex about 9 years ago. So as a programmer, I've liked the MetaTrader platform. I've been programming in it. I've programmed hundreds of strategies. I've written my own indicators, and I've also written a lot of robots. So please note that everything in here is my own opinion, and as I said, you won't find any clip like this anywhere on the internet. I've been searching for forex and randomness, but I haven't found anything like this, and I hope through this video clip I could actually at the end of the day save you a lot of money, maybe open your mind a little bit, reveal some amazing stuff to you, and at the end of the day prove to you also that forex is completely random. I would just like to quickly go over the content of this clip so that we're not wasting each other's time here. So yes, I'm going to spend 10 minutes and show you why people believe that the forex is not random, and then I'm going to spend 2 minutes on my punchline. So basically I would say the first 15 minutes of this video is the most important, and I'm going to show you an amazing punchline, but you need to watch the whole first 15 minutes at least. Then we're going to go to Excel, and I'm going to show you how to build your own forex model, or maybe prove to yourself what I've just shown you, but I don't want to spoil it now. Then I'm going to spend 30 minutes on disproving common indicators. For instance, support and resistance, trend lines, MACD, divergence, sweet spots, which is basically your zero lines, the Fibonacci, moving averages, and candle patterns. And I hope you understand that if I can disprove these ones, it basically means that any indicator that you could be using, the same principles apply. I mean, most indicators is basically something to do with moving averages, so that will basically disprove it doesn't matter what indicator you are using, the same principles will apply. Then I'm going to prove to you that forex is nothing more than the flipping of a coin, and I'm going to spend about 2 minutes on that. Next, I'm going to prove to you that trading forex and maybe trading pictures of mountain silhouettes is exactly the same thing. There's no difference. Then I'm going to give my opinion on why I believe forex is random, why it turned out to be random. And then I'm going to answer the big question: how about people that can show you positive accounts and graph?
Are you awake?
Yeah, I'm here.
Is it late night there, huh? It's late time there?
No, it's 3 o'clock in the afternoon here.
Oh, like 3 o'clock in the afternoon. That's not bad.
Yeah, I'm just watching this drama unfold at the moment. I don't know what, some sort of news or something must have come out, right?
Yeah, 10 o'clock they came out with a consumer sentiment. I guess people are kind of upset about the fact that they're sitting on a bunch of oil, but they can't use it. Kind of frustrating. Be like if you were sitting on a pile of money and you weren't allowed to spend it. It's kind of tough sledding there.
I've just been buying into this this USD CAD just because it's like pulling back into all them daily highs.
Oh yeah, ripped off the top.
Yeah. So it's kind of back to the prior resistance now on the daily. So I thought, well, it's probably worth buying into that, surely. So let's go. If we're kind of anticipating like triple top becoming a bottom.
I think I really wish I would have sold more at the top.
Are you sold into that big rally at the top?
Yesterday morning.
Oh, wow.
So I was also trading the NASDAQ. I went long NASDAQ at the apex of the triangle there and lost about $800. But, I mean, this trade was good. I had the buys on the, let's see, I'll go to the screen here. I'll put it on the Discord. Here, it's like dual sharing, so they don't sync together, I don't think, but yeah, just like this green chart, color money, my money chart.
Okay, so you bought, because it's good to know you're buying into it as well.
Well, I was going to buy, I didn't know how bad the news was, but fair value, I'd say I'm going to call fair value being, or the 50% pullback, that concept. If you take this box, and you cut that in half, there's plenty of places to buy and meander here. So the only trick is, okay, 8 hours for here. Well, the market's going to close, so I'm going to put a scalp in here like, let's risk 12 to make 8. High probability trade, got to cash. So this is kind of a drip down loss leader trade here. Let me put these orders in like this. Maybe risk 16 to make 12 down here. I'd actually, that's 8 hours from now. I don't know if we're going down there, but if we do a dippity-do, we ricochet off this. Otherwise, the thing to do is to stand in front of the train yesterday. This is a 100 pip grid, so you commit to about 120 pip stops. I just wrote these scripts for the swing traders, so here's here's a monster drop. Like, this is blow your mind shit. You trade this on the guppy. I'm going to drop this. That's the 6K. with a 120 pip stop, 80 pip range, a 6K. I know it says by 10, but it's not.
Yeah.
I mean,
Morning,
actually,
fellas.
it's 10 pips apart, and then it's
I know.
deeper. Hey, what's up? Are you ready for the weekend? Everybody's
me?
working for the weekend. That's the song.
Everyone's working for the weekend. Hey, Nick, I Victor's been in London all week. You guys couldn't hook up, but I even gave him a cigar to give you.
Oh shit! Yeah, to be honest, I've just been non-stop. I haven't even had a chance to trade much this week, so I haven't been on.
All good, man. We'll regroup in a couple months then, or whenever they get back to London. It's all good.
So yeah, I'm not expecting much from these buys. I'm not expecting it to kind of try and, especially on a Friday, take out that buy that they put it again yesterday. But I'll happily buy into the previous structure here.
I was laughing listening to these guys this morning. I never really listened to these guys, but these Tasty Trade guys, Thinkorswim creators.
They're pretty good.
Well, when they said surely the commodity markets are trending, let's go take a look. No, they don't trend either.
Nah.
There's no such thing as a trend.
What is this? One of these live rooms on
No, these Chicago guys, big traders, serious traders. They were talking about trading often and trading small, so that was a good. I have to agree with that. That's definitely the way to go.
Well, Tasty Trade, didn't they do Thinkorswim?
Yeah,
Didn't
the
they
guy
write
that invented, the guy that started it's talking in the video. They're a big guy, big Kahuna guy, big bruiser behind the desk.
What are you watching this on? What's it broadcasting on?
Oh, I already played it this morning. I started at 6:30 in the morning, so I've been playing it this whole morning. The beginning of the stream.
Oh, I see.
Yeah, so it was like, I never heard these guys talk about this. They trade often, trade small. Manage a trade. Because if you keep trading out of 50 trades, you'll probably win. Like you have to make it through maybe 20 losers or something. People just can't handle knocking on doors where people don't buy their shit. It's the hard part of life.
Yeah, I recognize that guy off that YouTube channel. I think Vinny did a video about him.
Yeah, Vinny was talking about how he was. I agree. They definitely know what they're talking about. Even if he is a big Thinkorswim guy, which he found that niche because he filled the gap between we don't give a fuck about you unless you're an institution and the retail guy. Scott Trade. I think Scott Trade is where I bought my penny stocks when I was a kid. I don't know if they still exist, but it was like $20 a trade. Now it's like free. You just show up to their platform and they'll just charge you like a minimal commission as long as you trade a lot. Cheaper by the dozen. That was a good idea to change to that model. Yeah,
I had a laugh watching that video you posted yesterday, the planetary trader.
Oh my God! It was It was suggested to me by YouTube. Now, you could say what you want about YouTube and their copyright issues. That algo's worth it. It's finding. It read my mind. Yeah, no, I clicked on some. I went down that rabbit hole. Next thing you know, I'm surprised. That. Like I said, I sat in a room. They passed a microphone to me for real. I drove to the other side of town. They passed a microphone, and I talked to this guy over Skype or something. And I asked him, do you use a line chart? I thought I'd blow his mind. I thought he was going to go, oh, my God, you do too? So, yeah, you like that on your salad? I do too. So, didn't work out. But he was committed to the if the moon's in the 7th house, you got to put on some old 60s stuff for that one.
I think it was like 10 minutes in or something like that. He's like, this is gonna look a bit busy on the day chart, and it just looks like the chart's on fire. He's got these like vertical swirly lines everywhere. Yeah, just a bit busy.
Yeah, did he put planets? I didn't watch the whole thing. I was about 5 minutes in, and I go, oh my God, like really, this is like real. This is like Scientology for traders. If a Scientologist was trading. Yeah, the thetans are down here. See that they put yours where the thetans are down here. The unwashed down here, the vacuum.
It's like to think they put so much programmatic effort into these kind of indicators, talking about the Venus price line. Lord.
I like the, how about the Golden Cross? Do you remember this is about, I made fun of this. I did a video 5 years ago. This guy from, he sells silver, you know, can't remember his name. Big guy on the internet, big guy in the world, you know, big persona, you know. And he's talking this and that. And he goes, it's the death cross. The 200 cross is the 100 stock market. This is 5 years ago when, you know, the market was supposed to crash. Then Trump came along and said, we're just going to deregulate everything and go back to capitalism. The market just went fucking bonkers because of zero interest rates. It was free sailing, you know. And then everybody's like,
But then everything got a bit overheated, didn't it?
Well, not really. What happened there, I think, was so I would have to say Trump kind of set up these guys for failure in the sense that he walked away with the books balanced based on nearly zero interest rates. Now, we'll pay that off because we'll make so much fucking GDP because you make more tax money comes in when you lower taxes. So this is a laugher's curve, you know. And so we all know that one. So, but yeah, Trump was he did the best he could, but I think these people are so fucking overly woke. I think they're just going to drive it off a cliff and blow themselves up. They're going to get the Darwin Award for being the dumbest politicians on the planet. I mean, they're not even helping. You know, it's like
they looked at everyone on his cabinet. The average is 2.4 years of actual business experience, where Trump had about 12, 13 years for the people surrounding.
Yeah, even the people he fired, he brought people in based on, this guy knows a lot of shit. What's really funny is the United States, I think, still has, they don't talk about it, but the U.S. Postal Director, or whatever, the chairman board, that's Trump elected that guy just before, and that was supposed to be, that guy was going to rig the election. And it turns out, guess what? He's like still there. And he's probably making them. I got my mail instantly now. I've never had the mail be so good. I hate to say this. I've never had the U.S. Post Office be so fucking good. That is one thing that Trump straightened out big time. Looks like we're doing a little bounce house here on the dollar CAD into the close at 10:30. But look at the 4 hour. You're dipping into that big pool of tickets. So I'm under trading. I say after this guy was criticizing the fact that I lost $1,300 yesterday. He's going, well, you had bad trading day. I was like, yeah. I said, what? Dude, I'm sitting there writing $200 stops on single drops, and the market's crashing. Probably the biggest sell-off in NASDAQ other than 2 days ago. Like, it's fucking vicious. Look at this, the dollar CAD. So I marked this off yesterday on the beginning of the stream. I said, look at this. We're selling up into this shelf way the fuck up here in these top tick Tommyville of this wedge thing here, and it went right to, so if you martingaled into that, a lot of people aren't doing this trade, but right at the 100-yard line, you're up 200 pips almost, just smacking off. I mean, you just have to trade with wide stops, but that trade was obvious. I showed that yesterday morning. So yeah. I'm selling into that fucker. Now, I would have made money, but I had in the background is running NASDAQ, and NASDAQ's dropping literally 300. Look at the chart. So you don't just look at the chart and look at ripping all the way back into the floor now, coming back into Sunday's price. So the market has been. So I actually made money on this rip. I actually made money. I ended up at $3,500 buying this smack. But when this came down, here's the apex of the triangle. If you remember, in the chart, I was picking out this 15-minute triangle apex, and everybody knew it was coming, right? So it goes way back to, well, I'm talking about the triangle here, right? I don't know if you can see that one, but let's zoom in.
Okay, yeah.
So, I mean, this is just a lack of volatility, and you're cordoning it off with line charts. It's very easy to draw. Like, if you can't find the triangle, then I guess you're just not a visual trader, but it's a depiction of a doji forming. The triangle is just a flag or a doji. So how is that going to resolve? And it was getting very tense, most tensest. And here comes the I think the Dow Jones opens, it smacks down. And if you weren't in that trade, you would have had to pile your. So here's your lonely wick on the 30-minute. You'd have to pile your bank in here, which I didn't have. Like I just wrote these 200 pip stops. So if I would have bought with 120 pip stops all the way to, well, there, and then, you know, if you have enough money, certainly you want to buy down here just in case. But if you commit to just the box only and you start to fill based on this and give yourself 12-hour expirations maybe on these tickets. I can't get this fucking object to activate, so. Oh, fuck. We'll just start over. There's too many objects on the screen. So right here, if you're committed to buying that and you cash out, so that's about a 120 pip window, banging off these round numbers, and then you cash out at the top of that box, you made money, right? So if you go for the full auction, which is, we're going to take out the high of the day now. This is the lonely wick on the top side of that vacuum, and so you could probably safely say, well, there'll be sellers galore in that box, and I guess you could have traded that box. Now, maybe that's not your target range. Here's Top Dick Tommy, right in that window. So in that window from this guy, you really need two boxes in there to make it proper. So this big supply now. You know, Top Tick Tommy right now, right? So sellers galore, and now you're coming up on, it's just insane how this thing just keeps cleaning out people that, now you could just put the sell limit grid in here, which I don't have one, so I just put single drops for now.
So, just asking for a friend.
Here's $100.
Do you buy 1,000 NASDAQs? Like, how do you actually size this thing? I mean, I'm just trying to understand the
okay, so here's,
the
so here's, $50 to make $100 if the market can come up here. It's more realistic. We're going to smack up at the close. So let's put some scalps in. Let's risk $40 to make $30 in 2 hours. The market
shorting
has
now?
Yeah, everything above is a short. Everything below is a buy. So if I drop it below, it's a buy. Above is a short. So this is very simple.
Okay.
There's nothing to.
But how much is the actual number of NASDAQs that you're buying? I understand the 50 to make 80. It's 1,000 of them?
1,000. 0.01, a micro lot. In other words, it's going to cost me
0.01 of one full NASDAQ contract.
It's going to cost me $60 in margin. The leverage is 50 to 1.
Gotcha.
It's going to cost me. I'll be down right when I get filled. I'll be down the spread $1.12.
Dude, I put in 100. I had no idea, and it made like 8 G's in 5 minutes while we were just talking. I'm like, what's going on over here? My numbers are all wrong, incorrect.
No, they start all platforms start with 0.01, which is a standard lot. That's $100,000 position. So, yeah, the platforms in MetaTrader, at least I don't know what you're doing, but that's the default. So if I want to buy a pullback here for a dead cat bounce, so we're pulling back off the supply zone. This is NASDAQ 15-minute chart. This is $10. Each handle here is $10.
Right.
This is a 2-hour buy limit. I'm risking 30 to make 20 if it plays out. There's my stop. I'm risking more than I'm going to make for 2 hours. I could put them here. I could put them on the Fibonacci's. There's a Fibonacci down here. I'm risking $90 to make potentially. Not even that, $40 coming back up. So these are loss leaders, right? Bad ratios, high probability. As simple as that.
Okay.
So you're sitting here. You're on the which time frame? What structure? Can you see this trade happening? This is the 1-hour chart. Depends what vacuum you're trying to. So here I'd have to say, well, 2 hours might be a little aggressive here. Let's take off this ticket. So you just keep. It's like landscaping. Oh, that's a little too tight. Okay, put this in here. Move this down. Like, once you start looking at the 15, you're like, shit, this thing could go ripping back to this box and then rip up into here. So what's possible? If you look at this chart here, like the 15-minute chart, like how are you going to place your trades in there? So you just have to find the supply and demand zones and mark off this. You could have scalped this for $50 bounce. You know, this is just 1K. You could have made $30 here. 2Ks, $30 on that dead cat bounce. Re-rack. Say I'm going to buy everything from here down.
That's pretty amazing on just like such a small amount to make $30.
Oh my God, this trade here, if this actually happened and I was still in these tickets, do you realize I'd be up about $3,000 on 3K here with the
Yeah, that's the part I was going to say. I mean, if you walk away from it and then look at it again and you have those tickets filled and you got out at where you got in kind of routine, you're really far ahead with just using a small amount. I don't know how it works on the trading view. I just put 100. I had no idea what I was doing, obviously. And
well, size does matter. Size matters even
size. It has to be as small as possible. That's why I'm trying to understand it when I'm looking between two different platforms. So it's making a. So I would put one NASDAQ on the trading view because it's got 100 to 1, let's say, on a leverage.
Is
so
it
that
really
would
100
be,
to 1?
I believe it is.
It should be $30 then for your margin requirement. $30.
Okay. I'll try to
So
figure that out.
you try to get a micro lot or a nano lot. I noticed the other broker took the Bitcoin and decimaled it out so bad that I can't run any scripts on it. So they took it. The broker wanted to make it so that you could trade there.
Right.
And so their micro lot is priced into Bitcoin as if like I'm not sure how to even put a trade on there, or if you even can. I'm not even sure. I don't trade Bitcoin, so I'm not worried about it. There's plenty of money to be made and lost. And, well, NASDAQ, like I said, if I would have thought about it, unfortunately, I was trading with a 20-pip stop, which you can see here is ridiculous. If you look at the 5-minute NASDAQ, I mean, this thing could pull back into these limits here easily by the end of the day.
Sure.
So, really, and then are you going to sit there with your finger on the trigger? So if they don't smash down, yeah, it's a lot of money. I can't believe. Look at this 30-minute. Look how deep this market is on 30-minute chart. So you took out the high. You just took out the high of 2 days ago, and it's pulling back. People are up $20 on that already per 1K. It's unbelievable. So the kind of like the high risk trade is to put orders down here. This is $50 to make $50. This is $50 to make 50. Now I don't have the 200 to make 400. But you can see that if you put a 200 to make 4 down here and you could wait another day, you made 400, 500 pips here. I'm talking $500 per 1K. It's $100 on each of these black lines. So the spread's not bad considering how this vicious this market is. So yeah, and here's the kind of the low risk. These should have wider stops too. This is 30 to make 30. That's a half-hour expiration. So now that one is based on a fast market. Market's dropping really fast. Grab this half hour. If a market can get there in a half hour, probably won't last, right? Just like this. When you see this wick, it meant that within a half an hour, if you loaded the wagon here on everything down here and down here, and you had drops down there that lasted a half hour or less, they got filled, or more, half hour or more. So if these guys expire at the end of the day, you would have had to absorb that much fill. That's going to be an 8K, $80. So that's $80 per ticket with a 100 pip stop. So $800 to make what? I don't know, $2,000 there. Getting out right now. So if you don't want to get too close to the market, I'd say put these half hours in, and you're just going to basically, that's what I want my robot to do, is come in with the half hours when the market's quiet, trade close to the market looking for some spike. And on the top side, I don't think I would, I think it's going to rip up there. So it really depends what you're expecting. So structure-wise here, we know this is the big-ass lonely wick up here. I feel confident I could put orders up there. But then when you go to the 4 hour, you're like, well, this thing could just go ripping out right into the Asian session. So here's where it all started. So I've seen this cliche where the market is, you end up with a weekly hammer because the market literally opened here and closes here. Look how fast the retrace is. So it's kind of dipping down. It keeps cleaning house there. Keeps taking out all of the supply. And finally, here's the retest argument. Oh, they retested it again, and here's the channel. The timing argument is the channel that you could draw. Oh, I'm just going to draw your classic time walk down channel here, right? So you're claiming momentum channel here, perfect walk down. But, you know, it's all about me. It's all about buying this area, even though that is kind of cute how that all lines up. But now the argument is this is the last price pulse, screaming back to the floor. The market closed unchanged for the week, and everybody's heads exploded because anybody that has stop, right? Anybody who has stop in there is wiped out. And anybody that was on either side, you either cashed out or you didn't get out. The guys that didn't get out, they're like, "Fuck, we were so up on that trade. Why don't we get out?"
Yep.
The guys that were on the wrong side who bought too much, they're like, "Holy shit, the market's deeper than I thought." I mean, I can imagine all the losing traders kind of gripes, you know, about like auction trading is just like, look how in the end, where's this market really going? So if you, this is why there is no trend. There is no trend. See how we're back to here now. What have you done all week with your life? Mr.
Nothing.
NASDAQ.
It's gone up and down.
I've done nothing with my life.
This
is, I think, called a stagflation. It's like big stagflation here. Stagflation. Structurally speaking, like we just gone nowhere. We fell through the floor back there. So way back here, like this thing's been, well, on the monthly, it is kind of scary. It's kind of funny how, do you think trees grow to the sky or something? There was a hammer here. There's a classic hammer, inverted hammer, then a doji. And look at this gap. I mean, this is literally the most ultimate climax to any market you've ever seen in your life, NASDAQ.
Right.
But now it's back to the starting gate from fucking 2 years ago. It's just mind-blowing. These poor people. And then again, they see a trend. I'll show you how trend lines got broke there. Now, is this too steep a trend? This is the rollover that I figured that this is what Cardwell was doing with RSI. So this is the breakover. This is I did this on gold 10 years ago.
Okay.
I have another channel on YouTube I forgot about, but it's really old. It's like when I started trading. Somebody says, "Is that you?" I said, "Yeah." So here's the crossover. In RSI, you get the crossover first. So it's definitely divergence there. You know that because it's coming away. Divergence, all you need to do is get divergence. Just draw this line. So once it starts to diverge against the last known projection, which is the last known price pulse, if you connect these two price pulses, it's not hitting targets. That's your first divergence. So you didn't have to do RSI to figure that out, right? So this is failed targets. Then the first rollover. But now, I mean, the guys that are heavy hitters, I'm sure they're gobbling these prices up because if you only come back to here, it's a great trade.
You still did good. Yeah, you made bank.
So it's always about that, right? So these guys today were talking about, hey, just get it out of the market, you know. Just take the money.
Yeah, make
and
it, take it. I've always.
That's what
I've
they were
always
talking
lived by
about
that.
today. So
Yeah, make it and take it, man.
yeah, you gotta make it.
Small orders, thousands of them, and you're going to have probability in your favor. And that is actually mathematically correct. I mean, they're not.
So here,
they're
looks
not
like I'm going to
blowing
get filled finally on this. I'm getting filled. Look at this. So I'm standing in front of the market here.
Okay.
I should probably pluck that ticket off, but fuck them. I should pull that ticket back. Looks like I can get overfilled here a little bit. I'll put some half-hour ones in. So this is the kind of thing the robot could do for me, is that this time of day or any time of day, really, he's constantly trolling for this little flash crash. Of course, it's more prominent to happen when the news comes out or like this kind of stuff. And, of course, it's take the money and run's proven on this chart all day long, I think, you know, how that's painfully obvious. You got to get out. NASDAQ, you just got to get the fuck out. And on the 1 minute chart, you can really make a living on the 1 minute chart, but you got to be super fast. Like, see how close I'm a little too close on that ticket. So I can pluck that ticket off before they fill me. I'd rather buy it below the 100-yard line, so on the with the handles I can see the 100-yard line, even though I'm on the 1 minute chart. So anything below there, I think, is a cool buy for some kind of wackadoodle. Here's a re-rack. You know, you could have just put a 1 minute chart. You put a plunge ticket team in there. That's $3K coming back. I mean, Jesus, that's $100. That's $300. risking 150 to make 300 there easily, right? You're buying every
All day long.
$10
Yeah, I'll
handle
do it.
and you're cashing out. You don't even have to take that whole price pulse. I mean, the market is so insane. I've never seen a market so
Too tough. It's tough. Yeah, it's
well,
very
you got to
crazy.
trade. No, you got to risk $100 to make $50. I mean, you got to say,
Right.
I'll put 3Ks. I'll risk $300. I'll put a 3K every $10. So that wouldn't be that bad, actually. You just got to plan it out. That's all. So you can say, I'm going to put a K here, and I will get filled on 2K maybe. I can go fill on 1K. Or I got a K here. I got a K here. This one's $50. They're both break evens. Hey, I made $50.
Right.
You made your 50. I
No.
guarantee you made 50 because I can count 50 skinny lines to here.
Correct.
So really, it's about the art of the drop. So if you're going to do a bad ratio and risk 40 to make 20, here's risk 30 to make 20 for 2 hours right down here. This is the 1 minute chart, by the way. So, but if you slam into this, which you've seen this a million times, right?
Right.
And this is what you're doing all day long. If you're trying to mine the shelves and the voids on the 1 minute chart, it's very well. Look at this. I mean, this is a big, giant crush, and when you see that coming in, because you prepared and actually can make the top bottom argument from here down.
Right.
This top become a bottom, but I'm going to give it a little more, because
Gonna give
otherwise
it
you
some wiggle
get
room.
otherwise you're going to
Yeah.
miss these wicks. So a robot on the NASDAQ's going to have to be assessing like the 5 minute chart. So the 5 minute robot's going to throw stuff out there. The 5 minute structure looks a little bit boring compared to that. But, we know, visually we know these are the supply zones left over for the rest of the day. But I'm actually going to aggressively buy into this 100 pip vault. But I put 50 pips and I put here's a 200 pip stop to make 120. Now, I'd put that down deep, right? So you have to pick all these according to some kind of frame of logic. People that play, what is it, over there in Israel, they play, is it backgammon or something? No, they play something in the street there with these. And I'm like, Jesus Christ, people. Rolling the dice and on and on. Just trade forex, for God's sakes. Just trade NASDAQ with these drops. Is it backgammon? Is that the
Be a lot
game?
more fun for you. Agreed.
Yeah, so I don't think I can. I mean, well, I think I can always blow up the account if I overload. I don't really know what I'm risking here, but I think I put at least $1,000 of risk out here just now easily. But like I said, some of these are 30-minute expirations, and that's the trick. 30-minute expirations deep. Okay, I'm getting filled right now. Just picked up a ticket.
Oh, you can. I mean, just based on what I've seen in limited amount of time on NASDAQ,
just picked up a ticket.
You could look at 11 o'clock till 11:30 as a little guidepost, and you know that the London traders are going to get cock blocked by all the New York traders, because New York runs NASDAQ, not the Europeans, so they can smash it down to not let them go out with as much profit as they thought they were going to make from let's say the daily high, and then they'll take over it by 11:30. Then Bob's your uncle. They'll take it over to see which way they want to take it. I think that's really the handoff is an important section of the day, like the Asian session and like all these different sessions. I think it's important to know about the human element. That's just me.
Yeah, the cash market is the human emotional element. People are very skittish. There's a lot of orders coming in and out. It's like I said, coming all the way back to the opening of the week. Pretty amazing. It's certainly a bullish pattern if you think that weekly hammers. But then again, you could just retap the wick on Monday next week and make the same amount of money.
Mm-hmm.
So the idea that this is the entry or the end of candlestick or after the engulfing pattern, I got confirmation. Well, come on. I mean, the only way to really is to have that short-term trade plan and long-term trade plans if you want to really be efficient. But this trade's working out, so I'm up about $17 here. I'm in 3K,
Okay.
so
All right.
it's kind of blended. So I just cashed out of something right there, auto cashed out. 1 minute chart, cashing out. We dipped into that box. That was enough.
Nice.
So I can just pull these off. Oh, I gotta accept one-click trading there.
Yeah, take the money and run.
So if I take the money and run, now I just got one guy floating. So I'm scaling out. Now because I scaled out, I want to buy some more on that 30-minute
Want to buy
ticket.
more a little bit closer, or maybe we'll go market? I don't know.
Actually, no, a little bit if it goes lower. So here's when you make money on a trade, come back and trade lighter, actually, I think.
Okay.
So kind of come back and just say, what if they smash it down? Like, because I still got all that exposure pending below me.
Right.
So it was very hard to impress that guy yesterday because, I would have had to, like, this is the 1 minute chart. So just try to imagine when you get into this trade here and you're waiting for them to crush this supply. So the supply and demand zones are just so fucking crazy here. Like, this is the lonely wick people are selling into, don't forget, to cash out down to here. So that's why getting out of that trade is like, you had to get out because it looks like we could just come down here again and start crushing lower the rest of the day and just come after this lonely wick. If they come after that, I'm going to make some money, but I could also get overfilled because I put so many here. So if I think I'm getting, I changed the indicators so you can see there's a hot spot there. So some of those might be half hours. I suppose you can make different. If you really cared, you could make different color arrows for like if it's a really big ticket, maybe it's yellow. You can do anything you want as far as what that arrow is. It's right now it's black, but so if you really cared, I'm talking about if you really cared, you would do stuff like that. Now I'm just going to hold this one because this might make like $30. It's only got to come up to here now. Take out this. This is the 1 minute supply. So I can't believe I'm looking at a 1 minute chart. You know what I'm saying?
That's a lot of activity.
It's
man, for
crazy,
sure.
but no, it's very. Look at that! Look at that oil came all the way back to the floor, and that was like the bottom tick Bobby.
Right.
Another headshot on the 4-hour, amazing 4-hour crude. Wow, just mind blowing. That's another market. Look at this feeding frenzy down in this, just all the way down to this low from how long ago? And it's a $10 window of smashing crap down here.
Wow.
So who's really got these tickets? So these are the tickets I'm talking about. Like, you get filled. You wish you would have bought $1 zillion of crude there, but see,
It's always
it's
like that.
cleaning out.
It's
No,
always
but
like
but no, this is where all the stop hunting's going on. Liquidity here. Here's a lonely wick and a shelf. Here's the other lonely wick and a shelf. See how this one's deeper? We never made it down here, but I'm sure that they were hoping and praying.
Right.
The people that have tickets down here are like, dude, take it down there in one day. So the feeding frenzy, same thing on the top side. Once you hit this lonely wick, it's like, holy shit. And it doesn't take out the top. That's $124 a barrel up there. That's like it. I'm like, holy shit. And then, not to mention the good old-fashioned trend lines.
Right.
People are looking at this shit going, well, that looks like we broke that trend line. You certainly broke this one. So here's the breakover, pullback, fine resistance. Trend lines only work on close. And they would just keep moving. I did a video once like this where I kept putting in trend lines, and the guy goes, it looks like a Gann fan. And I go, that's what Gann was trying to do, I think, is say, well, see the rollover? Everything, if you attach it to here, as you walk down the stairs, the rollover keeps changing as the market gets more and more down. So here's the
It actually does look like a fan.
Yeah, it's like a Gann fan. So if you keep anchoring your trade here, then the next idea is we're going to break this trend line. But at some point, the other one takes over, right? How long can this trend keep going down? The guy from Britain said it looked like antennas. He goes, you're putting all those antennas on there. I go, yeah, I know. So you can just make your own pitchfork out of these, if you just copy them over. But it's just giving you a place and space to hang your hat and say, oh, well, I could see it getting up into that box. But the floor right now is just on just pure wicks is here. The closing, that's the big floor. The closing floor is here. I think a lot of people have already scalped out of that trade, that oil. And maybe oil's doomed on the dailies, you know what I mean? So, I mean, not doomed, but certainly that weekly smash was that kind of cut in, and maybe that's over because the weekly got cut, you know. So that weekly big supply thing here, all those wicks got smashed. So maybe crude is in the long run. It's not that there's not trends, but it's like, what good would it be to not get out of these climax moves, even though you think this is an uptrend? You know, it's so crazy.
No, you have to take the money, man. I mean,
this is insanity. You can make the argument.
I'm getting the sense that a lot of the younger traders are, even with the techniques and stuff and methods that you're showing them, they're still trying to make $7,000 a trade. You know, like, it's like, whoa, hang on a second. You don't have $140,000 to make $7,000 a trade. So get over it. If you got 500, a nickel, 250, 100, there's all these 5,000 brokers all over the universe that'll let you trade to your heart's content. Doesn't mean you should trade to your heart's content in every single trade. You have to pick your spots. You got to pick your traps. So what the hell are they doing? I have no idea what they're doing. I mean, the trading is a long-term game. Lots of small positions. And then the probabilities do work in your favor. And if you have good probabilities, I mean, we spent a couple hours looking at those bots that are given away for free that are doing better than the one that costs $17,000 a minute. I mean, come on, right?
I just watched.
If you're going to do a string of 100 trades and you're going to win 60 of them, well, you better have a 1-to-1 ratio. If you're going to win 80 of them, then you can go a little bit underneath, you know, risk 40 to make 30. And I think with your methodology, I mean, you were farting around and you got 0.2. So right away you're like, yeah, I'd rather be more accurate and risk a little bit more to make a little bit less. I think that, for me, the math works better in my head. But maybe for other people, they just want to keep going. I don't understand it, but, you know, who am I? I just got here.
Oh, I don't know. There's a million people out there. I don't like to assume anything about people, but, you know, we have to make some assumptions. That the mob, you know, supposedly 90% of traders lose money. I'm trading, but 90% of musicians aren't rock stars, at least. At least. Locally famous, maybe, right?
Not even.
I'd say, in other words, I'd say that 10% of the people are famous. Like, I'm sure that if a local, like, I just watched this band called something in the smoking section. It's called Smoking Section Band. Oh my God, these people are so fucking talented. They're like two Chicagos together, like Chicago tight, like
nice.
Band Chicago. Horn section.
Forgive me. I want to hear about that. Hold that thought. I'll be about 10 minutes because I gotta go get the lady from her swimming class. Or she's gonna start crying that I didn't get there on time. So give me about 10.
Go to jail. I'm up $16 on this trade. Anyways. Okay. I got the wrong screen up here.
I know to get my hands burnt with this USD CAD at the moment. Don't know how deep you go here.
Yeah, so this CAD's beating you up, huh?
I took scalped out for a little bit on the first bounce. I put some more tickets in a bit lower down now because I don't want to kind of refill at the same prices.
Yeah, I mean, it looks good structurally, but the problem is the market's kind of going to close in about 3 hours.
Exactly, yeah. It's not the same trade anymore.
Right, I think the trade was really the burst into the upper thing, and the sell was the only way I could imagine that. Just like the buy on the Australian dollar was kind of an inverted version. Australian dollar buy.
I was buying some Australian dollars this week.
Yeah, because it got trapped under the floor, and I thought, well, that's going to be the counter opposite, and when I saw the Canadian had that giant vacuum staring it down, more than the New Zealand dollar fell in the hole too. So both New Zealand and they usually run opposite a CAD, but it's not a perfect world, for that kind of what do they call it? When things match up like that.
Correlation. Though.
Yeah, I mean, because dollar Swiss against euro to the dollar. Almost a mirror image, but not always, because certainly not during the depegging. So things aren't really perfect like that. But if you're going to have a buy only system, so if you have a buy only system and you're buying dollar yen and buying the dollar to the euro, then there's probably more trading opportunities per week. If you're only buying if you're only a buyer in the market, but you pick the pairs like dollar yen and euro to the dollar. Stuff like that.
Yeah, sure.
Or I have one where I trade euro to the pound and euro to the dollar. So euro to the pound, I get a tight spread. And it's a tighter spread other than the euros. Because it's the euro, but completely different trade, A lot more bizarre range trading and just psycho moves, which you would just get blown out of naturally on the... I think I'm going to cash out this ticket. $26 coming into the sell window on the 1 minute chart, NASDAQ. I'll make $100. So yeah, it's crazy, huh? So they're gonna wrap it up.
Sure.
You guys
I haven't
gonna
really
have
looked at euro much recently, just because it's crazy going down.
Oh no, it's complete obliteration. But to me, it's like I'm gonna be buying that next week when it comes down about 25 pips. Actually, I'm just range trading it. Been range trading it all week, but I must say, for the big picture people, they're looking at the daily going, holy shit, that is like on the weekly, it's just mind blowing. I mean, you're literally 300 pips below the floor of the year. It's like in no man's land. But
it's been the same with the British pound too. It's been crazy, the line in it. I'm not even sure that we're gonna go and hunt that see that big spike low on the British pound on the daily. We're just gonna
holy shit,
make our way down there.
I think all these things are just gonna meander. It's terrible to think about. I'd buy the pound right now if it came down. I'm gonna put it. In fact, if the market was gonna stay open for 2 more days straight, if this was Wednesday, I'd be buying right here in a column. I think this is a 20 pip grid, so I'd be buying 20 to 40 pips deep into the close, maybe get that cap bounce here. Because the sellers came in right at the top of Asia there. They're up about 20 pips right now. The people that sell this vacuum that existed above Asia, going back to that shelf, way back machine here. Yeah, I'm supposed to be on that chart. Okay. Got such a lag on the internet. Oh well. I guess the buffers fell up and all that shit. Supposed to be on this screen. So you're looking at the same thing. Let me see. Yeah, that's the chart. Yeah, the internet's really late. But anyways, the seller window is there. Like if you're just going to do supply and demand, that's the 1 hour chart. The 1 hour supply and demand is a pretty active trader, I think. This idea of buying the wicks on a 4 hour chart, yeah, sure looks cool in hindsight, but you waited 2 weeks for that fucking trade. So, supply and demand on the 1 hour is kind of like here's a top tick, Tommy, right in Australian dollar. You just took out the high from 2 days ago. These guys are up like what, $10.
I remember that the guy who did that video, the top tick Tommy, the guy doing the crayon drawing. I remember looking kind of who made that video. He's still he posts regularly on Twitter. He's like a
Does he really?
pit trader or something like that.
Really?
Yeah. He posts charts daily on Twitter.
Oh my God. Yeah, the supply and demand stuff, so people think it doesn't work because that Sam Seiden or something he lost money or I don't know. So whether somebody loses money doesn't mean that it doesn't work. Like position sizing works and frequency of trading works. All that stuff works. I'm actually slightly up on this Canadian dollar trade. It's probably worth 10 pips into the close. That's about it. In other words, the kind of scramble, like to me, the target's going to have to be on the 1 hour. It's going to be like just this little thing here, this little notch, I see. Well, how many pips is that? What is that? Maybe 15 pips up. Certainly, I wish it would come smashing back to this round handle here, but I don't think that's happening. But here's your classic.
I think it's too late in the week.
So here's your classic. If you got the scripts lined up tight here in Asia, that would be your sell window. And the spreads are pretty tight in here. So these pockets. The problem is these pockets change size. Like if you're going to buy this vault, that's a completely different trade price than selling Asian top tick Tommy here, where they make a fake breakout in the 4 hours, but you're filling this little void, and then bye-bye, you fall through the floor, bye-bye, you're done. Like, who couldn't see that coming? But you had to wait. If you got short on the 4 hour, you had to wait for this to collapse. If you sold that wick up there, then you're a super deep swing trader, and you're up almost 200 pips right now, selling at the 100 year almost. If you sold above that round, if you put a cluster up in there, so it's really trade location, order placement is the big holy grail, so to speak, because if you know where the supply and demand zones are, you just put a crop of tickets in like a window of 100 pips here. You would have made 100 pips out of that box. Here's where you're going to get killed. If you can't see the big vacuums, they're going to blow your brains out. You can't put orders on the top of this. I got that this is a lonely wick, but look where you're at. You're underneath. Like, don't forget the people that have bought so much shit under the floor here. You can't stand in their way. I don't know how to describe it. But at some point, right, this trend's going to end. This perfect trend. It's got to end, man. This is like that, I'm sure you've been with these people, women, whatever. And you're like, this girl, man, everything's perfect, and you're like, uh-oh, she demands to take my boots off when I come home. Ruh-roh. we got a live wire. We got a problem. Hey, lady, what the fuck? You're hot, but I think you have issues. I don't even know if we're going to be able to talk for the rest of the day. I think I'm going to have to go right now. I think I hear my mom calling me. Come on, Johnny. She's crazy. She's crazy. But she's hot. Crazy hot. Crazy hot. I'm going to put some outlandish Ross leaders
ringing in the distance.
Right, you hear that fucking, even you hear that British siren. That thing that sounds like
the DJ sound.
Yeah, everything. You hear fucking dive. Oh, ooga horns from fucking truckers with bugs in their teeth. Even you give me some of that good old fashioned, dude. There was a time about 5 years ago I was addicted to watching the reruns of. It's going to come up on my suggestion, but just by me saying it on the stream. But I'm going to say it. Charles Bronson, Death Wish. The Death Wish, man, I'm a Death Wish trader. A Death Wish forex, man. I love that. I'm a vigilante limit entry guy. I just crave that. Give me some popcorn and some, like the whole reel. Because of YouTube, people are putting like 10 hours of police files up and stuff. They're posting it now. It's insane. NASDAQ's knocking on heaven's door here. Look at that thing. It's coming after me. Stops. My limits. Got limits way up in Disneyland. Reaching into the northern abyss. Come on, people. Step away from the trading platforms. So here's a nice $500 move on a 1K. If you bought this trap, You can only trade about a 5K there with this account. The size of this account. So when you're building these, when you go to trade a new market, never forget that on the daily charts, here, look at this drop. So there's probably somebody who bought everything in this box, some deep pocket person. And, or they bought here, this would be the prime real estate. I'm sure everybody's hoping for the market to take this out and continue on its merry ways if nothing happened. Nothing to see here. On the weekly, it looks more possible. On the weekly analysis of NASDAQ. Holy shit. Wow. It's just down to these, so deep. I put some outlandish tickets up here. I don't think they're going to fill, but we'll put them in anyways. Just for the exercise. Let's try these 100 pip stops. 100 to make 60. $80 to make 60. Let's stand in front of the train now to the upside. Top tick Tommy. Break evens. $100 stops. Canadians should be dropping as stocks go up. Put a big rack in here and like 5K right now. 5K of the CAD dropping into the trap.
Graphs and say, well, look at our accounts, look how well we're doing. So how can forex be random? So I want to give my opinion on that. I'm going to talk 2 minutes about binary options, and then I'm going to talk about Warren Buffett and a statement that I read about him that he made, and very interesting. I'm going to talk a little bit about optimization of trading robots and how you can be deceived by them. I'm going to make my final end statement, and then lastly I'm going to talk a little bit about forex statistics, and at the end of the day I would like people to post back to this clip, maybe say yes they agree or they disagree. Maybe I'm looking for people that's working in forex companies to maybe give us the real statistics of how many people are actually making it in forex. The common theory out there is that 10% are making it and 90% not, but I believe that statistics is completely skew. I won't be surprised if it's like 1% or 0.1% or 0.01%. So I hope you enjoy this clip, enjoy, and I hope it can be a revelation to you as it has been to me. 5 to 10 minutes to just go through some principles why people believe that the forex market isn't random. So in lesson 101 about forex, I was told that the forex move in waves, so you'll get an up movement and a retracement and an up and a retracement, and at some point it will break the previous low here, so you'll get this down movement and a retracement, down retracement, down retracement, and down again. So it does seem like the forex market does move in wave patterns. I'm just going to add a few indicators that a lot of people use. I'm going to start with a simple trend line. Normally you connect a low point with a low point, so I'm going to connect those 2 points, maybe like that. and it once you connect it, it does seem like the market tried to break the trend line. It was a failed attempt, and the people are saying this should the market now went up because of that. It tried almost here again, but eventually this is a typical move where you get a candle breaking the trend line. It goes down, and then this trend line used to be support this market for up. At this moment in time here, it becomes a resistance line. So this up here, it was resisted by this line, or you could say this line is giving a support for this for the market to go down here. So I'm just going to draw another trend line in this down move here. So I'm connecting those 2 points, and as you can see, the market is now in a down move. So those are trend lines. Another indicator that a lot of people use is the I call it parallel lines. I'm just going to delete this one, and it's just a little bit of advancement of a trend line, or maybe just a channel. So yes, let's connect those 2 points again, but this time I'm going to take this point here and connect it to that high of that candle here. And as you can clearly see, the market seemed to move within a channel. So it went up almost to the channel, back to the channel, up to the channel, back to the channel, up to the channel, and finally it broke the channel, which was the same line as my trend line that I drew earlier. So these channels are formed on all the time frames, and very interesting. A lot of times you get channels within channels. I'm quickly going to go to the daily and maybe just draw a channel here. Maybe like that.
The band sounded like Chicago. That's where I left it with you.
If you go back, you'll see that there's a channel down within a channel, and obviously there's most likely a channel here.
Yeah, they're pretty amazing. So just amazing. They play with Michael McDonald, and I mean, just they play What Is Hip, and there's like 20 guys on stage playing What Is Hip with the tightest bass line. I mean, just you just can't believe it. I mean, it's just, and that it's like 6 years ago or something like that, and that's all they have. They're gone. I don't even know. I was looking for some more of them playing. There's some bootlegs of them playing, but yeah, it's amazing. So tight, just so good. I mean, of course, I fell down a rabbit hole of watching the Michael McDonald kind of all the places he's sung, all the albums he's sung on. It's just amazing.
He's pretty kick-ass.
Started off with Katie Lied with Steely Dan and went all the way through all that. Doobie Brothers stuff is just mind-blowing. They had some guy was sick. He like, hey, you want to fill in and sing? Sure. Come and write a few songs.
Huh.
He's just amazing.
There's talent out there, buddy.
I mean, he's on so many people's albums. It's crazy. He's playing with some hip-hop guy, too. Some rapper dude, Big Face or something. I don't know. Like, what? Mr. Big or something? I don't know. There's some... He's doing it all. Yeah, it certainly sounds good. So that NASDAQ trade kind of worked out, broke out, making a big run. So I cashed out when we got to the 1 minute structure. So I got to my exit. I made $26 on that last, or $36 on the way.
All
So
right.
just got new highs here. Never got filled on the sell side yet, but yeah, that was a night. That was about $80 right there. If I would have moved my target, $80 on that 1K right there, in just like 15 minutes. You know, it's hard to believe. You know.
Yeah.
Look at this 15 minutes. Look at this. This is. Look at, so you come down the round handle. You're up $80 in half an hour.
Yep.
On a 1K.
It's ludicrous. The NASDAQ
So
is
the people that are selling here are already up $1 off top tick Tommy of the day right now. They'll probably ride that for $30 to here. I bet that thing could pull back at least back to the structure closing high of. So somebody's going to make a little about a few points there, or they're going to get clobbered. But I'm going to sell into the clobber. So I put my tickets way up in Disneyland. above the high of like 3 days ago, starting to sell here into the close.
Right.
That's very
12,000
conservative.
range.
Oh, I got like I got 100 pip stops and some of that stuff.
Oof.
100 bucks. So here, look at the pullback on the 5 minute. Already cashing out.
Got to be a
Put
cash
some
out button
scalps
for
in
the
here.
robot. Like, here, you've just made $50. You're cashed out.
But see,
Bye-bye.
the problem with
go get a
buying,
life.
the problem with buying here, you got to put a 40 pip stop here just to make 20, just to make 30 come back, because it could just come sweeping back. I mean, this is the 5 minute chart, so you're looking at the 15. It's like, oh, that could easily come back to here. Jesus, come all the way back to the starting gate. I'm planning on. The idea of the market coming back to the starting gate 5 and 6 times is just something most people can't tolerate. They're like, when is this fucker going to finally go up? It's not. It's just here to torture
It
you.
never goes up. It's always, yeah.
It's just it's here to range you to death. How do you feel now about your trend trading? Oh, I just got done with a $6,000 trend trading course in class on how to build an algorithm on moving averages, and yeah, I'm waiting for my entry. You're waiting for your entry? Okay. Yeah, I'm not risking 2%, dude. I got this thing all tuned up, optimized, ready to go. I say, okay, well, like, so how's it going so far? I haven't got a signal yet, but I'll let you know. Meanwhile, I'm trading
Catch up next
noise.
year.
Meanwhile, I'm trading tops become bottoms on the half-hour chart, just doing the grunt work of getting in and out of the market. The grunt work of making little chunks of the market.
You're like that other guy who's like, fuck, I'll tell you when the stars align, you know. I'm getting the telescope out tonight. I can tell you if I'm putting a trade on tomorrow.
I was ready to go with that guy's program, but I thought, how am I going to integrate it with my ikamushus? Do I have to go to Japan and take the celestial bodies? Like, do I have to trade ikamushu based on I live in Japan? Because, you know, they have a different constellations in the sky over there. Right? You need a license too. I was just at the store getting some stuff. They're selling balloons. They're selling balloons for $1.50. And they're selling licensed balloons for $2. And I thought, man. So I asked the guy. He didn't think it was funny. I thought this was pretty funny. I just thought of this joke while I was in line. Of course, the joke is, I have a balloon license. Can I get a balloon I already have a balloon license for all balloons. You see my like yearly permit. Can I just get the balloons for $1.50? And he didn't think that was funny at all. I thought it was very funny.
Uh-huh.
I had to laugh. I laughed at his face. Ha ha ha. No, I just was like, wow. Yeah, geez, buddy. No, he was like that Buckingham Palace guy.
Won't move.
He blinks, they cut his head off, right? Then the rules of the road over there now. The queen comes out and does a fucking lop like a slasher movie, lopping off with his head. He blinked. He was scalping with 40 standard lots in the NASDAQ. Really nervous. He had like a 40-point stop. He had a $3,000 stop on that trade, and I bumped his elbow, and we lost on that trade.
And then off with his hat.
Yeah, they took off with his.
I mean, them guys probably make pretty good traders, right?
Oh my god.
The position on.
Yeah, can you imagine? Do you think that? You think forex is so popular that there's a kid out there right now being abused by his dad, like electrodes on his body parts, and going, "You will trade. I don't care how many times they stopped you out. You will trade this algo. You built it. You trade it." You know, like making the kid cut the lawn, but making the kid trade forex with his lunch money. Why is your kid so skinny? He's losing a lot trading. He's getting stopped out. He'll learn. No,
buying into the euro.
They learn. I mean, it's just like the paddle. They learn.
Sure.
Financial paddle. That kid's sleeping under a bridge.
The kids.
Until he gets enough margin required. Until he gets his margin account built up.
Oh man.
Yeah, he's working at McDonald's just so he can trade it on the Asian session. That Cedar FX doesn't give you any. They don't give you. They have no commissions. Yeah, there's a handful out there. Unregulated rules, though.
Ripping higher, it looks like. S&P.
I think we're going after that Asian session Sunday night's prices, coming all the way back to the starting gate. And end up with a hammer, a dragonfly, open web of claws. Oof. Yeah, I don't like holding over the weekend, but the dollar CAD would be plunging. The dollar CAD should plunge as the S&P and the stocks go up. I put my Gann grid on. That's going to help a lot. Yeah, I just took a refresher course. I just spent $6,000 last week taking a Gartley pattern course and an Ikamushi, and I blended them together. And the robot's killing it. Oh my God, the robot can order lunch for me now. That robot is fucking amazing. Ikamushi. The problem is orders sushi. Yeah,
robot.
it just keeps ordering sushi because of the Ikamushis. What do they call it? It's like egg drop.
You know what? I think they gotta keep. I think they're just trying to install hope in people. Listen, if you have this proper indicator, you just might be able to make a go of this business.
Well, it's the new. Isn't it the new perfume? This one will get you laid. This perfume right here. I remember they had that Yves Saint Laurent when I was a kid. They came out with opium. We were smoking opium back then. And we were like, "Wow, that's kind of funny. That's trendy."
That's pretty interesting.
They need a perfume called Black Tar Heroin, I think, because they had one called Yves Saint Laurent should come out with it. Actually, that kind of, you know what they should do? They should step in front of that one and actually, we weaned a bunch of heroin addicts, so they switched to our perfume and they think they're getting a fucking contact high just from the smell. Our perfume so accurately nails the fentanyl.
Thanks.
This is way we've. How about Elon Musk comes out with a cologne called Kraken. And how about
on the car.
we get claymation versions of Hunter Biden advertising for crack.
Oh my God!
The new perfume.
He was shaking hands with nobody there again yesterday in Israel.
Oh really?
I felt bad.
Yeah,
He
laughed
turned
till
around to shake someone's hand,
No, it's just
and the guy
embarrassing.
directed him, and he continued pointing to make it look like he was pointing. But he looked. It's just really, really. It's elder abuse, man. I don't care what anyone says.
It's just criminal.
Complete elder abuse.
What are you gonna say? Look at the euros coming back to the round. The euro's gonna take out the high of 2 days ago at the same time the S&P. I think we're gonna take out. You got 20 more pips to go here. 25 pips more to go north on the euro, and then the S&P is going to close up too. So we're taking out the high. I think it's the same scenario for the euro. Euro goes up to Asia's prices, and the NASDAQ goes back to Asia's prices. Crude oil. Where's that going to close at here? Crude oil's kind of in a, I think, a kind of a bear market. Industrially speaking, you know. Who needs oil if there's a recession? A fundamental view. Yeah, so Canadian dollar down, stocks up.
What did Trump say? He's going to run?
I think somebody said it was like a major hint or something.
Sure.
I think it's paying for the obvious. He just left Alaska. He probably they had like a record turnout in Alaska. They just got all these woke idiots. It's like me saying, "Come along with me, and I'm going to take all the Social Security front and run it through my robot. You're safe with me. Come along with me. Put your mask on, though. You're going to need a mask for what I'm going to do to you." Like Bush wanted to put everybody in the stock market. It was hilarious.
Right. That's pretty funny, actually.
Oh, what a goof fuck! And then the market crashed. Everybody's like,
Not a
everybody,
smart man
everybody clinched their ass cheeks together, going, "We missed that bullet." Like, wow, whew. what a
Armstrong went to it.
bozo!
They called him to interview him.
Super
and he went to interview
bozo.
him.
Oh, bozo
He
the
is.
clown.
No. They told him that he's actually not that bright. And Marty Armstrong's like, "What do you mean he's not that bright?" They're like, "No, he's stupid."
Yeah,
he went to go visit
goofy.
with him.
You know what? He's a goofy
stupid
patriot.
man.
He's like, I think Jimmy Carter was smarter, but Jimmy Carter was a little bit too careful, I would say. In other words, he had no balls. So being careful could be dangerous too. Where Churchill, to me, at least from what I've heard of him speak, I'm like, there's a man with balls. Giant, hairy balls, no shame in his ball game. But that's what you need, and that's why they don't like Trump, because he's a grab him by the pussy guy.
Sure.
And he says they like that. He says they like that, and I know girls that like that. And I know girls that grab him by the dick. I met one of my girlfriends was grabbed by the balls. She would check everybody's package at the bar. It was her deal. People said to me, "What about your girlfriend doing that?" And I said, "Well, she's really not my girlfriend. She's just she's my neighbor, and she's out of her mind. And I find her entertaining. We're not married. Yeah, besides, she thought it was gay. She claimed it was gay because I wouldn't bang her. But she was a gymnast, so she could do backflips in high heels, and then she grabbed people's crotches at the last moment coming down.
That's a girl.
No, she was a real performer. She was a fucking gymnast, 6th in the country, until she broke her foot. Yeah. Her boyfriend ran over her foot with the car, so that's what ended her career. It's an absolute cliche, the most cliche story in your life. But
oh my God.
Yeah, your classic hometown girl, and from a small town, but totally ripped. I mean, this girl was a gymnast. She had veins in her fucking legs. Like when she took her, she was wearing shorts. She could pick up she could pick you up by your hair with her toes, throw you around and shit. It's crazy. Because she got the 4-inch beam. She was 4-inch beam expert, so she treat you like a 4-inch beam. And I wanted her to sit on me. She thought I said, I'm not perverted. I said, listen, you're just heavy enough that if you just sit on my back, it's a lami technique, a massage that I got when I was in Hawaii one time. The guy said, it's cost extra, and you need a license for it. It's like the sushi guy that makes the fillets. So I said, do it, Well, he lamied me and started your ass and go all the way to your neck with full body weight, with his forearms oiled up. And when you're done with that, dude, you're so relaxed. You're so relaxed
Really?
that if somebody says something wrong to you, you go, fuck off. You have no filters. So I went out to eat with my parents that night in Hawaii. And I'm driving this rent-a-car. And everybody's criticizing my driving. You know how I can't handle criticism. I just can't take it, so I have to lash back. So I was basically told my parents, like, fuck off. So they threatened to, they go, well, you can just go home. I said, okay, I will. And my girlfriend said, can I stay? I go, you can stay all you want. Fuck these people. But no, I never been like that rude in my life, but I think I blame it on the massage. But I tell you what, I was so relaxed. I was literally, it turned me into an 8-year-old kid. I was like, I don't care about nothing. I don't recommend. I'm very careful. The guy warned me. It wasn't physical. So I came back to the guy and I said, dude, that massage you gave me, I feel like I almost went to jail. I was so relaxed. I just said whatever I thought, and I almost got in big trouble. And he said, no, it's not that. It's the volcanic. You're in Hawaii, and there's volcanic action out here. And I'm like, holy fuck.
Oh, no.
Because the other thing he did when he's on top of me, that sounds bad, but he says, do you mind if I make sounds? And I said, no. So he's doing vocal vibrations to try to give me micro, healing from the vibrations. And I get that. And it probably does have a slight effect, right? More than a mask,
Your
right?
body's
More than a
reacting to everything,
mask.
right? Yeah, right.
But I think if you're a true believer, and on the micro level, it's like, the Reiki massage where they don't touch you or something. They kind of just go over you, like they take their hands and rub them together. It's it's like a healing technique in martial arts. If you get hurt, they rub you and make heat. But they rub their palms together and they get their palms near you. I mean, it's going to anyways.
Do anything?
You know what I'm saying. But yeah. Well, I guess in a sense, like, so it's like a Tai Chi thing. You start to go down this mystic road at some point, and you end up in Ikamushus, and you end up blowing up your account. You get two, but I love the Asians. I love the Asian girls with the mask on. I really like that look.
Well,
Give me some.
listen, you know what? In Asia, I think people wear masks. They have a cold, so they don't cough on everybody.
Well, they're always,
Or, you know,
always got
you're
some kind
sneezing.
of yeah. Well, they're in mass
And that makes
transit all
sense
the
to me.
time.
Be
Mass
polite, you
transit.
know. Don't walk around sneezing in the air right in front of 30 people, you know. Put a mask on if you're going to sneeze your brains out.
It's also
If you have to
a
go
mass
out at all.
transit issue, isn't it? Too. They have those subways and all those byways. And
They push the people in the trains there. Imagine you rolling up to go to work in Tokyo, and there's a guy behind you, the baton, and he's squeezing everybody into the train. I mean, it's so ridiculous.
yeah, no, they really try to be efficient, and you know they do have central planners there, so they're very dialed into the latest stats to try to adjust. It doesn't work for Americans because we're just too helter-skelter. See, I think Charlie Manson nailed it there. Helter-skelter. He's the guy that wanted the Civil Wars. It's kind of funny back in the 60s. Kids these days don't understand.
we're all on
People that are
acid
20 years
before.
old don't understand how crazy it was in the 60s.
Yeah,
they
it
think,
was really nuts,
They think
without a doubt.
fentanyl's crazy. People were overdosed. I mean, it was crazy. My cousin was
People
a
didn't know what they
heroin
were
addict.
taking, man. They were just popping. Here, try this yellow one. Okay, what about this red one?
Did you?
They would
Yeah.
have bowls full of pills. They had no idea what they were taking
Just
and
go,
what
go,
combinations
go.
they were taking.
You want to laugh? Go
Very
watch
good.
the old Dragnet shows with the
Right.
busting the party with a bowl full of different colored bright pills, and the Dragnet guys are like, look at this, they were taking pills of unknown origin. I used to watch the Dragnet thing, real stories, real people, shit that happened. Now you can watch body cams of some congressman getting pulled over, hammered to Kingdom
Oh, no.
Come. Have you watched that
Oh,
stuff? Code Blue channel, like, oh my God, there's these typically Democrat girls that pulled over just annihilatedly drunk, and they go, "Don't you know who I am? I'm a legislator." It's like, honey, you're just hammered right now.
Yeah, you're not allowed to drive right now.
Baby's hammered. Baby's in a world of hurt. I'd take her off the staff, the drive. She's no longer allowed to have a chauffeur's license. She should be riding in the back of the limo. So they never got to be that rich. That the movie stars got hammered. A lot of them didn't even drive.
Oh, yeah. James Dean died, didn't he? He crashed his car. He was probably on
Yeah, gosh. Was he 20, 28, 20 years old? All those people, man. Yeah, all those people. Hendrix, 28 years old. A lot of 28-year-old guys.
27, I thought.
Oh, 27 now.
Yeah.
Well,
Same
in the
with,
30s, I
Morrison.
would say.
27 seems to be the number.
Janis Joplin, all those people.
And it's 27. Yeah, but you know what? Because they hit such fame and fortune by 25 that they had nothing to do with themselves. They literally didn't know what to do with themselves. And no one was there to guide them, to tell them, listen, you can have a career, blah, blah, blah. They were into the partying. I mean,
Yeah.
Janis Joplin got in to get laid. She wasn't a pretty girl.
I don't know. She's hot, like tomboy hot. So yeah, she wasn't girly girl.
Not at all. But she's the kind of girl that could, she got into the rock and roll business. A lot of guys will throw it at her.
I guess
You know?
she reminds me of my last wife. She's really kind of organic. I would say.
Yeah, she's
not a lot of makeup. I don't think.
A
but,
beatnik type of broad. We get it.
Yeah,
We get it.
really down to earth. I say.
Going to patchouli.
Certainly, she was. So Big Brother and the Holding Company, that stuff, man, that's crazy. That band she had. I mean, really, there's a band too. Don't forget.
They're really good guys. Yeah, they were.
I mean, heavy stuff. It's like Eric Burden and stuff. That's heavy music. I mean, it's just nothing like it, really. Like when I heard 8 Miles High by the Byrds, I was like, man, this is a guitar solo. It's just scatterbrained. It's like McLaughlin. And those films are still on YouTube from the black and white 60s. MC5. I had my neighbors in MC5 so heavily.
Oh, but I gotta bust a move. I gotta make some phone calls to the team. I'll try to catch up. You gonna be out for a little while?
I suppose I'll be hanging out here. I don't know if we had.
All right. I'll try to tap in about a half hour.
Still waiting for this guy TT to speak. I think that's the FBI informant. So
I've been texting him. He's a young guy. He's learning to trade different techniques.
Okay.
But I'm trying to guide him in the best direction possible.
Pitching and buy him a microphone.
Oh yeah, I would. Maybe he does need a microphone. I'm not being facetious on it.
Well, he can hook a speaker. You could take a guitar speaker to hook it to your laptop.
Yeah, probably. He's got a friend
That's
to
the
hack.
that they ended up doing that with kick drums to record kick drums. They took a speaker. Some guy said, "Well, just take a fucking no shit." Took a 10-inch driver. He made a mic out of the 10-inch driver so it could handle the fucking kick, and it'd be a great fucking secondary feed.
Oh, I mean, you could just use a smartphone. The Discord as an app.
Yeah, there's no excuse. There's no excuse for appearing as an FBI
I think
agent.
he's one of the vibration protectors here.
Oh, it's trying to. Oh, is he Robinacci's student?
No.
He's the one that got away. I've been watching a lot of horror flicks. He's the one that got out of the shed, found out how to do his own film. He got hold of the Fibonacci tool. He ran to the sundial. He goes, dude, I'm going to trade fucking soybeans. Yeah, based on seasonal. Dude, get away from me. I got my. Don't touch my Fibonacci tool. I just cleaned it. I just oiled my Fibonacci. You know what? That's the thing. When rusty Fibonacci tool, I was not getting a good fill. I was just missing the market by that much. That'd be funny if I had real swag, like send out a real Fibonacci. I swear to God to you, the back of Robert Fisher's book on the logarithmic spiral and Fibonacci. It's a real book. Got it downstairs, and it's so funny.
Have you got like a full library of these old books still?
Yeah, I mean it's terrible. I mean if you crack them open, and now that you look back, 30, 40 years later, you go, oh, I get it. I see. I think I always thought if I opened up one of those books, it would say, well, do this and do that, and you'll make money. But there was no trade plans in any of the books. So I was like, damn, this is crazy. This is all like philosophical, abstract kind of like contemplation of does 618 really exist? And okay, I think I marked it off.
Take a picture of these.
I think I got it, and I got the 618, and like, wait. Like, is that? Well, it's close. All right, the market came back to 618-ish, and as soon as you put the ish on there, then why 618? Why not just go 60, 70, 80, 90? That's why I just became a grid trader, I think. But I think I was just like, what are we doing here, people? 618. I love it though. I'm glad you picked the number. I guess it's keeping people from over trading, to be honest with you. I mean, it's certainly a balance, right? You can't stand in front of a train. And you shouldn't just only show up at the train station once a year. There's got to be something between showing up once a month for the train, hoping you catch it, or laying on every track you see in the yard. But yeah, next week's going to be pretty much, it's going to take so much. Like I say, it takes very long for a market to retrace after being pounded to death. Like, so the euro dollar is so beat to shit. They just took out the, they're trying to take the high of 2 days ago. It's a struggle here, but look at the pullback we just witnessed. That was worth about. So if you're quick straw McGraw here, you could have made yourself a 30 pips here, really easy. All you had to do is place your buy limits back at the starting gate. And this is a 25 pip grid, so this is about a 20 pip window. And in this case, what you'd be doing is trying to, you're going to have to buy, probably start buying here. And maybe you got tickets all the way down here, which I do. And we got underfilled. It's too late, in my opinion, to sell up here. But I think when you come into the, so the 1 hour charts are like the I guess, the most rinse and repeat charts. So coming into Monday, this is still a great place to buy. Sell side, geez. So looking at this thing. They'd all be short term though, you know. So even if I was going to sell up here, which would be a little bit, certainly, we know there'll be sellers up here, right? People cashing out. There'll be drama. It's like a 35 pip window of drama coming. So you can either scalp in that stuff, like it's going to pop up there and ricochet around. So what kind of trade do you want to do, you know? I say buy here and sell up here. And maybe you're short right now off of this little slot. I'd probably put your target for the day. Day's coming to an end. That's the 1 minute chart. So 1 hour chart. So coming back to here would be your target probably. Just like a 15 pip scalp. Not the best trade in the world. These guys are making money. Another top tick Tommy. Just made himself a clean $30 there. We're not doing we're not getting filled on nothing here, looks like. Looking for the CAD to retrace up. A little drift up into the close.